Hello everyone. This is the first chapter for EPFO for General Accounting Principles. Today is the first class. Today we will discuss basics of accountancy, the definitions, mandatory principles, types of accounting and accounting standards. After that, we will discuss the basic accounting concepts. So let us begin. Firstly, we come to the definition. Accounting is the process of identifying, measuring and communicating economic information. This permits informed judgments and decisions by users of information. So we see that there are three parts. First is identification of economic information, whether or not a transaction has any economic value. So mind that economic value is necessary. If something cannot be measured in economic terms, it will not be accounted for in the standard form of accounting. Second is measurement. Measurement means estimating or quantifying the value. For example, if I buy a 10 rupees chips packet, that has to be recorded as 10 rupees chips packet, not just a packet of chips. So quantifying the value of every transaction is important for accounting. And third is communicating. Communicating in this form means recording the statement in different books of accounts. So books of accounts we'll study in later chapters. These are basically different forms of registers you might have seen in various shops, that they have a ledger, a cash book, a journal. So every transaction in accounts has to be registered in different books of accounts. Accounting information can be used by different users. It is used for economic decision making by the management, by the board of directors. It can be used for shareholding investment decisions as well as tax decisions by government. It can be used for valuation by consultancy companies, McKinsey, Bain, etc. you might have heard. So there are two kinds of users. Firstly is the internal set of users, which are the employees as well as management, and second is the external form of users, which are government, investors, etc. All right, now we move forward to the next slide. There are three types of accounting primarily. The first is financial accounting. Financial accounting looks at the finances, the overall financial statements, by measuring the profit and loss, closing balances as well as opening balances. What was the position of any company or a going concern or a shop at the end of every financial year as well as at the beginning of every financial year. This also conveys financial information for longer term purpose, such as debt equity ratio, how much liability you have for debt towards equity. It also helps in tax authorities to assess how much tax to be calculated for any entity. Is this clear? Okay, now we move to the cost accounting principle. Cost accounting is basically measuring how much it costs to make a certain product. For example, if I have to make a bucket or a pipe, so first will be the raw material cost, then will be the processing cost, then will be the employee cost, and last will be the marketing costs as well as other operating expenses, right? So all of these will go towards the costs, and only after these costs are analyzed can we ultimately set the price, because if the price of any product does not cover even the costs, then it's going to lead to a loss. So the second form of accounting is cost accounting. The third form of accounting is management accounting. This is basically non-financial accounting. This looks at how productive an employee is. So productivity of employee, customer feedback, customer satisfaction, all of these come in management accounting. There are other forms of accounting also, such as social accounting, which the government can look at on the basis of how are different companies making decisions and how is it impacting society, but this is not important for the purpose of this course, so we will not delve into that. Okay, moving on to the next slide. Okay, so now we will start with the theory part of accountancy. So accountancy books have to perform certain features. They have to live up to certain expectations because there are different users of the economic information. What type of users did we discuss? We discussed internal users, the employees as well as management, as well as the external users, the shareholders, the tax authorities, government, etc. So for the benefit of all of these, there are some mandatory features of any accounting books. Alright, we will discuss what these accounting books are in detail in the coming lessons. For now, just know that all of these accounting books have to follow certain principles. I will just give you a brief hint, brief summary: cash book, uh, journal, ledger, and balance sheet. These are the primary accounting books that we'll be dealing with over the course of this entire course. So the first principle that we have to look at is the principle of reliability. The information in the accounting books has to be completely accurate. If it is not accurate, then you can understand what will be the problem. It cannot lead to trust. So the absence of trust will lead to false information. This makes the accounting books irrelevant. Now we come to the second part, which is relevance. So only that information which has some relevance to the users has to be looked at. So every accountant has to understand who are the final users of the books of accounts. So whatever is being taken has to be recorded in that manner. For example, if a shopkeeper provides food for his employees, so he does not have to mention, if he is keeping food for employees, whether he bought pakoras, chai, etc., as long as he just measures food as one item in the expense category, and he can simply say, however, this is for a shopkeeper, right? For a restaurant, what food items were taken becomes relevant information. So relevancy has to be looked at depending upon who are the users of the information. And for the internal users, especially the management, you have to look at what is relevant depending upon the industry. Now we come to the third part, which is understandability. Okay. So the information has to be conveyed in a form that is clear, concise, and formatted. This will ensure that ultimately the readers of the information have access to actual unadulterated financial position. So maintaining the integrity of the account books requires that the person who is ultimately going to be using these account books not just knows that these are reliable and relevant information, but is also able to understand. So this means that you have to record every transaction as it is. If you received cash, you will have to record it as cash account being debited, not ki 200 rupees being debited or UPI being debited. These will not do. You will have to debit the right amount and then mention the accountancy value. We will discuss how these books of accounts are prepared later on, but I am just giving you an example. Now, besides this, we come to the last principle for ensuring fairness of account books, which is comparability. This is the most important principle because a lot of accountancy concepts which is going to be the main part of this video, are dependent upon the comparability principle. Comparability principle means that account books should be compared across industries. For example, the balance sheet of the pharmaceutical industry should be able to be compared to the balance sheet of a steel company. We can learn what are the different parameters that a steel company uses and what are the different parameters that a pharmaceutical company engages in, to understand what are the differences between the two industries. Within the same industry, so the information that is supplied by two pharmaceutical companies, for example, should be comparable with each other, that what are the ingredients they are purchasing, how much they are paying for research and development, for marketing purposes. So their books of accounts should be in similar form. Third is across time. If in 1 year I maintain a cash book which shows how much cash I received and I paid, and a balance sheet, and in the next year I only maintain a debt record, how much someone owes me or how much I owe to someone else, but I don't maintain a cash register and present a balance sheet, then it makes no sense, because in 1 year I have only accounted for the cash flow, and on the other year I have only accounted for the income earned but not the cash earned or kept. So this means that ultimately information across 2 years will not be comparable. So maintenance of the same balance sheet, the same information across multiple years is very important for the purpose of comparability. One more aspect that we'll discuss is within the same company, but we'll discuss it later. Within same company, we'll come to this towards the end of the class. So if this is clear, let's move on to the next part, accounting standards. So accounting standards are basically principles or rules which have to be followed for maintaining books of accounts. Maintaining books of accounts. What kind of transactions are you supposed to record? How much are you supposed to value something? What value will you involve? So what books, what value, what time. These are basically some of the rules that the accounting standards have to look at. So the most popular is the GAAP, the Generally Accepted Accounting Principles. These are a set of rules for accounting. This was started in the USA, but India's own Generally Accepted Accounting Principles were laid down by the ICAI. The ICAI has also laid down accounting standards. There are multiple accounting standards, AS1, AS2 they are called, which those who are studying for CA might be aware of, that every particular book has to be maintained according to different AS. The next set is the International Financial Reporting Standards, the IFRS. These are not rules, understand, these are not rules, these are only principles. So the GAAP was a set of rules. They provided what value. For example, they said historical cost is to be looked at, that the cost at which you buy something has to be the cost which is recorded. There is no deviation from the principle. The IFRS, for example, provides for the fair value concept. How is the fair value going to be arrived at? Is dependent upon the specific jurisdiction. Jurisdiction is any country which is supposed to apply these rules. So the IFRS is what is accepted across 167 jurisdictions, including the European Union, the India has also come up with the National Financial Reporting Authority under the Companies Act for implementing the IFRS in its own form. So the NFRA now replaces the ICAI's mandate. The ICAI is Institute of Chartered Accountants of India. Earlier it used to set the accounting standards as we saw, but now the NFRA sets the accounting standards for companies as well as for other different accounting entities. So the ICAI now only conducts the exam for CA. Okay, if this is clear, let's move on to the next slide. So now we come to the concept of double entry bookkeeping. Double entry bookkeeping is the foundational method through which books of accounts are maintained. Double entry basically means that every books of account has two different categories. One is the liabilities side, the second is the asset side, and any transaction which has some effect on either of these two will ultimately be reflected through a debit or a credit on both sides. So if something increases our assets, it is debited. If something increases our liability, it is credited. However, if something decreases our assets, it is also credited, and if something increases our decreases our liability, it is also debited. Understood? So bookkeeping is the act of record keeping for financial information. We'll discuss the rules of debit and credit later on in proper depth in the next class. At present, it's only important to know what is double entry bookkeeping. So the bookkeeper is actually the original name for accountant, and in the ancient times it was called a bookkeeper only. This is based on the principle that every monetary transaction has a dual effect. This is the duality concept that we will learn later in this same class. This helps ensure accuracy of financial information and seamless flow of data, because if anything is measured on both sides, the debit as well as the credit side, ultimately it is reflected in a proper form across the final books of account in both the ledger as well as the balance sheet. So this leads to accuracy of information as well as seamless flow of data across multiple years. This originated with Middle Eastern traders. Luco di Borgo of Italy gave it the modern form by writing a book on this subject, on how to maintain double entry bookkeeping. Alright, now we finally move to basic accounting concepts. These are the 12 concepts which are the main crux of today's class. Now that we have sufficiently discussed the background of accountancy, we will move to what these principles are. These concepts are fundamental to the maintenance of books of account. This is different from the cautions that we originally discussed. You remember? Reliability, relevance, understandability, comparability. These are slightly different. These are the technical measures that are used while maintaining the books of accounts, but they are directly dependent upon these 4 cautions. Okay, so these are the 12 concepts that we will be discussing over the course of this class. The business entity concept, the money measurement concept, the going concern concept, accounting period concept, cost concept, duality concept, matching concept, as well as 5 conventions. Okay, so these conventions are also called concepts, but these are not the same as the previous concepts. We'll discuss their differences: the full disclosure, consistency, prudence and conservatism, revenue recognition and materiality. Okay, let us begin. First is the business entity concept. This means that the business entity is separate from its owners. Alright, so this means that a business is a separate legal identity altogether. While we maintain the books of accounts, we maintain it for the business, not for the owner. The owner is only a liability. The capital invested by the shareholders is recorded as a liability of the business, which will ultimately be paid back. Now you will see in the next principle how this is slightly contradictory to one of the other accounting concepts that we will be discussing, but we don't have to worry about it. Okay, the capital invested by a shareholder is a liability for the business and it will ultimately be paid back. Moving on to the next concept. The money measurement concept. The money measurement concept states that only those transactions which are happening in money terms can be recorded in books of accounts. On the other hand, transactions which can't be expressed in monetary units are not recorded, such as acts of kindness. If I tell someone that, listen, you're looking very good today, that is, or please take care, please go home early if you want to, that is only an act of kindness. That does not have any direct monetary impact, and as a consequence, it cannot be recorded in the books of account. On the contrary, any transaction which has economic value in monetary units, such as charity, if the business donates something to the people for advertisement or for genuine goodwill, all of these will be recorded because they have monetary value. They can be expressed in terms of money. But what about if the owner decides to pay some poor people or to organize a bhandara or food camps for certain people out of goodwill? Will that be recorded? No. Why? Because of the business entity concept, that the owner is separate from the business. This does not happen in real life. Most businessmen ordinarily ensure that anything that they do, all expenses that they take up, is recorded as a business expense. But in terms of integrity based financial accounting, we don't consider the expenses made by the owner as expenses of the company. So some examples that we will be discussing: appointment of a very efficient manager. This actually improves the financial performance of every company. Everyone knows this fact. In fact, shareholder also uses this information. However, it is not reflected in the books of accounts. A new competitor entering the market, this increases the losses or the possibility of loss for a business, but we will not account for it because this does not have direct monetary value. A rift between the production and marketing departments, the capability of human resources, etc. You are hiring very skilled labor, you are not hiring any skilled labor, employees are leaving at a very fast rate because of high attrition. All of these will not be recorded because they cannot be expressed in terms of money. This is the money measurement concept, that books of accounts are only concerned with economic transactions. Moving on to the third concept. This is the going concern concept. The going concern word, the word going concern normally means that companies businesses will go on, made out of one poem. It says that owners may come and owners may go, but company goes on forever. So this is basically the idea of a going concern concept, that the firm would continue to carry out its operations indefinitely. This means this allows for closing accounts to be prepared at the end of every year and opening accounts to be prepared at the beginning of the next financial year. Now this is where I had earlier pointed out a contradiction that we'll be seeing. Do you remember with the business entity principle, with the business entity concept, we had seen that the owner's invested capital is a liability for the business. It has to be paid back on some day. How will you pay it back if the firm will carry on indefinitely? This is merely a contradiction that is philosophical in nature. It does not impact how we prepare our books of accounts. These concepts are only to maintain accurate books of accounts. If we are to maintain books only on the basis of that what happened in 1 year, then we will not be able to record debt for multiple years, 3 years, or cash for 1 month accurately. As a consequence, we ensure that the going concern concept is applied so that we have timely, accurate information about financial data for any company, for any shop, or any sole individual or partnership. Okay, moving on to the next slide. Now we come to the accounting period concept. All books of accounts, be it the balance sheet, the profit and loss account, etc., have to be provided at regular intervals. Normally, while studying accountancy, we study it for 1 year. However, companies have to provide for quarterly as well as half yearly reports as well. Public companies especially. Annual reports are discussed at big meetings such as the AGMs. So the accounting period concept ensures that through regular intervals we can have measurable information. This ensures comparability, which is one of the fundamental needs of any account book. Because if we have information for 3 months in one go, and then we have information for 5 months, and then for 4 months, then we don't know how exactly are we performing in each segment, because these are not comparable directly. If we have 4 quarters, then we definitely have a better comparison on which quarter provides for good returns, which quarter does not provide for good returns. So having any monthly, quarterly, annual assessment ensures that information is comparable. So this is the accounting period concept, that books of accounts have to be maintained for specific time frames. Okay, now we move on to the next accounting concept. The fifth concept that we'll be discussing is the cost concept. The cost concept basically means that the price of all assets is to be, for the purpose of valuation in the books of accounts, have to be recorded at purchase price. So when we have to decide the value of any asset, we look at how much it was purchased for. And when we discuss how much it was purchased for, we discuss cost of acquisition, the crude cost that was paid. For example, if you purchased one machinery for 5 lakh rupees, then you paid 1 lakh rupees for transportation 20,000 rupees for installation as well as 30,000 rupees for cleaning or ensuring that its pipes etc. are connected, then the total cost that will be recorded is 6.5 lakhs. Understood? 5 lakhs, 1 lakh, 0.2 and 0.3. So all of these will together add to the capital cost. All of these costs together make up the purchase price of any asset that is to be decided. Suppose the same machinery 1 month later costs 13 lakhs in the market. Now what? Now suddenly do you change the entire value that is recorded? No. Market price at different dates is not recorded. What will be recorded later on is the sale price. If you decide to sell the machinery, then there will be capital gains on the sale of machinery. That can be recorded, but for all purposes, the purchase price in your books will be what will be the cost of the machinery. So if you buy it for 6.5 lakhs, then you will continue to show the machinery as 6.5 lakhs in value, even if its market price is different. Sometimes it happens that there are accounting standards on over the course of time, the value will go down. For example, there is a car. It might cost 30 lakh rupees. An expensive sedan might cost 30 lakh rupees when you buy it. But the moment you buy it, you cannot sell it for 30 lakhs anymore. So what we apply is depreciation. We will discuss this concept later on in another class in proper depth. At present, just understand that sometimes depreciation of value happens or appreciation of value also happens. Appreciation of value only normally happens for land, because over the course of time you might have purchased a land or a house for 25 lakhs. It could be worth 1 crore in modern day property prices. So appreciation also happens, but depreciation is the most common accounting activity that we conduct for most assets such as machinery, flooring, office equipment, etc. All of these face depreciation in value. So there are some certain accounting standards which deal with how depreciation has to be recorded, and depreciation is recorded as a separate entry, recorded separately in the books of accounts as new transactions. So this will reduce the value of a machinery, but this will happen over the course of multiple years. Okay, so as we see, the general rule is only to record the cost price on at how much did you buy a particular product for. Moving on to the next slide. This is the most important concept in the entirety of double entry bookkeeping, the dual aspect concept. The dual aspect concept basically means that every transaction has a dual effect. We discussed it earlier also while giving the background of theory of double entry bookkeeping. This means that every transaction affects two accounts on opposite sides. These two accounts are normally maintained, one on the debit side and the other on the credit side. Okay, so the debit and the credit have to be equal. For example, if we purchase goods, now if goods are purchased, then cash will go out. So goods will increase in assets, so we will debit some goods and we will credit some cash because cash is going out for, let's say, 100 rupees each. So goods worth 100 rupees. Why goods worth 100 rupees? Because of the cost concept, that even if we bought 120 rupees of goods worth at 100 rupees, we will be recording their value as 100. If we bought if we paid 100 rupees cash, we will be recording 100 rupees of cash. What if the discount is measured? We'll discuss it later in a separate class. Please remember that both aspects are to be recorded. The general rule is that assets is equal to liabilities plus capital. Capital is also recorded on the liabilities side. So this is how a balance sheet ultimately becomes equal. That if think of it as a pot. If the owner puts 2 oranges and a creditor or a family member puts 3 oranges inside the pot, the total number of assets inside the pot are 5 oranges. So on one side you will only record 5 oranges. On the other side we will know that 2 from the owner and 3 from family. So the asset side has to be equal to the liability side ultimately. There are times when profits and losses have to be recorded for different purposes. For example, if we buy a machinery for 6.5 lakhs, we debit machinery to cash. We pay cash 6.5 lakhs. Now later on we sell this same machinery for 10 lakh rupees. What will happen? How will we record this transaction? Because there is more cash, there is less cost of machinery. For this we will do cash. If we get 10 lakh rupees to machinery 6.5 lakh and to profit and loss account. This is a profit because it's being credited. So profit and loss account 3.5 lakh. Ultimately both sides have to be equal. If 10 lakh are debited, 10 lakh have to be credited also. Okay, so this is the dual aspect concept. This is the basic foundational principle on which ultimately all double entry bookkeeping is done. Now we move on to the next slide. Now we come to the realization concept. Before this, I would just like to clarify that if you all think that my pace is too fast, please feel free to pause the video to understand a concept or to rewind. Don't be overwhelmed with the speed of the slides. This is going to be a big course altogether, which is why my speed is going to be slightly at a higher pace. But don't worry, the concepts we will cover over the course of multiple slides. These are only an introductory sessions. Ultimately, we will be applying these concepts in multiple slides, so in multiple classes. So you will get a hang of it over the course of time. Don't worry. Okay. So we come to the realization concept. Realization concept is based on one basis of accounting, which is called accrual basis. Okay, there are two bases. One is the accrual basis and second is the cash basis. The cash basis of accounting says that only when you receive cash should you record a transaction. This used to be in the earlier times, ancient times, when money is what matters. Over the course of time, banks have grown, so record keeping is easier and more sophisticated. Contracts can now be enforced in courts, so there is less risk of what? Of debt default, कि कोई आपका पैसा लेके भाग जाएगा. That risk is very less. So as a consequence, we have moved to the major form, which is accrual basis. Accrual basis basically means that revenue from any business should be included when it is realized. So if I sell you goods on one day and you are to pay me 20 days later, even then I will record the transaction on the day when it is done, not 20 days later when you pay me. Okay, so this is the realization concept, that revenue from any business transaction should be included in accounting records only when it is realized. Revenue is said to have been realized when cash is received or right to receive cash on sale of goods or services has been created. So if I sell you goods and you are to pay me 20 days later, my right to receive cash has been created today itself. Therefore, I will record the transaction today. This also means, in other words only, when the obligation to receive the amount has been established. One should record revenue when it has been earned, not when the payment is collected. When the payment is collected, we will make a separate entry. Please understand. This helps in ensuring details of one accounting period are maintained within that period itself. For example, if I sell goods on 30th March or 29th March, but the payment is to be received 10 days later, how will I record this entry? And don't worry, I will be explaining how to record journal entries over the course of other classes. I am just giving you these examples so that if you are able to understand how double entry bookkeeping works. So if I sell goods on 30th March and they are to be paid for 10 days later, so my creditors is going up. So I will say creditors debit for rupees 100 to goods debit for rupees 100. This will be on 30th March, and then on 31st March I will make my balance sheet. The opening balance sheet over the course of the next financial year will have some creditors, and on 10th of April or whenever that money is paid, I will say cash debited rupees 100 to creditors. To debtors, I am so sorry, I made an error. Even in the earlier transaction it was debtors. Debtors are those जिनसे आपने उधार लिया है, who owe you money. Creditors are those who you owe money, जिनको आपको पैसा वापस लौटाना है. Please ignore this. The transaction is going to be, in the previous one it was debtors credited. Debtors are an asset to any company to goods, because goods are going down. After realizing, it becomes cash debited to debtors for the same amount, rupees 100. If the debtor is unable to pay, for example the debtor pays only rupees 90, then we also credit it to loss account. Then we also debit the loss. We get 90 rupees of 90 rupees of cash, 10 rupees of loss, and 100 rupees of debtors are being removed. So this is the realization concept, that at present we only record how much is realized. Okay. So one example that we can look at is, if A sells 100 barrels of oil to B on 10th Jan, it will be paid on 10th Feb, then revenue is realized on 10th Jan, whereas debt will become realizable on 10th Feb. Before that, if I claim the debt, the debtor has the right to say no, I will pay after 10th Feb. This is out of our syllabus. Okay, moving on to the next slide. Now we come to the matching concept. The matching concept states that expenses incurred in the accounting period should be matched with revenues during that same period. That it implies that all revenues earned during one accounting year whether received or not received during that year, and all costs incurred, whether paid or not paid, will be taken into account while ascertaining profit and loss of that year. So this is the reason why in the previous slide, even if we sell goods on debt, we have to maintain that there is a debtor for rupees 100 and goods have gone down by rupees 100, because our balance sheet has to reflect ultimately that there is a debtor as well as some goods. We cannot wait for cash to come in before we record a transaction. It has to be conducted in the same time period. It is also a part of the matching concept that both sides have to be equal across time. So as a consequence, this is a corollary of the accounting period concept and the duality concept. You remember a few slides ago, I had given the example of how we sell a machinery for rupees 10 lakhs, which was worth only rupees 6.5 lakhs. Remember? So we had also credited the profit and loss account for 3.5 lakhs. This ensures that whatever profit we have made will be made in that same accounting year. What if this P&L, this profit that we had made, was to be vested over 5 years? Then we would have to provide for provisioning. So some of it, while we receive cash, some will be machinery. If we receive cash for rupees 10 lakhs, machinery is sold for 6.5 lakhs, but the profit that we make has to be realized over 5 years. Then this year's profit is only 70,000, and provision or reserve is more used for ordinary amounts of money that we keep for future purposes, that will be credited with 2.8 lakhs. Understood? So the profit and loss for this year will only be what is meant to be taken this year and nothing outside of it. Moving on to the next slide. Now we come to the full disclosure concept. This is also a convention. Okay, this is not the same as the other concepts, because the other concepts had a direct bearing on how books of accounts are to be made. This is a guiding factor. This concept basically says that all material and relevant facts, material means important, relevant means which the users will consider valuable, concerning the financial performance of an enterprise, must be fully and completely disclosed in the financial statements. This is a direct corollary of the reliability requirement that we discussed earlier. Full disclosure means that there should be full, fair and adequate disclosure of accounting information. In the absence of full, fair and adequate disclosure, it can lead to scams. If one might recall, there was a Satyam scam a few years ago where they had not disclosed the existence of some books of accounts and they had fake information about employees. This led to banning of the auditing firm that had conducted the audit because they did not record the fault that the Satyam company had made. Result also led to some arrests and a loss in the general investor confidence. So it is not just the company which suffers as a consequence of false information, it is also the entire market which suffers because everyone relies on financial statements. Be it your competitors, be it your lenders, be it your vendors or your creditors, debtors, etc. Everyone relies on your financial statements. Therefore, full, accurate and fair disclosure of accounting information is very necessary. Now we come to the next concept. I hope this one was clear. This was very basic in nature, that you should be honest about your actual true financial position. We come to the next slide. This is the consistency concept. All the coming concepts are basically conventions in some form. They can be deviated from if there is a need, but they should not be deviated from, is basically the idea of having a convention. So consistency convention basically means that the same accounting principles should be used for preparing financial statements year after year. One should maintain consistency because it allows for comparison, which helps in the comparability of different accounting statements. As we had studied, all financial informations need comparability so that decision making as well as cost cutting is possible over the long run. So there are different types of consistencies. First is vertical consistency, wherein price of one asset within the organization should be same across different books of account. For example, if my machinery is 6.5 lakhs, then it has to be the same in cash book, it has to be the same in my journal and in my balance sheet. It cannot be that I say I paid 7 lakhs in the cash book and then I record only 5 lakhs worth of machinery in the final balance sheet. It has to be the same for every organization. Remember, if another company buys the same machinery for 10 lakh rupees, then this does not affect my position if I bought it for 6.5 lakhs. I am only concerned with one business entity, that is the business entity rule, the business entity concept that we discussed. The second consistency is horizontal consistency, that the same accounting books should be maintained over multiple years. So if a business is maintaining cash book, journal, balance sheet, trial balance, etc., all of these have to be for multiple years. This will ensure comparability across time. The third is more of a convention. It is not directly a concept that is mandatory. It is the dimension consistency, that similar trading organizations should have similar accounts. So if a rice mill, for example, has a mill machine for 20 lakhs, another same size rice mill should not ideally have one milling machine for 20 crore. Understand? Because that might mean there is a fraud, there is a lack of fairness. So overall, across the industry, if all entities have the same prices, we can generally come to terms on what is the standard industry practice in a particular industry. This is applicable for all industries, be it trading, be it airlines, or any other industry, the same principles are followed. Understood? We move on to the next slide. This is the 11th concept. Sorry for the numbering. The materiality concept, that only material facts which are important as well as relevant information should be supplied to the users of accounting information. The materiality of a fact depends upon its nature as well as the amount involved. So, any fact would be considered material if it is reasonably believed that its knowledge would influence the decision of informed users of financial statement. For example, money spent on food, as we had discussed earlier, money spent on food for employees can be recorded. It is not relevant what the food was which was eaten. If you spend rupees 1000 every day consistently for 10 employees lunch, then that is not a problem. However, if one fine day you spend 1 lakh rupees on a single day for the same 10 employees, then you have to specifically record. Why? Because it's not just the nature but also the amount which is involved. So if you are using a very high amount, then it is better that you record whole transaction. This makes your entire books more fair. Whenever I say books, please understand it is obvious that I only mean books of accounts. This is not fiction or non-fiction books that I am talking about. So, for the fairness, for reliability, for relevance, we will have to work on the materiality concept. This is also a convention. Okay. Now we move on to the last of all. This is the prudence principle or the conservatism concept. The prudence principle basically says anticipate no profit but provide for all possible losses. Anyone might say this is a horrible way to do business. This is very pessimistic in nature. This is against all hope, because you are suddenly anticipating that you will never make profit but you will provide for all losses. If I am only going to make losses, then why be in business? I am in business to make profit. I am not in business to make losses. The point is that only through this idea of prudence can we ultimately maintain fair accounts. You make provisions for losses so that in case there is a loss, you have that covered for. Obviously there is going to be a profit. It is always good that there is a profit, and when the profit happens, your balance sheet will grow over the course of many years. If you show consistent profit, this will anyway improve credit worthiness. But in case if you don't make provisions, then whenever there is a loss, you will be caught off guard. That is not something that any business wants to afford. As a consequence, we provision for all losses and we anticipate no profit. This keeps us grounded in reality. There is a poem by हरिवंश राय बच्चन. उसमें एक लाइन आती है कि स्वप्न पर ही मुग्ध मत हो, सत्य का भी ज्ञान कर ले. That ultimately, please be grounded in reality that there is a possibility of losses also. So be grounded and ensure that if there are profits, you can be happy later on, but the business has to anticipate. So we make different provisions for losses, be it provisions for NPA, provision for depreciation, provisions for fire, etc. We keep certain provisions. This allows us to balance our losses over multiple years instead of one single year. For example, banks make provisions for non-performing assets. They don't account for early payment of loan because of the conservatism or the prudence principle. This is basically the 12th set of accounting concepts that we have studied. So with this, we come to the end of the theory part of today's class. After this, we will discuss the various PYQs, previous year questions that have come in the last two EPFO exams. So today we discussed the definition of accounting, that it is the act of identifying, measuring and recording or communicating any financial information. We discussed different forms of accounting, be it financial accounting, cost accounting or management accounting. We discussed different accounting standards, the generally accepted accounting principles, the international financial reporting standards, as well as the establishment of the National Financial Reporting Authority, the NFRA, by India for setting up accounting standards for Indian companies. We also discussed what are the key features of any books of accounts. They have to be reliable, they have to be relevant, they have to be understandable, and they have to be comparable over time. We also discussed that there are different accounting concepts, these 12 accounting concepts that we discussed. So these are basically the crux of what today's class consisted of. Please have a look at the basic accounting concepts, the business entity concept, that all businesses have to be treated as a separate entity from their owners. The owners are not the business and the business is not an owner. The owner's investment is only a liability for the business. The second is the money measurement principle, that any information or transaction which does not have economic value will not be recorded in the books of account. Hiring of a very productive manager, entering of a new competitor in the market, loss of productivity of employees, all of this will not be recorded, whereas anything which has transactional value will be recorded in the books of account. The third was the going concern principle, that the business will continue to go on for the foreseeable future. It will not end. The fourth was the accounting period concept, that books of accounts have to be maintained for relevant periods of time at regular intervals. So be it quarterly, be it half yearly, be it annually, but books of accounts have to be made at regular intervals and not upon the whims and fancy of the accountant. The fourth was the cost principle, that the cost concept says that whatever cost you purchased an asset for, that cost has to be recognized. The sixth was the dual aspect principle or the duality concept, which says that every transaction has one debit side and one credit side. Then we come to the matching concept, that both the sides have to match, the debit and the credit have to be equal to each other ultimately. And then we come to certain conventions, which were the full disclosure convention, the consistency concept, the conservatism or the prudence concept, the revenue realization concept, and the materiality concept. The full disclosure concept says that fair value has been recorded. Consistency says that same accounts have to be maintained. Conservatism says all losses to be recorded, provisioned, and no profits to be anticipated. The revenue recognition principle says that whenever revenue is realized, not when the payment is received, then you will record it. And the materiality principle says that all important transactions have to be recorded. So these were the 12 accounting concepts that we discussed today. Now we will move on to the previous year questions. All right. So we discussed the first PYQ. What is the underlying accounting concept that supports no anticipation of profits but provision for all possible losses? Please take a guess. Okay, so as we discussed, it is the conservatism or the prudence principle. Prudent person, as we know, is someone who applies modesty, who does not take too much risk. And conservatism, a conservative person is also someone who is not very radical in their mindset, who go very slow, who ensure that they account for all the bad things. So this is what the conservatism concept is about, and this is the correct answer. Moving on to the next PYQ. So which one of the following accounting concepts is applied by an entity when events such as new competitor entering the market or rift between production and marketing departments are not disclosed in books of accounts? तो अगर कोई नया कॉम्पिटिटर एंटर कर गया या फिर प्रोडक्शन और मार्केटिंग डिपार्टमेंट के बीच में लड़ाई हो गई, झगड़ा हो गया, दे डोंट अग्री ऑन द सेम प्राइस, ये सब हम लोग बुक्स ऑफ अकाउंट्स में नहीं रिकॉर्ड करते हैं. वाई इज़ दैट? बिकॉज ऑफ विच प्रिंसिपल we had discussed? This is because of the money measurement principle. All right, moving on to the next previous year question. In case of gold, revenue is recognized in the accounting period in which the gold is the answer is mined. Why? Because the asset becomes realizable when gold is mined. This is a very specific concept from mining, that when the asset is mined, it is realized. The asset is sold at a later date. The same is existing for crops also and for other entities also, that when the asset comes into existence, it becomes realized. Okay. Now we come to the next PYQ. This is the last PYQ for the day. In context of accounting, the term IFRS stands for A. International Financial Reporting Standards, B. Indian Financial Reporting Standards, C. Indian Financial Reporting System, or D. Indian International Financial Reporting System. We had discussed in this class that IFRS stands for International Financial Reporting Standards. So the answer is A. Okay, so with this we come to the end of the first class. We will be discussing accounting principles and the basics of account books, financial statements such as trial balance, balance sheet, etc. over the course of the next two classes. Alright, have a good day. Hello everyone, Welcome to the second class for General Accounting Principles for EPFO. In this class, we will discuss the rules of debit and credit. Okay, so let us begin with the basics. Firstly, let us recall from last class what we learned, that there is a dual nature or a duality concept in accountancy which helps in double entry bookkeeping. That every transaction has a give and a take. For example, buying a computer for rupees 40,000 for cash. In this case, I give cash of rupees 40,000 and I take computer of rupees 40,000. Okay. Debit literally means left side. Credit means the right side. That is all that the origin of these terms provides for. Okay. When we talk about rules of debit and credit, these are very fundamental to the entire maintenance of books of accounts. Okay. Because all accounting has a debit side and a credit side which is equal ultimately. So let us take this very example of buying a computer for rupees 40,000. I have purchased an asset, a computer, and I have given cash. Since the value of the computer is through the cash I have paid for 40,000, I will take the value of the computer as 40,000. Okay. Even if to the shopkeeper it could have been for 25,000, that is not my concern. If I purchased it for 40,000, I will record it as 40,000. There is evidence of transactions through different books such as cash memo, invoice, sales, pay-in slip, check, salary slip, etc. These evidence of transactions, these evidence help auditors as well as accountants and tax authorities to judge whether the accounting statements are true, because accounting statements need to be reliable. We discussed in the previous class. Therefore, evidence of transactions is necessary. This also brings trust in the business that we are doing. Cash memo is for cash sales, invoice is for any other form of sales, sales bill or pay-in slip, check, etc. are generally evidence of payments which have been made. Alright. So this is the dual nature of every transaction, that we give something and we take something in a transaction, and ultimately these define whether something is to be debited or to be credited. Okay. Just what we discussed, the buying of the computer for 40,000. How does it give the value of the computer to be 40,000? There are four types of cost. Okay. First is the original cost, which is the cost of an item at the time of purchase or creation. The original cost includes all costs associated with purchase and putting it into use, including commissions, transportation, appraisals, installation. So wages on installation of machinery, for example, is also included in the wages on installation of machinery is included in the original cost. Original cost is a topic of accountancy. Next we come to opportunity cost. It is the profit lost when one alternative is selected over another alternative. If I buy a fast computer for rupees 40,000 instead of a slower computer which was available for 30,000. Then I have taken the additional speed to be of quantifiable value in the profit lost when one alternative is selected over another. So this was my opportunity cost, a slow computer of rupees 30,000. Opportunity cost is a concept of economics. It is not a concept of accountancy but of economics. Third is replacement cost. It is the price that an entity would pay to replace an existing asset at current market price with similar asset. Suppose I purchased one machine for rupees 10,000. I purchased it 3 years ago. Today it is worth 28,000 in the market and I have to replace it even because it's defunct before its time. Now replacement cost is the cost of replacing the asset. It is the entire 28,000. This is normally a principle in insurance. This is not. I am sorry, there was some technical error, so the text has been replaced. We were discussing that original cost is a concept of accountancy. Opportunity cost is a concept of economics. Replacement cost is a concept of insurance. Whereas cash cost is the recognition of expenses as they are paid in cash. This is also a concept of accountancy. However, there are two bases of accounting, the cash basis of accounting and the accrual basis of accounting. We will discuss them. And we need to be mindful that only the accrual basis, which is the original cost, can be taken into account. I will just discuss this briefly. There are two bases of accounting. The cash basis, in this accounting entries are recorded only when cash is received or paid. So for example, I sell goods on 20th March 2023 and payment is received on 5th of April 2023. Now this belongs to financial year 22-23 and this belongs to 23-24. In the cash basis of accounting, I will record the sale in this year, whereas in the accrual basis, revenues and costs are recognized in the period in which they occur rather than when they are paid. So, if I am making the sale in FY 22-23, I will recognize the sale then only and I will recognize it as a debtor. Debtor who owes me money, who might pay me next year. Understood? So revenue and expense are taken into consideration in accrual basis for the purpose of income determination on the basis of accounting period which they relate. In India, the Companies Act 1956 recognizes accrual basis of accounting only. We discussed in the previous class that the National Financial Reporting Authority has been created under the Companies Act 2013 to lay down accounting standards. They also follow the accrual basis of accounting, not the cash basis of accounting. Okay, so only the cash cost is also a term. This is accountancy, this is economics, this is insurance, this is also accountancy, but we have to be careful. This is only going to confuse people when a question comes. Okay. Let us discuss some basic terms for accounting. First is a business entity. We will use these terms a lot of times when we discuss the rules of accounting today. Okay, the most of these terms will come over many times in the course of this entire chapter, in this lesson as well as in multiple other lessons. So I will give the glossary of terms for every term, for every lesson, but also please keep in mind the glossary of lessons terms from previous lessons in the coming classes. Okay, so first is the business entity. A business entity is a specific identifiable business enterprise. For example, Big Bazaar. This is based on the business entity concept, that we are accounting from the point of view of the business, not from an individual. Alright, please recall the example that I gave of buying a computer for 40,000. You do not have to think of it if from the point of view of the shopkeeper. If I specifically tell you that I am buying, however, if it says, if the question says sales of computer, then think of it as we are the business selling computers. Okay, we are only going to record transactions from the point of view of business, not owners, not banks or investors, but the business itself. Second is transaction. Transaction is exchange of some value between two or more entities. It can be cash transaction or a credit transaction. Both are allowed in the accrual basis. The value is the original cost. It has to come from money measurement principle that we discussed. Third is capital. Capital is the amount invested by the owner in a firm. Fourth is sundry creditors. Sundry means miscellaneous. Sundry creditors are basically current liabilities, creditors who we have to pay within 1 year or around 1 year, a little more than 1 year at times. Persons who have to be paid by an enterprise for providing goods and services on credit. Banks are not sundry creditors. Not sundry creditors. If they are giving you loans for money, they are not sundry creditors. Sundry creditors are vendors. For example, suppliers of raw material for my business. Those will be sundry creditors. Similarly, there is a concept of sundry debtors. Persons who are to pay for goods or services rendered for contractual services by us. So if I sell to someone else and I don't take the payment immediately, I tell them pay me after 15 days, then this will be a sundry debtor for me. The next term is drawings. Drawings is the amount of money or value which the proprietor takes away from the business for household or private use. So we will be dealing with sole proprietorships for the time being. In later classes, we will discuss accounting for companies, partnerships, and not-for-profit organizations. There was an error once again. Anyway, so we will be discussing with other forms such as partnerships, companies, and not-for-profit organizations in later classes. At present, we will only be dealing with sole proprietorships. Therefore, drawings are possible for a sole proprietor. They can withdraw as much money as they want from the business. There is no legal difference between the sole proprietor and the business. However, there is a difference for us as we are accounting for it because of the business entity concept. The two major terms that we will come across in today's class are assets. Assets are tangible objects or intangible rights owned by the enterprise. And liabilities. Liabilities are obligations or debt that an enterprise has to pay at some time in the future. Okay. This is what a balance sheet normally looks like. There is one asset side and there is one liability side. So asset side provides for how much the company owns, and liabilities provide for who owns how much of the company. So this is how a business is run, and both of them are equal ultimately. Okay. So let us begin with the rules of debit and credit. This is the format of an account. A format account looks like a T, the English letter T. This is where the account's title is put. For example, machinery account or loan account, etc. Every account has one title, and all entries for the debit and the credit side are mentioned in the same account. Okay. We will discuss books of accounts in the next class. Then there will be more clarity. But we need to first understand what the two sides of debit and credit are going to look like. This account can be for any purpose: machinery, goods, debtors, etc. And all transactions pertaining to one account should be maintained together. For example, if I have a machinery account, then it will have a balance such as to cash rupees 10 lakh if the machinery is worth rupees 10 lakh, and if I sell the machinery, then it will have buy cash, say I sell it for 6 lakh, and buy loss on sale 4 lakh. Okay. So this way a machine which has it could be for many years. So machine was worth 10 lakh, it was sold for cash of 10 lakh and loss of 4 lakh, which also adds up to 10 lakh rupees. This makes the account always balanced. The entries, the rules of debit and credit in this case for buying would have been machinery 10 lakh to cash 10 lakh. I will explain why. And when we sell it, it will be cash 6 lakh, loss on sale 4 lakh, to machinery 10 lakh. Okay. Please keep this one example in mind, that we took one machinery for 10 lakh and then we sold it for 6 lakhs and a loss of 4 lakh. We will use this example throughout to look at how assets and liabilities change and how rules of debit and credit apply to these. There are two types of accounting approaches. First is the modern approach. The other is the traditional approach. The modern approach is easier, so I am explaining the modern approach first. We will discuss both approaches in this in this class. So all accounts are divided into 5 categories in the modern approach for the purpose of recording of business transactions. The modern approach is American. This started in the 20th century, mostly in the 20th century accounting, and the traditional approach we will discuss has been in Europe for many centuries. In the first class, you might remember I told you of Luca di Borgo, who published the first book on double entry bookkeeping in the 15th century. So the traditional approach has been going on since then anyway. So there are 5 categories of accounts in the modern approach: assets, liabilities, capital, expenses or losses, and revenues or gains. Okay, these are the 5 categories of accounts on which the rules of debit and credit apply in the modern approach. So let's look at the rules of debit and credit now. The first rule is for recording changes in assets, expenses and losses. Remember, there are 5 categories: assets, liabilities, capital, expenses and losses, and revenues and gains. So for category 1 and category 4, this is applicable. Increase in asset is debited, decrease in asset is credited. Increase in expense loss is debited, decrease in expense loss is credited. Okay. Now let us discuss the transactions that we had made in the first slide, that we purchased machinery for 10 lakh rupees. We purchased a machinery. Machinery is an asset. So machinery debited rupees 10 lakh to cash credited rupees 10 lakh. Alright, machinery is an asset, it is increasing. Cash is an asset, is decreasing. Asset increase debit, asset decrease credit. Similarly, if we have to now discuss the second entry that we made, that we sold machinery later on at 6 lakhs for a loss of rupees 4 lakhs. Okay, because the machinery was worth 10 lakh rupees. So we receive cash rupees 6 lakh, increase in asset is debited, loss on sale 4 lakh, loss on sale of machinery debited 4 lakh to machinery credited rupees 10 lakh. Okay. An increase in expense or losses is debited. Loss on sale of machinery debited because it was 4. This is a loss. Decrease in asset is credited. Machinery is being sold, so it is being decreased from our balance sheet. We have credited it, okay, by the same amount. So this entry will look like cash loss on sale of machinery to machinery (6 lakh 4 lakh and 10 lakh. These are debited, these are credited. Please understand, the short form for debit is DR and we make 3 dots normally, and the short form for credited is CR. So normally whenever we make an entry, it is ABC DR to XYZ CR, and then we put the amounts. This is the debit side is slightly to the left because this is how an accounting entry will look like. Okay, that the debit is slightly to the left of the credit entry. This is how a journal is maintained. I will explain how a journal is maintained in proper detail in the next class. Okay, a journal cannot be maintained prior to the understanding of rules of debit and credit. That is why we are understanding these first. Once again, I will give you a caution. Payment such as wages are ordinarily expenses, but for the installation expense, they are included in the asset cost. For example, wages on installation of machinery or furniture, they are included in the asset cost. So let us try one example. I pay salary, paid salary to employee rupees 20,000 in cash. How will you make this entry? Take 30 seconds. It's a very simple entry. Okay. So the answer is salary debited 20,000 to cash account credited 20,000. Okay. Why? Because salary is an expense. So whenever it's increasing, we debit it. Cash is an asset. Whenever it is decreasing, we credit it. There might be some doubt in people that why does our bank say that rupees 20,000 have been credited to your account? You might have received such statements from the bank. That is because you are bank's liability. You are a bank's creditor. Please understand, they are accounting for themselves. They are not accounting for you. So therefore, you are a liability to them and they are increasing their liability by adding 20,000 to your account. That is why they say 20,000 credited to your account. When a business says 20,000 of cash is credited, that is reduction of cash from their assets. Alright. Moving on to the next rule. I hope this first rule is clear. Rule number 2. Increase in liabilities is credited, decrease in liabilities is debited. Similarly, increase in capital is credited, decrease in capital is debited. increase in revenue or gains is credited, decrease in revenue or gains is debited. Alright. So these are entries 2, 3 and 5 in the list that we showed, the 5 categories of account in the modern approach. These are the entries 2, 3 and 5. Any increase in all of these is credited and decrease is debited. Let us discuss one example, that we take a loan of rupees 10 lakh rupees. Okay. We take a loan for cash. How will you make this entry? We take a loan of rupees 10 lakh rupees for cash. Please make the entry. Please pause this video if you want to, if you need more time. I am giving you 20 seconds. Okay. This was a light question only. I hope everyone was able to get this correctly. The correct entry is cash debited 10 lakh to loan credited 10 lakh. Alright. Why? Because asset cash is increasing, so we debit it. Liability, which is loan, is increasing. Increase in liabilities is credited, so we credit it. Alright. Now suppose we make another entry that we have to repay this very loan. The loan is for 10 lakh, interest rate is 10% per annum. After 1 year, we pay 1 lakh of interest along with the loan. Okay. So, loan 10 lakh repaid, interest 1 lakh also paid in cash. How will you make this entry? Take 20 seconds. Okay. So in this case, the entry is going to be loan account debited 10 lakh, interest paid debited 1 lakh, to cash 11 lakh. A decrease in liability is debited. Since we are paying off the loan is decreasing our liability, so we have debited it. Cash is an asset which is going down, so we are crediting it. Interest paid is an expense. It is a business expense. Therefore, an increase in expense is being debited. Alright. Let us take one last entry before we move on to the traditional approach after this. The next is the traditional approach. Let us take one last entry. Suppose the machinery that we purchased for 10 lakh rupees was purchased on loan at 10% per annum. How will you make this entry? Take 20 seconds. This was a tricky entry, at least for the first time. The first entry is going to be machinery account debited rupees 10 lakh to loan account credited rupees 10 lakh. Alright, why? Our liability is increasing, a loan is increasing, so we credit, increase in liability is credited. Machinery, which is an asset, is increasing, so we debit it. Now suppose we sell this machinery for rupees 14 lakhs. This machinery is now sold for 14 lakhs. Alright, how will you make an entry? I am erasing the journal entry at the bottom. Please look at it if you want to. I am now erasing it. For selling of the machinery at rupees 14 lakhs, the entry is going to be, let's say this was sold for cash, cash debited 14 lakhs to machinery 10 lakhs to profit on sale of machinery 4 lakhs. Alright. Cash is an asset, is increasing, debited. Machinery is an asset which is decreasing, so we credit it. Profit on sale is an increase in the revenue or gains. If we are increasing it, it is credited. Therefore, it is also credited. At all times, the journal entries will equal up and they will tally. Alright, I hope this is clear. We move on to the traditional approach. There are three types of accounts in the traditional approach: the personal account, the real account, and the nominal account. Alright, this is the European model that was followed across time for multiple centuries earlier. So, personal account consists of natural persons such as Mr. ABC, Miss Suman, basically any debtor or creditor who we personally owe money to is a person, is a personal account. Same goes for artificial persons, companies, trust, firms, etc. These are also artificial persons, they are also personal accounts. Third is a representative person. I will explain this concept in the course, but any form of prepaid expense, outstanding rent, brokerage, while they are not naming a person, they are owed to a person. So if it is owed as a debt or credit to someone, they are a personal representative personal account. Okay, we will discuss all of these separately. Second is a real account. A real account is anything on the asset side. So any tangible asset such as machinery, plant or goods, or any intangible assets such as goodwill, patent, etc. All of these are mentioned in the real account. Alright. These are only on the asset side. There is nothing of this kind on the liability side. Alright. Third is the nominal account. Nominal account includes all incomes and gains such as sales, profits, etc. Expenses or losses such as rent, salary, wages, electricity paid. The third form is called branch account. Branch accounting we will discuss in a future class very briefly. Alright. So let us move on. The rules of debit and credit for personal account is that for any natural person, artificial person or representative person, we debit the receiver, credit the giver. Alright. If we prefix or suffix any of these outstanding, prepaid to a nominal account, then it becomes a personal account. For example, rent is a nominal account. Outstanding rent is a personal account. Why is that so? I will just go back and explain once actually. Nominal accounts are not carried on to the balance sheet. They are closed at the end of every year. So the balance sheet does not tell you how much income you made, what was the expense or loss, etc. Okay. They are closed at the end of every year. On the other hand, personal account as well as real account, both of them are mentioned in the balance sheet. Any person who owes you money is mentioned on the asset side. All real assets that you have are mentioned on the asset side. On the liability side, whoever you owe money to, such as your lenders, banks, or the owner, these are mentioned. So all personal accounts and real accounts are mentioned in the balance sheet. Nominal accounts are not mentioned in the balance sheet. If we owe outstanding debt such as rent or outstanding salary to someone, then that is a liability for the business. So therefore this will be mentioned in the balance sheet. If we have prepaid rent, for example, then that will be something that is an asset we can claim later on in the future. So this will be prepaid, will also be included in the balance sheet. Understood? We will discuss this properly, but I just wanted to give a brief background on why representative personal accounts are different from nominal accounts. So the rule is debit the receiver, credit the giver. Suppose I am giving you a practice question. Suppose I buy goods worth rupees 30,000 from Mr. X. How will I mention this? Please take 20 seconds to answer. Okay, so if we purchased goods from Mr. X then the entry is going to be, if we purchase them on credit, purchases, we normally don't say goods, we say purchases. But if you wrote goods, that's also correct. Don't feel bad about it. Purchases account debit to Mr. X, 30,000 credit. Why? Credit the giver. Mr. X has given us goods. So therefore, assets have increased, goods have increased by 30,000. So we debit, and Mr. X, the giver, has increased. So therefore, rupees 30,000. Let us take a more complex example. Mr. X owes us money, 500 rupees. Mr. Y, we have to pay Mr. Y 500 rupees. Mr. X pays Mr. Y. X pays Y. Take 30 seconds. Think about this entry. X pays Y on our behalf. Alright? Please understand. The entry is going to be Y debited 500 to X, credit 500. Okay. Why? Debit the receiver. Y has received, so we debit. Credit the giver. X has paid on behalf of us to Y. They have given. Whoever they give to, if that has an impact on our liabilities, we see and we credit them. Okay. Originally, X was a debtor, so X had a debit balance. By crediting X with 500 rupees, we have balanced out X. By paying Y, we have balanced out Y. An even more complex example, if you want, let us try. Or let's just take this question for the time being, that suppose we owe Y rupees 1000. X pays Y on our behalf rupees 500. We sell 300, we sell 500 rupees worth of goods to Y after this. Okay, rupees 500 goods to Y. Now think about this entry. We will discuss it later on. Now we come to the next rule of debit and credit. For real account have two forms. One is tangible real account, such as machinery, plant, furniture, as well as intangible real account, such as patent, goodwill. They are carried forward to the balance sheet and they continue. They are not closed at the end of every year. The rule for real account is debit what comes in, credit what goes out. Alright, so if we buy furniture, then we debit furniture, say for 5,000 rupees to cash, credit 5,000 rupees. Alright, furniture coming in, debited, cash going out, credited. Debit what comes in, credit what goes out. What is goodwill? I'll just briefly explain. There are some assets such as intellectual property rights which have monetary value. If I have a CA license or a lawyer license, I cannot sell my license, that is a personal license. But if I have a patent, say for a solar power plant, then I can sell it to someone else who can make it on my behalf. That patent will have value. Say I sell it for rupees 10 lakh rupees. Then whoever buys it for 10 lakh rupees can show patent debited 10 lakh to cash or to whatever. So this will become an asset in their books of account. Based on the cost concept, we will use the original cost paid. Okay. Moving on to the next third rule, after which we will discuss some questions. The third rule is the rule for nominal accounts for all incomes, expenses, as well as branch accounting. Branch accounting we will discuss later on briefly. At present, just understand that branch accounting is also a nominal account. The rule is debit all expenses and losses, credit all incomes and gains. Okay. Now, these are temporary accounts. If we make sales worth of rupees 500, what will be the entry? Sales of rupees 500. Please take 20 seconds. So the entry will be cash debited 500 to sales credit 500. Okay. Debit all expenses and losses, credit all incomes and gains. Sales is an income, so we credit it. Cash is an asset, it is coming in, so we debit it. Okay. Now let us come to the question that I had given you, that Y had given us loan of rupees 1000, X paid Y rupees 500, and we sold goods to Y rupees 500. Therefore, we need to make an entry. Please. Okay, this is a tough question. Take 1 minute. Okay, so let us discuss the answer for this. X has paid Y on our behalf. So therefore X is a previous debtor for us. Credit the giver. So we have X which will be credit, sales which will be credit, Y which will be debited. Alright. So Y debited 1000, sales 500, X 500. Do you understand why? We debit the receiver. Y has received from us rupees 1000. Credit the giver. X has given. So we give 500. And we credit all incomes and gains rupees 500. So this is the entry. Let us discuss one more question so that there is more clarity. Suppose what will we have outstanding rent for 1 month. What will be the entry? Think about it. Take 10 seconds. I am going to give out the answer quickly because I am not sure if most people will guess this. Okay, so the answer is going to be rent debited to outstanding rent. Great. Why? Rent is an expense. We debit all expenses. Outstanding rent is a personal account. They are ultimately giving the opportunity for a loan to some extent. Therefore, anyone who is on the outstanding rent side will be a credit balance. Okay, it's a personal account. You have to think of it as a personal account. I hope these are clear. Let's recap quickly. For personal account, the rule is debit the receiver, credit the giver. For real account, the rule is debit what comes in, credit what goes out. And for nominal account, the rule is all expenses and losses to be debited, all incomes and gains to be credited. Okay. Let's discuss some previous year questions. First, as per the traditional approach, the expense to be matched with revenue is based on A. Original cost, B. Opportunity cost, C. Replacement cost, and D. Cash cost. We had discussed in the traditional approach, the expense is matched with the original cost, not with any of the other costs that we have mentioned. This is for accountancy. This is for economics. Opportunity cost. Replacement cost is for insurance. Cash cost is to confuse you. Alright. Coming to the next question. Income and expenditure account is A. Real account, B. Personal account, C. Nominal account, and D. Capital account. We had discussed very recently only that income and expenditure accounts are nominal accounts. Alright. Next question. Wages paid for installation of machinery is debited to which of the following accounts? A. Wages account, B. Machinery account, C. Installation account, and the profit and loss account. I had recounted in multiple slides that wages paid for installation will add to the asset cost. Therefore, this will be in the machinery account. Any wages which are paid for repair works etc. will not be added to asset cost, but for installation they will be added. So please keep that in mind. Okay. Let's do some quick practice questions. First, an increase in which of the following shall be recorded on the debit side? A. Profit, B. Sales, C. Salary, and D. Windfall gains. Please pause if you want to think of the answer. I am going to give the answer in 5 seconds. The answer is C. Salary. Why? Because profit is an income, sales is an income, and windfall gains are an income for a business. Salary is an expense for the business. Understand, you are only thinking of it as a business entity. You cannot account from the view of employee, only the employer. So salary is an expense for the business. Okay, moving on to the last question. Which of the following rules of accounting is incorrect? A. Debit all expenses. B. Credit what comes in. C. Credit increase in liabilities. Or D. Debit the receiver. Once again, I am giving you 10 seconds. Please pause if you want to think more. The answer is B. Credit what comes in. We had discussed the rule is debit what comes in, credit what goes out. Okay, I hope this was helpful. We will discuss books of accounts in the next class. Thank you. Hello everyone. Welcome to the third class for General Accounting Principles, which is the first chapter of the EPFO course. So in this class, we will discuss the various books of accounts. In the previous 2 classes, we have discussed what are books of accounts and what are the different rules of debit and credit which apply to the different books of accounts. In this class, we will finally move to various classes of account books which are used for double entry bookkeeping, such as journal, ledger, cash book, trial balance, as well as balance sheet ultimately. There are some other accounts which are more complex in nature, which we will discuss over the course of the next class. This is the first of the 2 classes for books of accounts. Okay, let us begin. So here we begin with the different kinds of books of accounts. The first one is a voucher. Voucher in itself is not a book of account. It is only an evidence. A voucher is a documentary evidence in support of a transaction. So whenever we are supposed to record any transaction on a ledger or ultimately in any account, as we had discussed in the last class, that any account is a T-shaped account finally. So there are entries here and amounts here. Alright. So a voucher provides for the evidence for whatever entries we make either here or here. If I say, for example, I purchase a computer for rupees 40,000. We had discussed it in the last class for cash. 40,000. Then I will have a cash memo as a voucher for the purpose of showing to an auditor ultimately. These vouchers help in establishing the veracity. Veracity means truth of the financial statements that we submit. This helps the tax authorities, the auditors, as well as any other information user for any financial statement to ensure that what we are saying is correct. So there can be both cash vouchers such as cash memo and non-cash vouchers such as purchase order, receipts, etc. Okay. The next book of account is the journal. The word journal itself means daily entry. It starts from the French word jour, J-O-U-R, which means day. So journal is a book of daily entry. It is the first book in which any entry is recorded. Journal is a book of account in which all day-to-day business transactions are recorded in a chronological order. So, what are the two key features? One, all day-to-day transactions, all transactions basically. Second is chronological order. Because it is a daily book, all transactions are maintained as per the date. We will discuss over the next slides how a journal looks like. I will show you, but at present it is important to note these two features: all day-to-day transactions in a chronological manner. This is why the journal is the first book where any transaction is recorded. You might have seen there are shopkeeper registers at any grocery shop or anywhere that you visit, and they keep making entries to what was sold in those registers. This is to ensure that there is proper timely record of a journal entry. Any transaction that is recorded in a journal is called a journal entry. Every single transaction is a journal entry. Okay. So if I take a loan of rupees 10,000, loan debited rupees 10,000 to cash 10,000, that is one journal entry. When I pay back the loan, this was the entry for the paying back of the loan. Taking the loan is cash to loan. So both of these are separate journal entries. The loan account will have a separate account column in the next book that we will discuss, but two different entries, even if they are on the same date, on the same subject, will be two separate journal entries. Alright. Now we come to the next book, which is the ledger. Ledger is the principal book of the accounting system. It is the main book where all different accounts, where transactions relating to an account happen, are recorded. Okay. So inside a ledger there are multiple accounts. It is one book which has records of different accounts such as machinery account, furniture account, loan account, etc. And all transactions which are made in that account are kept there. So for example, in the loan account, it starts with cash loan of rupees 10,000. Remember, this is the credit side, this is the debit side, this is not the asset side, this is not a balance sheet, this is an account. And 2 days later, the loan is paid off. Even then, this account will have two separate entries. This will be within the same account, unlike the journal where the taking will be on one date and the paying off will be on another date. Okay, so the ledger has all different accounts where different transactions are maintained. The next major book of account is the cash book. Cash book is the book in which all transactions relating to cash payments, cash receipts as well as cash payments are recorded. So this is the main book of account for any trading enterprise normally. Most companies do not have very extensive cash books at times because they may be dealing with routine revenues. They may not be dealing with sporadic revenues like trading concerns are. However, a cash book is a fundamental book of account anyway for all. Some might find it very crucial in their day-to-day operation. Some might find it crucial only for their weekly operations, but it is crucial for all ultimately. Here, all transactions which have one side cash are recorded. Okay. For example, if I say I took a loan for rupees 10,000, in the cash book I will say loan rupees 10,000. Remember, on the loan account it was on the credit side. In the cash account it is on the debit side because cash has been debited to loan. On the other hand, if we were to pay off that loan, then on the loan account, this would be loan account to cash. Understood? Anyway, moving on to the next list of book of accounts. I will separately give you examples as well as pictures of these different account books so that it's easier to understand. The next list of book of accounts discusses various statements which are meant for preparation of the final accounts. Okay, the final accounts. The first one is the bank reconciliation statement. The bank reconciliation statement is prepared to reconcile the difference between balances as per the bank column of cash book and passbook on any given date. So there happens sometimes a moment when the cash book says that you are supposed to have a debit balance of 1,100,000 rupees, whereas the bank passbook says you have 99,900 rupees only. So there is a difference of 200 rupees in this case between the cash book and the bank passbook. This is normally not supposed to happen because of the matching concept as well as the duality concept, that everything has two sides, so they should match. If my cash book says that my bank balance is 1,100,000 rupees, then why does my bank passbook say that my balance is 99,900 rupees? The answer is very simple. There are times when there is human error. So it is because of the human errors sometimes that we are unable to record transactions correctly. The other reason is that at times some transactions are not recorded in a timely manner. So, to rectify these errors, we prepare a bank reconciliation statement. This is only prepared if the balances in the cash book and the bank passbook do not match. This we will discuss in this class only later on. The next book of account is the trial balance. The trial balance is a statement showing the balances or total of debits and credits of all the accounts in the ledger with the aim to verify accuracy of ledger accounts. It shows the financial position of all accounts and helps in preparing final statements. It is a statement containing the various ledger balances of an entity on a particular date. This is normally prepared on the end of the year, but this is not mandatory. You can prepare it on any particular date. Okay. For many public companies, quarterly as well as half yearly is needed. So therefore, they have to prepare it more frequently than other trading companies or single person companies, etc. The trial balance is not a formal book of account, not formal. The tax authorities or investors, they do not care what the trial balance shows. The trial balance is important for the accounting department. Why? Because they can verify the accuracy of the ledger account, and this shows the final position of all accounts ultimately. So auditors as well as accounting department can make use of this information. What happens in a trial balance is that different balances from the account books of the ledger are taken. The final closing balances, as they are called, as they stand at the end of the date, they are taken into one single column and finally put together. So an entire list of all debits and all credits is taken up. Finally, the balance is supposed to match. Okay. Why? Because debit is always equal to credit. If whatever you are debiting has an equal credit entry, then it's supposed to match. This does not mean that your financial statement will be correct, but if it is not matching, then it is certain that there is something incorrect. So at times the trial balance does not match. This happens frequently if there are accounting errors at times, and it is a common practice to rectify these errors after making the trial balance. We will discuss trial balance in proper detail. The next most important for people who are practicing accountancy is this book of account called the balance sheet. The balance sheet is the kacha chitta of a company. It shows all the assets of a company, all the liabilities. It normally also has how much profit did a company make or how much loss, as well as how much assets and who owns those assets. This is what a balance sheet ultimately show. Why have I put profit on the liability side and assets on the loss on the asset side? Can anyone take a guess? Please try to think about it. I will give you 1 minute. Okay, so the real reason is because liabilities provides for who owns the business. So except for the owner, there is one the owner, and then other is the outside liability. These are the two forms of liabilities. When the company starts making profit, it is capable of financing itself. Therefore, there are many assets which are brought not from an outsider's, either the owner's or a lender's money, but from the company's own money. So, profit is also one of the liabilities for the company which it owes to itself. Therefore, profit is the company's own liability that I own myself. Similarly, on the other side, if liabilities are rupees 10 lakhs, 5 lakh for owner and 5 lakh for lender, and assets are rupees 8 lakhs because the company has suffered a loss of rupees 2 lakhs, then it is the ownership, it is the responsibility of the ownership to also take care or to bear the losses. So, this will stay on the books of accounts till ultimately the owner reduces their own capital. So, if there are assets worth rupees 8 lakhs, losses worth rupees 2 lakhs, and capital worth rupees 5 lakhs and loan worth rupees 5 lakhs, then someday you will have to write off your capital to compensate for the loss. Later on, it will be owner 3 lakh, loan 5 lakh, asset 8 lakh. The 2 lakh loan is cut off by 2 lakh of capital. Understood? So, this is how the balance sheet always ends up matching. There is no case except for making of an error in which case the balance sheet should not match. This is the core foundational principle of double entry bookkeeping, and this will always continue because this is based on direct logic and rationality itself. There is one more major book of account called the profit and loss statement, the profit and loss account, and another called the trading account. These we will discuss when we discuss how treatment of various entries are done, because at present I thought it is going to be a difficult concept to explain, because profit and loss and trading account both are nominal accounts that we anyway discussed in the last class, but they are very important financial statements otherwise. Anyway, moving on to the next set of list of book of accounts. These are the last set of books of accounts that we have to deal with. The first is the purchase journal or the purchase book. This book records only the credit purchase of goods in which the firm deals with. Credit purchase of goods. So, if I take a loan for purchasing machinery, machinery 10 lakh to loan 10 lakh, this will not be in the purchase journal or purchase book. Why? Because machinery is not goods. Goods means whatever the company or trading concern is normally buying and selling. So goods depend upon the industry. If someone is in the textile business, then sarees are a good for them, and mill is a machine for them. But if someone is in the mill industry, they sell mills, then mills are goods. If someone is selling handloom mills or power looms, then those are goods. So it depends upon the industry to decide what is goods. I hope this is clear. The purchase journal or the purchase book records only the credit purchases. Why only credit purchases? Because this is not the stock book. We have another account called the stock inventory account, the inventory account. The inventory account provides for all stock purchases, all goods purchases, be it credit or debit or cash. So therefore, this is only to ensure that credit purchases of goods are dealt with. Cash purchases of goods are put in the cash book. So on the purchases side, when goods are being purchased, the inventory account has the debit side, that inventory debited either to cash or to any personal account we discussed in the last class, or for any personal account. Okay. The next book is the sales journal or the sales book. The sales book provides for all credit sales of merchandise recorded in the sales journal. Okay. So whatever inventory we end up selling on credit, who do we sell on credit? To our debtors. So debtors are an asset for the firm. Remember the rule, debit the receiver. So therefore, if they are receiving goods on credit, then they are ultimately going to be debited. Debtor debited to sales. Sales is an income, so this will be credited. Okay. This is the general entry. So now we have covered what is the purchase book as well as the sales journal. There are times when we don't like what we buy, but we already have made an entry for buying it. Already made journal entry. Therefore, we also keep a purchases return book, a book in which return of merchandise purchased is recorded. Okay. So here we credit the inventory once again, that instead of selling it forward, we only returned. This ensures fair financial information is provided. This is better than not declaring at all that we received goods. If we have in fact received goods, it is much better to honestly announce that we have taken these goods and now we are returning them. Similarly, This is the case with the sales return book. This is also a special book in which returns of merchandise sold on credit are recorded. Just the same way as someone might not be happy if we are not happy with someone else's good, it is possible that someone might not be happy with our good. So this is also why we also keep a sales return book. We note that we have made some sales and then those were returned. The last book of account is the journal proper. This journal proper is to maintain or to record transactions which do not find place in any of the above special journals. So purchase journal, sales journal, any of the real accounts, nominal accounts. In the absence of any of these, if something doesn't fall, we put it in the journal proper. For example, loss from theft or fire, capital gains from sale of machinery, and not just these but other sundry expenses at times. All of these will be included in the journal proper. Okay. There are many other kinds of transactions which are also recorded in the journal proper. For example, advertisement expenditure. If I am not routinely advertising, I am not going to maintain an advertisement account in my ledger books. So I will only put it in the journal proper. If sometimes there is a repair on furniture, this is an expense that is not very routine. So I will only record it once in a journal proper. Similarly, there might be outstanding rent at times. So outstanding rent is a separate account. We discussed in the last class that this is a personal account. But what about interest on rent outstanding? Outstanding rent is a separate account. Interest on rent is only a nominal account. This is not a personal account. So the interest on rent will be maintained in the journal proper. Understood that any transaction which is not falling under any of the specific heads that we have maintained in our ledger, they will be directly introduced in the journal proper. Moving on, we will now be discussing different types of books of accounts with example. So this is how a journal looks like normally. That this is the date column. We had seen that there are two parts, two mandatory parts to a journal. One is to record all daily transactions, and second is chronological order. Chronological order. So date comes first, then we show which entry where, debit and credit, and this is called the narration. So purchases account has been debited to cash, which means we have purchased goods. Let's say we purchased goods for 5,000 and we paid it via cash. The entry is being goods purchased in cash. So a narration normally gives a brief description. This narration for being goods purchased in cash, this gives a brief description of what is the entry about. Now let's see the second entry. Donation account debited to purchases. Purchases normally means inventory account. Okay. Goods are not normally called goods. They are transferred to a closing stock account later on. So donation account to purchases. Now donation is an expense. So this has been debited. Purchases, which means stock, has gone down. Stock is an asset for the company, and if stock is going down, then this will be credited. The narration says being goods donated. So if 1000 rupees of donation was made, then we will put this. What if, let's say, purchases were for 5000, the donation said donation was for 10,000. Is that possible? It is possible only if the closing stock, the opening stock had more than rupees 5000 worth of stock in the beginning, because then we will have 5000 worth of stock right here and 5000 from the existing inventory that we donated. Now let's look at the next entry. Drawings to purchases. Drawings, as we had discussed, is when the owner or proprietor /proprietor takes back money. In the capital account that we maintain, we have a column wherein we can debit the amount of capital through drawings. Okay. So at the end of the year, this is what happens, that if the capital account had some credit balance, let's say 1 lakh rupees, and if drawings to purchases means that goods were withdrawn for the purpose of the owner's own use, let's say 1000 rupees worth of goods were taken out, then we have the entry of capital account debited to drawings rupees 1000. This will reduce the closing balance. It will be 99,000. Next is the loss by fire to purchases. Loss by fire, as we saw, will go to the journal proper, because, and all of these will on one side affect the purchases account. So this is how a journal is maintained. Now we look at the ledger. Just have a brief glance at it, the different types of accounts that might exist. First is the cash account. If a business is not maintaining a cash book separately, then they can simply maintain a cash account in the journal. Then there is accounts receivable. Accounts receivable is nothing but debtors. The supplies inventory as well as merchandise inventory. This is how most businesses operate, that supplies inventory is raw materials, merchandise inventory is finished goods. Normally manufacturers buy some supplies, process it and then resell it. They are not in the business of direct reselling. Similarly, accounts payable is creditors. Then there is the sales revenue, cost of goods sold, which is basically operating costs, and the supplies expenditure. Now moving on to the next book. This I think was pretty clear. A ledger basically provides for all accounts which have separate heads. So in the debtors column we have all debtors who owe us money. In the creditors column, accounts payable, we maintain records of all accounts where we owe money. Receivables and payables are both short term. They are current liabilities. We will discuss current liabilities, fixed liabilities in the next class when we discuss profit and loss account, trading account, etc. as well. So for loan account, you will maintain a separate entry in the ledger, but for accounts receivable and for accounts payable, because they are both current assets and current liabilities, you do not have to maintain a separate book. Okay. A cash book is very similar. Just have a brief look. The different kinds of transactions. That first, the cash book had a debit balance. Why? Because cash is an asset. So there was a debit balance, and there were multiple expenditures made for insurance, for furniture, for purchases, for stationery, to Rukmani. This is a personal account that we paid to Rukmani. Rent is a regular, to salary. Gurmeet paid us money. So this is also a personal account, but we received money. Through sales we received money. So this is a nominal account, sales, whereas Gurmeet is a personal account. Ultimately, there is some that we paid to the bank, not as bank charges, but we simply put in a bank. At times, some trading firms maintain a separate bank account and a separate cash account. So this is the balance, the remaining 23,400. The total of the account does not matter. It only matters to check if the two sides are matching. If this is also 88,200 and if this is also 88,200, then there is reasonable chance that everything is fine. There is no error. We saw that 23,400 is the closing balance, 23,400 is the opening balance here. Okay. This was simple. These are only some examples of how a purchases and sales book look like. This is an example of a purchase book that names of different suppliers have been provided from whom we purchased goods. Remember, purchase book is for our creditors, that in a purchase book we owe money, whereas in a sales book we are owed money. In a sales book we are owed money. Alright, please have a brief look over all of these, that we maintain an invoice number, the date, and this is all, because all of these are current liabilities. So ultimately we only carry the entry of sundry debtors into the balance sheet. We don't mention the names of all Neva Electronic, Pavan Electronic, etc. separately onto the balance sheet. That is unnecessary. Moving on. Now we come to the bank reconciliation statement. I had told you earlier that a bank reconciliation statement, the BRS, is made when the final balance in the cash book is different from the balance in the bank passbook. So the reconciliation statement identifies the errors and rectifies them. The errors or the difference could be for multiple reasons. It could be the error by the firm in its accounting process. Sometimes you don't realize that you might have spent 200 rupees via UPI or through an employee and you failed to record it. Sometimes there might have been bank charges that we may not have noted, but the bank has already charged. Sometimes the bank also makes an error. Sometimes it adds money or takes money from another account by mistake. So sometimes there are checks which are unpaid. So you might have noted in cash book that we have paid, but the bank has not encashed the check yet. So the passbook is not adequately updated because the money is not deducted from the bank account, but we have already understood that it will soon be deducted. So this is the format of a bank reconciliation statement. Please have a look. First we add the items, that this is the balance as per cash book. Let's say this was 1,100,000 rupees. Items credit in passbook but not recorded in cash book. There is none. Items credit in cash book but not recorded in passbook. There is none. Items debit in cash book but not recorded in passbook, none. Items debit in passbook not recorded in cash book, rupees 200 bank charges. Balance as per passbook 99,900. And the earlier example that we had discussed in the beginning of the class. So this way we come up with a final answer just to justify to the accountant and to the auditor that everything is fine, there is no golmaal going on in the class. Okay. Now we move on to trial balance. Trial balance is the most important part. Please listen to this part carefully. The trial balance is made from the ledger balances of various accounts. Okay. So all ledger account closing balances, I am using the word closing balances because the trial balance is usually prepared at the end of the year. However, it can be at any date. So closing balance might not be the right word if it is not at the end of the year, just balance of all account, which is why in the definition we only say made from the ledger balances of various accounts. They are usually prepared at the end of the year. It can be prepared at any date. The trial balance serves three purposes. First is to ascertain arithmetical accuracy, that both debit should match the credit side. If it is 1, 2, 3, 4 rupees, then the other side should also be 1, 2, 3, 4 rupees. Second is to help locate the error, that if this says 1,230 rupees, then there has to be a 4 rupees trade off somewhere. Probably we put 2 rupees extra on the debit side when they should be on the credit side. So we minus 2 and we plus 2, and this would be 1232, and this would be this would be 1232, this would also be 1232. So suddenly the balance becomes clear. So this helps in locating errors, and this helps in preparation of financial statements, because ultimately it is these balances from which we will carry forward the final details into the balance sheet. So while it looks very basic, trial balance is the most challenging part, and this is what frustrates accountants towards the end of every quarter, because they have to look at every transaction that could have gone wrong or is probably not recorded, and ultimately they have to vouch for it, that where is the proof, what actually happened in one transaction, etc. So let us look at the causes of errors in a trial balance. As we had seen earlier, that it should match, but most often it does not match, and when it does not match, there is a good reason why it does not match, and we have to correct it later on, because this is not a financial statement. It is fine if it does not match. The balance sheet always has to match. Trial balance does not always match, must match for accuracy. If the trial balance is not matching, you can be certain that there is an accounting error. If the balance sheet does not match, then that means you're a failed accountant. A balance sheet has to match, otherwise it is not a balance sheet at all. Understood? Whatever errors have to be made in the trial balance. If all entries are correct in all accounts of the firm, then the trial balance should match automatically. Then there is no reason why the trial balance will not match. However, just because the trial balance matches does not mean that there are no further errors. This happens because of the phenomenon of compensating errors. Please understand, when equal amounts on both sides are interchanged by accident, then compensating errors occur. For example, I purchased furniture worth rupees 28,000, but I accidentally noted it on the credit side. I put furniture on the credit side of the trial balance. On the debit side, I put creditors as well as profits. Both of these are wrong. We saw that because I might have mistaken that this is the liability side, so I put all of this, but this is not how it's supposed to be. These are supposed to be on the opposite sides. So if 28,000 furniture exists and 13,000 plus 15,000 exists, then even if these are wrong entries, my trial balance will match, because there is an error of 28,000 on both sides. However, this will still make the financial statement wrong, that my balance sheet will be incorrect. It will not portray the true financial position. And accuracy and fairness of the financial statements is a cardinal principle that we cannot violate. So therefore, this is the first kind of error, which is the compensating errors. Okay. Now we move on to the next errors. Compensating errors, I hope, is clear. When equal amounts on both sides get interchanged. The other form of error is the error of omission, that sometimes you might have forgotten, say there's a 5,000 here and 15,000 here. So you might have forgotten credit side entries. You might have forgotten to carry forward creditors worth rupees 10,000. So if you forgot creditors worth rupees 10,000, if you add them, you will get this. Otherwise, you might have committed the error of commission, that you might have added assets from the previous year, that goods which have been sold are still considered for rupees 10,000, but it also includes cash. Let's say goods for 5,000 which were sold, as well as cash which was received for the goods, both have been included. So this creates a problem. Now the third is the error of principal. The error of principal is the cardinal error that someone makes while making a trial balance. This we discussed in the rules for debit and credit, that we are unsure on which side of the debit or credit balance should something fall. For example, I take a loan for rupees 50,000 and I make the entry loan debited rupees 50,000 to cash 50,000. Please understand how fatal this error is, because loan is a liability. I have treated it like an asset. So now, if I already had a loan of say rupees 1 lakh rupees, my ideal loan amount should have been 1,50,000 rupees. Ideal loan in the correct case. But now, because I have debited loan, I will have simply deducted 50,000 from the 1 lakh that already existed, and now I am left with loan rupees 50,000. So you understand, this error of principal sometimes creates major calculation errors. So these are the three kinds of errors which normally occur while maintaining a trial balance. If the trial balance does not match, for example, if one side says 28,000, the other side says 23,000, then the solution is called a suspense account. We say suspense account rupees 5,000 on the debit side, and this is all. This allows us to move forward to the closing financial statements, and then we will rectify these errors later on. So this suspense account will get reflected in the balance sheet if we have to carry forward to the balance sheet, and then in the next year we will finally, because it is debited, say we had missed out on cash, one entry of cash we had missed out earlier, that we had received some cash, so that we can do cash debit to suspense account rupees 5,000. So in the next year's trial balance, this will finally be written off, and ultimately things will balance out. So this is how trial balance gets rectified ultimately. Okay, we will look at a sample balance sheet just for the sake of convenience. This will be more for the next class. I am just giving a brief background on what a balance sheet looks like. So just have a look that, for example, assets for rupees 5 lakh, capital for rupees 5 lakh. So both of them match. This was very easy. Ultimately, the rule remains that assets equal to liability plus capital. This is the matching concept that we discussed in the first class. Let's look at one other example for a balance sheet. This is slightly more complicated, not complicated as such, but more than the previous claim, that we have multiple assets such as cash, bank account, debtors, stock, furniture and plant and machinery. So furniture and plant and machinery are fixed assets which will stay for multiple years. Cash, bank, etc. are current assets which are for 1 year or less. So altogether this amounts to 68,000 rupees. We have creditors worth rupees 1,70,000 and capital worth rupees 5,10,000. So this is also 6,80,000 rupees. This is how balance sheet looks like. We will discuss balance sheet of companies in a later class, balance sheet of companies and balance sheet of partnerships, as well as not for profit organizations. These three we will cover separately because these are slightly technical. These are, well, I will cover the basics first, uske baad after that we will cover the deeper concepts. Let's look at the previous year questions. Question number 1. Which of the following is the first book in which the transaction of a business unit are recorded? As we had seen, it is the journal, because there daily all transactions are recorded, okay, in a chronological manner. From the journal it is carried on to the ledger as well as to the cash book. From the ledger and cash book they are carried on to the trial balance, and from here to the balance sheet. Alright, let's look at the next question. Which one of the following statements about trial balance is correct? A. It is a book containing different accounts of an entity. B. It is a statement containing balances of debtors of an entity. C. It is a statement containing balances of debtors and creditors of an entity. And D. It is a statement containing various ledger balances of an entity on a particular date. As we had discussed, the answer is D. It is a statement containing various ledger balances of an entity on a particular date. C. Statement containing balances of debtors and creditors are sales book and purchase book. Containing balances of debtors of an entity is the sales book, and book containing different accounts of an entity is the ledger. So the answer is D. Moving on to the next question. Is the total of debit and credit side of trial balance the same? A. No. There are sometimes good reason why they differ. B. Yes, always. C. Yes, except where the trial balance is extracted at the year end. And D. No, because it is not a balance sheet. Now please understand, is the total of debit and credit side of trial balance the same? A is the best answer because it says no, there are sometimes good reason why they differ. Okay, that there are reasons why they can differ, otherwise they are the same. Yes, always is a wrong answer because it is possible for the trial balance to be wrong. It should not be, but it is possible and it often is. And it is a very standard accepted practice and it is legally permitted. So there is no harm in having a difference in trial balance, credit and debit side. Okay, because we can always have the suspense account. So the answer is A. So these were the questions. Thank you. We will meet in the next class now. Hello everyone. Welcome to the fourth class of General Accounting Principles for EPFO. Today we will discuss financial statements. Financial statements are basically statements which depict the financial position of a company at the end of the year. Okay, let us begin. So, financial statements are the statements which are prepared at the end of the accounting year. They are generally prepared at the end of every 1 year. However, for companies which are listed on a stock exchange, they have to submit quarterly returns as well as half yearly returns as well. Okay, there are two kinds of statements. First is the income statement, which is trading account and profit and loss account. These show how much the company is earning. And the position statement, which is the balance sheet. This shows what is the overall position of the company. So using these two statements, we can calculate different forms of ratios for the company. For example, debt to equity ratio, debt servicing ratio, etc. Okay. In this class, we will only be discussing the income statements. We will be discussing position statement in the next class. Okay. Please understand that the two statements that we discussed, trading account and profit and loss account, are from the perspective of sole proprietorship. Sole proprietorship, which is when one single owner exists. Trading account is normally only for a trading company which buys supplies, processes them and sells them once again. We don't have a trading account for services companies normally. And for companies, we have a statement of profit and loss, not a profit and loss account that we discussed today. So we will discuss in later classes accounting for partnerships, companies and not-for-profit organizations. So when we discuss this, we will also discuss the statement of profit and loss. In the present class, we are only going to discuss the trading account and the profit and loss account. These are very preliminary points that we need to clarify before we move on to advanced statements. Okay, so let us begin. Okay, so now we come to capital and revenue items. These are the basis on which all financial statements are made. So all transactions have to be treated either as capital items or revenue items. What are capital items? Capital receipts and capital expenditure. Those who are familiar with terms of economy for any of the other entrance exams would know that the budget provisions also provide for requirement of capital expenditure, revenue expenditure and capital receipts and revenue receipts. So what is capital? Capital is anything that affects the assets or liabilities of a business. So capital receipts are those which either lead to increase in capital, increase in liabilities or decrease in assets. Okay, liabilities increase or assets decrease will normally increase the receipts of the business. So for example, through sale of land, one of our assets, and in this case please mind these are non-cash assets. So through sale of land, one of our non-cash assets, which is land, will go down and our cash will come up. So this is a capital receipt. Similarly, loan, if we take, our liabilities will go up and our cash will go up. So this is a capital receipt. If the owner themselves provides for equity, this is also a capital receipt, because owner's capital will increase and cash will increase. So these are the forms of capital receipts. Then we come to capital expenditure. Capital expenditure is anything which causes reduction in cash but increase in assets or decrease in liabilities. So purchase of machinery is a capital expenditure. We have spent cash to buy an asset. Therefore, machinery is increasing, cash is decreasing. Thus, this is capital expenditure. Payment of loan, repayment of loan is also a capital expenditure, because liabilities are going down, please remember, while cash is also going down. So that is also a capital expenditure. Now we come to revenue items. Revenue items are those which are basically non-capital in nature. That is essentially the definition. Revenue receipts are those receipts which occur in the normal course of business. Such as sale of goods. And revenue expenditure is that expenditure which is also incurred in the normal course of business, such as wages, rent, electricity charges, etc. The core accounting treatment of these is that the revenue items form part of trading and profit and loss accounts, while the capital items are used in the preparation of balance sheet. So for example, when I purchase land, this will not have an effect on my P&L account, profit and loss account, but this will directly be visible on my balance sheet. So through this, we need to understand what is the core difference between capital items and revenue items. Revenue items form a part of trading account and profit and loss account, and capital items form a part of balance sheet. This is the basic difference. Okay. Now let us come to what constitutes income statements. So as I told you, there are two kinds of income statements. First is the trading account. Second is the profit and loss account. The trading account is maintained by any trading company. For normal accounting, we don't look at service companies, startups, etc. We will discuss partnerships and companies act, but we will not look at niche, very specialized types of companies. Okay. So what is the trading account? Trading account is an account that discusses position of inventory, the opening stock, as well as the closing stock, and helps in the calculation of profit margins and gross profit. Gross profit is basically that profit which is only related to core operations of a company. Therefore, if I am in the business of manufacturing of agarbattis, then all costs for agarbatti, raw material, wages to workers and packaging will be included in the agarbatti cost, and then sale price minus manufacturing cost will give me the gross profit. We will come to what is cost of goods sold in a few slides, but please understand this is for the purpose of cost accounting, that we need to come up with the correct cost. We had discussed in the previous classes what is the point of cost accounting. Cost accounting helps in setting price. How much does it cost to make a product? Is what leads to cost accounting. Okay. The next accounting statement, income statement, is the profit and loss account. The profit and loss account takes the gross profit from the trading account as its basis. It can also be gross loss. Okay. Please be mindful that it's not necessary that someone makes a gross profit all the time. So the profit and loss account takes the gross profit and then adds all other expenditures, all other expenses or expenditure, to calculate the net profit of the company, of the sole proprietorship business. This is important for making other financial decisions about operating costs. There is also something called the operating profit. We will not be discussing this at present, although I will briefly explain it when we are discussing gross profit and net profit. So examples of decisions that might be needed is expenses on salaries, advertisement, rent, etc., which are very important for running any industry if you think about it, but they don't affect the gross profit of a company. So a company which has its price point dependent upon rent, advertisement or salaries will find it more difficult to compete. But if a company is very sure of what its core operating costs are, then it can reduce the ancillary expenses of advertisement, rent, etc., and become more competitive. Are you understanding? So let us start with the preparation of these statements. So we begin with the preparation of the trading account. Okay. So the trading account, as we saw, is the first account used for calculating of gross profit or gross loss. The formula for gross profit is net sales minus cost of goods sold. Now what is cost of goods sold? Let us look at it first. So cost of goods sold is the direct cost for making, selling, goods. Only the costs involved in the direct making or selling of goods is used to calculate cost of goods sold. The formula for cost of goods sold is opening stock plus net purchases plus all direct expenses minus closing stock. Please understand. Let us say I have 5 oranges worth 10 rupees each in the beginning. I buy 2 more oranges. This is the selling price. Please remember. What do we purchase? We purchase and we record the cost price. Let us say the cost price is 7 rupees. Okay. Now I buy 2 rupees more, 2 oranges more worth rupees 14. So my total purchases have been opening stock for rupees 35, purchases for rupees 14. Is there any other expenditure at present? No. Now suppose I am able to sell 5 of these for rupees 50. This is only for later. Okay. The opening stock was rupees 35 and the purchases, net purchases, because there are no returns, I will explain this in detail later, is rupees 14. So at present our total cost of goods sold is 49 rupees. Now suppose I am only able to sell 5 of these oranges, then I still have 2 oranges left. My closing stock is worth rupees 14 once again. So I will subtract this and finally I will get cost of goods sold to be rupees 35. Now my sales were for 5 oranges, I sold rupees 50. If this was my sales, then my gross profit will be net sales, which is 50 minus cost of goods sold rupees 35 is equal to 15%. 15 rupees. I'm sorry. Okay. 15 rupees. What is my gross profit ratio? The formula for it is, I will just use some blank space. Wait. The formula for gross profit ratio for GPR is gross profit upon net sales into 100. Okay. So if net sales is rupees 50, gross profit is 15, then my gross profit ratio is going to be 15 upon 50 into 100 is equal to 30%. Alright, let us discuss a more complex example now, just to establish the principles more clearly. Suppose cost of goods sold has to be calculated. All that I am provided with is opening stock rupees 350, purchases rupees 50, wages rupees 50, closing stock rupees 100. What is my cost of goods sold? It is 350 rupees. We add 350 plus 50 plus 50 and minus 100. Wages are a direct expenditure. These are different from salaries which are paid to other employees such as advertisement employees. Wages are paid to workmen for manufacturing. This is also an important difference. We will discuss this more deeply in the classes in labor law when we discuss who is a workman. But at present, please understand that a workman gets wages whereas an employee gets salary. Okay, salaries are not direct expense, wages are direct expense. All right. What is net purchases? Net purchases is purchases minus purchases returns. You would remember in the last class we discussed a purchase book as well as a purchases returns book. Whatever we sell out, whatever we return to our creditors, that we don't need these goods, they are reduced from our stock directly. Similarly, what are net sales? Sales minus sales returns. So now let us try a more complicated numerical. Suppose opening stock is rupees 20, purchases is rupees 50, sales is rupees 200, wages are rupees 35, sales returns is rupees 100. And other direct expenditure is rupees 20. Take 2 minutes, try to solve this problem right now. The operating stock is rupees 20, the purchases is rupees 50, the sales is rupees 200, wages rupees 35, sales return rupees 100 and other direct expenditure rupees 20. I hope you're done. Let us solve this problem. Using the same formula, we come to these calculations that the net sales were rupees 100, which is sales minus sales returns. The cost of goods sold was opening stock plus purchases plus wages plus direct expenditure. There is no purchase return, there is no closing stock mentioned. In this case, we will assume that there is no closing stock. We will simply take all the stock as sold. So cost of goods sold is rupees 125. Since the cost of goods sold is more than the net sales, we incur a gross loss of rupees 25. What is the gross loss ratio in this case? It is the same as the gross profit ratio. Gross loss upon net sales into 100, which is 25 upon 100 is 25%. Is this clear? I will be erasing this for trying to handle another kind of questions. Okay. So please go through this entire problem once again if you want to. I think it was pretty direct. We should move on. So what if some questions might provide you only the gross profit and net sales? You have to come up with cost of goods sold. How will you do this? We will do this by transposing this equation. Cost of goods sold is equal to net sales minus gross profit. Okay. Sometimes you might only be given the gross profit ratio and you have to come up with cost of goods sold. How will you do this? Let's say net sales is equal to rupees 10,000. The gross profit ratio is equal to 20%. What is the cost of goods sold? Apply the same formula. The gross profit ratio is equal to gross profit upon net sales. If this is 20%, then the gross profit will be rupees 2,000. Therefore, cost of goods sold will be rupees 8,000. What if you're only provided for the gross profit ratio on cost of goods sold? Let us say gross profit is 20% of cost of goods sold and net sales is rupees 10 lakhs. Let us keep it 12 lakhs for convenience for the time being. Okay. So what if the gross profit is 20% of cost of goods sold and net sales is 12 lakhs? This means net sales is equal to COGS plus gross profit, which is COGS plus 20% of COGS, which is equal to 120% COGS is equal to 12,000. I am sorry, 12,000. Therefore, cost of goods sold is rupees 10,000 and gross profit is rupees 2,000. How do we arrive at this formula more easily? So the formula for this is if gross profit is equal to X% of cost of goods sold, then it is equal to, then gross profit is equal to net sales into X upon 100 plus X. Okay. In this case, in the previous example, the net sales were rupees 12,000. If we try 20% of gross profit of cost of goods sold. Remember, this is different from the gross profit ratio. Gross profit ratio is always gross profit upon net sales. There is no gross profit ratio involved in this question. This is only as a percentage of cost of goods sold. But if this is the question, then the formula is net sales into X upon 100 plus X. If we apply this, we will get the answer very simply, that the answer is rupees 2,000. This will always be the case. Okay. Now, same goes for gross loss also. A few definitions we will just do quickly. That opening stock refers to the value of goods lying unsold at the beginning of the accounting year. It is shown on the debit side of the trading account. We will look at a sample trading account in the next slide. Closing stock is the value of goods lying unsold at the end of the accounting year. It is shown on credit side of the trading account. And direct expenses are expenses that can be attributed directly to the purchase of goods or goods manufactured. So while we look at cost of goods sold, we look at what was the goods involved which we were selling. And when we have to look at profit, we will only look at the profit on the goods that we have sold, which is why opening stock as well as all expenses are counted and closing stock is removed, because closing stock, if it has not been sold, then no profit has been made on the closing stock. So therefore we have to exclude it from the cost. Alright. This gross profit or gross loss is what gets carried on onto the profit and loss account. Okay. Let us see a trading account example first. So this is what a sample trading account looks like. Trading account for the year ended. Please remember that other accounts are continuing accounts. Trading account is a flow account. Okay, all income statements are flow statements. They discuss the change that has occurred in every year over the course of a period. So this is the difference from a position statement such as balance sheet. A position statement only shows the static position on one date, on a date, whereas the flow statement such as trading account provides for the year ended, for the entire year they provide the accounts. Okay, so we look at this trading account. It has an opening stock, there were purchases less returns outwards, which were returns, purchase returns, then wages, carriage and freight are transportation costs. So these were some of them. And to gross profits, if there have been gross profits. Then on the other side we have sales less returns inwards. Return inwards is sales returns because you are getting back stock that you had sold already. So sales minus sales returns minus closing stock, and we get either a gross profit or a gross loss. Okay, this is what the formula for trading account is. This is what the format for a trading account is. We now move on to a profit and loss account. Okay, the profit and loss account is more comprehensive. It looks at the net profit of a company, of a business, whereas the trading account was looking at the gross profit. While gross profit is sales minus purchases and direct expenses, net profit is gross profit plus other incomes minus indirect expenses. Why? Because direct expenses have already been deducted, so you will not deduct them again. All the items of revenue, income and expenses, whether cash or non-cash, are considered in this account. So all non-capital items which were either received or sold will be taken into account. Only revenue, income and expenses related to current year are debited or credited to this account. Following are not shown. Firstly, drawings. Drawings we saw is the withdrawal of capital. Withdrawal of capital by the owner. Since drawings are not expenses of the firm, they are not shown. Why? Because drawing is a capital expenditure. The cash goes down, but liability to the owner also goes down. So drawing is not shown. Secondly, income tax. In case of sole proprietor firms, this is what we are considering right now. The income tax is a personal expense. It is not debited directly for the firm. So if the firm is paying income tax, it will debit income tax from the capital account. That will also be a capital expenditure, because capital will go down and cash will go down. Alright, let us discuss some problem questions that are possible. Suppose you have gross profit of rupees 10,000. You have salaries rupees 2,000. Wages rupees 1,000. Rent rupees 1000 and ad expenses, advertisement expenses rupees 1000. Calculate the net profit ratio. Calculate the net profit only for the time being. Okay, were you able to do this? Let us look at the answer. Net profit is gross profit plus other incomes minus indirect expenses. So gross profit is 10,000. Indirect expenses are salaries, rent and ad expenditure. Wages are direct expenditure, they have already been deducted. So we will use 10,000 minus 2,000 minus 1,000 minus 1,000. The gross profit is 6,000. The net profit is 6,000, not 5,000. Okay. Please be mindful of these tricks. At times you can get an answer wrong. Sometimes EPFO has asked questions on gross profit, net profit, and this can create confusion. And if the options are very close by, then you might lose out on 1 or 2 marks. There is negative marking also, and the margins are very close for EPFO. So please be careful. Wages, as we discussed in the previous slide only, is a direct expenditure. Okay, let us try another problem. Suppose gross profit 10,000, rent received 2,000, rent paid 1,000, sale of land 5,000, and salary 1,000. This is minus, all the others are plus. Okay, salary has been paid, rent has been paid. Calculate the net profit. Take 30 seconds, take 1 minute. Okay, let us see. The gross profit was rupees 10,000. Rent received is other revenue income because you will regularly receive rent if you are receiving rent. So 12,000. Sale of land will not be counted. Sale of land is what we discussed is a capital item. So we will not count any of this. Now we'll deduct rent paid and salary paid. So 10,000 plus 2,000 minus 1,000 minus 1,000. Alright, 12,000 minus 2,000. The net profit is rupees 10,000. Okay, please be mindful once again that any capital item will not be included. Only revenue, income and expenses related to current year are debited or credited to this account. Okay. Let us look at the format of a profit and loss account. So as we see this sample, they have started with a gross loss. So if it is gross loss, we put it on the debit side. If it is gross profit, we put it on the credit side. Then they have deducted salaries, office rent, printing and stationery, telephone expenses, postage expenses, discount allowed. Discount allowed is an expense for the business which is a sale related expense. This is not a production related expense. Insurance, audit fees, electricity charges, repairs and renewals, depreciation charged. We will discuss depreciation in the next class as to how treatment for depreciation is done. Okay. Advertisement expenses, carriage outwards. Carriage outwards is goods that we have spent money to deliver, that the customer has not paid for, we have paid for. To bad debts, if certain debtors have not paid their debts, they have become, in banks they are called non-performing assets, but for normal trading concerns they are called bad debts. To provision of bad debts. Provision for bad debts is something we will discuss in the next class when we discuss provisions, reserves and depreciation. Okay. Selling commission, bank charges, interests on loan, loss on sale of asset. And on the credit side, they have put discount received on sales. Discount received is also an other income. They are not any form of direct purchases income में नहीं आएगा ये, तो हम इसको यहाँ पे ऐड करते हैं नेट प्रॉफिट में, प्रॉफिट एंड लॉस में हम इसे ट्रेडिंग अकाउंट में नहीं डालते हैं. कमीशन रिसीव्ड, बैंक इंटरेस्ट, रेंट रिसीव्ड, डिविडेंड ऑन शेयर्स हेल्ड बाय द कंपनी, interest earned on debentures, profit on sale of asset. Please look at this. Loss on sale of asset and profit on sale of asset. The proceeds of sale are not profit. Only profit is profit. Okay. So if I say sale of land for rupees 5,000, that is capital. That is a capital receipt. If I say profit on sale of land, then this, if the account said sale of land, profit on sale of land, to land 5,000, 1,000, for land worth rupees 5,000, The equation would have been sale of land 5,000 to land 4,000 to profit on sale of land rupees 1,000. Okay. Moving on. This is the basic difference between the different kinds of expenditure: capital expenditure and revenue expenditure. Capital expenditure increases the earning capacity of the business, whereas revenue expenditure is incurred to maintain the earning capacity of the business. So the electricity charges that we pay, the rent that we pay, the salaries and wages that we pay, these are to maintain the earning capacity. If we pay some joining bonus, that can be, what can that be? If we pay joining bonus for rupees 25,000, but only if the person stays for 5 years, we will discuss it in the next slide. Okay. The next is capital expenditure is incurred to acquire fixed assets for operation of business. Revenue expenditure is incurred on day-to-day conduct of business. So if I buy more land, machinery, furniture, this will be capital expenditure. But if I spend money on repairs of machinery, that will be revenue expenditure. Capital expenditure is non-recurring by nature. Revenue expenditure is generally recurring. We will recur most of the expenses such as electricity expense, wages every year, every month. Capital expenditure benefits more than one accounting year. Revenue expenditure normally benefits 1 year. Capital expenditure subject to depreciation, we will discuss this, I have told you, is recorded in balance sheet. Revenue expenditure is transferred to trading and profit and loss account, subject to adjustment for outstanding and prepaid amount. We discussed it in the earlier class that outstanding and prepaid accounts are personal accounts, so they will not be included. Okay. Moving on. Deferred revenue expenditure. Sometimes some expenditure is revenue in nature, however, it has long-term effects and large transaction value. For example, I put one ad in newspaper for 500 rupees. I do this every month or every 2 months. That is revenue in nature. Advertisement expenditures are normally revenue expenditure. However, if I put 1 lakh rupees in a marketing campaign such as Coca-Cola, if they put, Coca-Cola might be putting 10 crore into one marketing campaign. So the benefits of every campaign will be for multiple years. We still remember Pepsi's Dil Mange More slogan. They paid a lot of money. They hired many actors. They ensured that it was a massive success. They still reap the benefits. So the cost should be distributed over many years. Okay. So any revenue expenditure which will be taken up again, but at present it is more than one accounting year. More than 1 year will be cut from the expenses over the course of time, these are called deferred revenue expenditure. Okay. If I spend 5 lakh rupees on an ad campaign which will help me for 5 years, then in 1 year my expenditure is approximately rupees 1 lakh only. Therefore, I will show only 1 lakh as expenditure in 1 year and treat the other 4 lakh as deferred revenue expenditure. We will deal with the treatment of deferred revenue expenditure in the next class when we discuss provisions and reserves and depreciation. Okay. Some examples are huge expenditure on advertisement campaign, preliminary expenses for company. A company has to spend a lot of money to get itself registered. They have to pay CAs, they have to pay law firms, they have to pay for the director incorporation number to the registrar of companies, etc. etc. They have to pay different investment bankers. So all of these preliminary expenses are treated as deferred revenue expenses for the company, and they are cut over and they are deducted from the company's balance sheet over the course of many years. Otherwise, if we don't do this, then the company will show loss when in reality the benefits are long term. This will prevent a fair disclosure of books of account. And so to ensure fairness, we give proper weight to deferred revenue expenditure. Alright. We will quickly discuss what are receipts. In a similar form to revenue expenditure and capital expenditure, there are receipts in the business. If the receipts imply an obligation to return the money, these are capital receipts. Example can be additional capital brought in by the owner or a loan taken from a bank. These will increase the liabilities. Okay, both receipts are leading to obligations, first to the owner by additional capital and other to outsiders, which is loan taken from bank. Another example is the sale of fixed asset like machinery or furniture. This reduces the assets, the non-cash assets, please remember. However, if a receipt does not incur an obligation to return the money or is not in the form of sale of fixed asset, it is termed as revenue receipt. Okay. Creditors are by default capital receipts. Even if they are sundry creditors, they are still going to be depicted on the balance sheet and they are capital receipts. We will discuss current liabilities, current assets, in the next class on balance sheet. Okay. Let us look at some previous year questions. Which of the following denotes gross profit? A. Cost of goods sold plus opening stock. B. Sales less cost of goods sold. C. Sales less purchases. Or D. Net profit less expenses of the period. As we had discussed, the answer is B. Sales less cost of goods sold. That is the gross profit. Cost of goods sold plus opening stock makes no sense because cost of goods sold already includes opening stock. Sales less purchases is also not cost of goods sold, because this is only going to show the revenue from the period. And net profit less expenses of the period is also making no sense, because net profit has already deducted all the expenses of the period. Okay, so the answer is B, sales less cost of goods sold. Coming to the next question. Preliminary expenses are examples of A. Capital expenditure, B. Capital gain, C. Deferred revenue expenditure, or D. Revenue expenditure or expense. We have just discussed this, that preliminary expenses are examples of deferred revenue expenditure, because they are covered over multiple years in the balance sheet of a company. Okay. Moving on. This is a numerical question. Consider the following information. Rate of gross profit is 25% on cost of goods sold, and the sales is rupees 20 lakhs. Which one of the following is the amount of gross profit? Okay. Please remember, this is 25% on cost of goods sold. Please pause it right away and take your time to solve, and then come to the conclusion. I will give you 10 seconds. Pause it and practice as much time as you require. All right. Okay. Now we will solve this. We had already discussed that the formula is sales into x upon 100 plus x, where x is the percent on cost of goods sold. So we come to sales into 25 upon 125 is equal to rupees 4 lakh. 1/5 हो गया ये, तो 20 lakh into 1/5 is 4 lakh. Okay, this is the answer. With this we conclude today's class. We will discuss over the next classes balance sheet, provisions, reserves and depreciation. Okay, have a good time. Bye bye. Hello everyone, welcome to the 5th class for General Accounting Principles for EPFO. In this class, we shall be discussing the second part of financial statements, primarily the balance sheet. Alright, in the last class, we discussed the first part of financial statements, which were the income statements, profit and loss account and trading account. And in this class, as I said earlier, we shall be discussing the balance sheet. Let us begin. So balance sheet is the final statement, the final position statement of any company, any business entity or any partnership firm. Any business organization basically has to make a balance sheet. This is called a position statement because it is prepared to ascertain the financial position of a firm on a particular date. We will discuss what this financial position means when we discuss stock and flow in the next slide. The balance sheet depicts, as we have seen, it depicts the liabilities and assets of a firm. I have also shown you a sample balance sheet in the previous classes. So there are two columns, the asset side and the liabilities side, and both of them are ultimately equal in a balance sheet of a company. This is based on the accounting equation that assets equal to total liabilities plus capital. Therefore, assets is what the company owns and liabilities is who owns the company. Therefore, if the company owns something, then someone has to own what the company owns ultimately, and those are the liabilities. Be it the internal liabilities, which are owner, or the external liabilities, which are lenders and creditors. Okay. Please remember that balance sheet is a statement. It is not an account. Therefore, there is no debit or credit side in this. We have discussed even up till the point of profit and loss account, we have a debit side and a credit side. This is not the case with a balance sheet. There is no debit, there is no credit. It is only a position statement with assets and liabilities. All right. So these were the basics of a balance sheet. Please let's move on to the next slide. Now that we have studied both position statement as well as income statement, let us understand the key difference between the concept of stock and flow. All right. A stock is basically the accumulated or available quantity at a particular moment. For example, how much cash do you have right now? You can look into your pockets. You might see there is either 50 rupees, there is 100, 700 rupees, 1700 rupees, 17,000 rupees if you have too much cash around you. But you will have money at a particular moment right now. Whereas a flow implies movement of commodity from source to destination. The way a river flows from the mountains to the sea, ultimately, in a very similar way, a flow implies the movement of a commodity or the change, the transition. This happens over a period. Okay. So, for example, if I now ask you how much money did you earn last month? Now you will not just look at your pocket, right? You will calculate how much you earned in the last month. So this is over a period of time. This is not at a single moment. So this is the basic difference between a stock and a flow. Why am I explaining this concept? Because balance sheet is a stock statement. It only represents the position on a particular date, whereas income statements such as profit and loss account or trading account, these are flow statements. They discuss the change in the financial position, the change in financial position of a company over the course of 1 year, one accounting period, whatever the accounting period is, be it quarterly, half yearly, annually, all of these. But an income statement is a flow statement. It only happens over a period. I cannot make a profit and loss account for 1 day or for 1 moment, but I can make a balance sheet for the present moment only. Okay. So even if we look at what the narration says for both of these, the balance sheet says as on 31 2023 as on, because this was measured on 31st March 2023, whereas income statement says P&L account, profit and loss account for the year ended on 31/3/23. For the year ended, because this was for the profit and loss account for the entire year. Okay, so a stock is a static concept. There is no time dimension. It is only on a particular moment, whereas flow is a dynamic concept. There is a time dimension to it, whether it is 1 year, 5 years, 25 years. All of these will be discussed in a flow concept. And quantity is measured at a point in time, and quantity is measured in flow in a period of time. Okay, both stock and flows influence each other. It is ultimately the flow which determines the difference between two stock statements. If my balance sheet on 31/3/22 and balance sheet on 31/3/23 have a difference of 1 lakh rupees in the total on both sides, then the flow statements will explain how this difference came up to be. Therefore, a balance sheet can only be prepared after profit and loss account is prepared. I hope this is clear. If you want, please just look at this slide and pause the video if you want to. I will now be erasing everything and moving on. Okay. So as we had discussed, the balance sheet has two sides, assets and liabilities. There are two major types of assets, the fixed assets and the current assets. Okay. So fixed assets, long-term assets are assets that are purchased for permanent long-term use, and these help the business to earn revenue. Okay. These help the business to earn revenue. For example, land and building, plant and machinery, motor vehicle. In land and building, you can ultimately store your goods. Through plant and machinery, you can process goods for value addition. Through motor vehicles, you can deliver goods. So these are capital assets, not goods. Okay, these are basically non-cash, non-goods assets with validity over 1 year, normally over many years. All right. The next category is the current assets. Current assets which are acquired by the business either for resale or for converting them into cash. These are normally realized within a period of 1 year. The abnormal circumstances are very rare. Normally they occur in terms of contingencies. We will discuss them, but if you are asked a question, you will always answer within 1 year. Okay. For example, cash in hand, cash at bank, bill receivables. Bills receivable are negotiable instruments. Okay. Promissory notes that you might receive, check. Debtors, stock, prepaid expenses, advances, inventory, trade receivables. Why prepaid expenses? Because they are, we had discussed it earlier, they are representative personal accounts. They are not expenses accounts. Even though the name says prepaid expenses, they are not expense accounts. They are representative personal accounts. They can be claimed in the future. Claimed in the future within 1 year. Okay. If something is not going to be within 1 year, then they will be deferred revenue expenditure, such as the advertisement expenditure that we had discussed earlier. All right. So these were the primary two categories of assets. There are other categories of assets in which we classify assets. Normally they are not represented this way in a balance sheet, but still let's learn the classification. First, we have liquid assets. Liquid assets are those which are either cash or can be easily converted into cash, such as cash, stocks, marketable securities. Here stocks means shares. Okay. Equity shares. Marketable securities also mean shares, mutual funds, which you can sell within 1 day or few days. Sometimes it takes 2 days to transact a trade, but that is also not a very big amount. So because at times if you buy goods, you might have to wait for months, but for mutual funds you don't have to wait for months if you need money immediately. That is why these are called marketable securities, and they are highly liquid. Liquid means convertibility into cash. So cash is the most liquid, and fixed assets are the least liquid. Why? Because you will have to sell them through legal process, through large scale auction, buyers, etc. That will take a lot of time. So these are liquid assets. The next category are wasting assets. Wasting assets are assets which exhaust or reduce in value by their use, such as mines, quarries. The more you mine, the less there is to mine. Normally, fishing ponds will also fall in this category, but there is a debate over whether they are wasting assets or not, because fish can replenish, but coal mining will not replenish. The third category is fictitious assets. Fictitious assets are not real assets. These are items of such expenses and losses which have not been written off in full. For example, and I will explain this through an example only, this will be much easier. Preliminary expenses, underwriting commission, etc. So what are these? When a company is incorporated, there are some preliminary expenses. The company in its balance sheet on the asset side, suppose owners put rupees 10 lakh, there are assets worth 8 lakh and preliminary expenses of 2 lakh. Why? Because the owners had spent rupees 10 lakh, but 2 lakh were for registration of company, etc. So owner's capital will still be called owner's capital, but 2 lakh of this will be written down. Written down is deleted gradually. So every year about 40,000 of this preliminary expenses will be cut out, and similarly 40,000 will go from the owner's capital through profit and loss account. So these are fictitious assets, they are not real assets, they are only shown on the asset side of a balance sheet. Okay, same is for underwriting commission. Underwriting commission is when, if you are supposed to issue stocks to public, there are some investment banks which promise to buy your shares at a lower rate if your public offer is not successful completely. Then they will make it successful mandatorily. This ensures that the IPO does not fail. For this, they charge a predetermined fees called underwriting commission. This underwriting commission is also a fictitious asset because it's a huge expenditure that is written down over multiple years. Okay. Moving on to liabilities now. These were the 5 types of assets which we have discussed: fixed assets, current assets, wasting assets, fictitious assets, and liquid assets. Okay. Let's move on to types of liabilities. There are 2 main types of liabilities: the long-term liabilities, fixed liabilities, and current liabilities. Okay. Fixed liabilities or long-term liabilities are liabilities which are not payable during the current accounting year. That is all. If there is a loan for 10 years, it's a fixed liability. Even if 1/10th of the loan is paid this year, that 1/10th will not be a current liability. The entire loan is a fixed liability. Only the amount of the loan will reduce every year as we keep paying it. Okay. Generally, funds raised through such means are used for purchase of fixed assets. Why? Because these are large amounts. We don't use large loans for working capital requirements. Examples are loan on mortgage, loan from financial institutions, etc. The other type are current liabilities. Current liabilities are liabilities which are payable during the current year. Very simple. Bank overdraft, trade creditors, trade payables such as checks to someone else, outstanding expenses, advance taken. Outstanding expenses is a current liability. Remember, prepaid expenses were a current asset. So outstanding expenses is a current liability. Why? Because if we have outstanding salary, we need to pay very soon. All right. So these are the 2 main types of liabilities. There is one specific type called contingent liability that we will just discuss. That sometimes some events are uncertain, which can become liability for a business later on. Okay. For example, someone files a consumer case against a company, consumer complaint. Now they have only filed the complaint. The court has not given any judgment. No fine right now. So if there is no fine right now, then there is no liability. But soon there might be. So we have to be very careful that these contingent liabilities are not liabilities. At present, there is no liability. For example, litigation expenses against can lead to potential fine or payments. At present, there is no liability, thus they are not recorded in books of accounts or financial statements. There is no requirement there. It will lead to unfair disclosure if it is shown on the books, but it has to be disclosed in the notes to accounts. Okay, notes to accounts are statements after the balance sheet, which have to be added. There you have to declare all pending contingent liabilities also. In the insurance business, the entire business is of contingent liability. So there they have to mandatorily make reserves. However, suppose you give guarantee for your friend's business. If you give a guarantee that the friend will pay their loan, then in case only if the friend defaults, only then will you be liable. If the friend does not default, then you are not liable. Okay, so this will also be a contingent liability. Some foreseeable contingencies exist at times, such as the guarantee that we talked about. If you regularly give multiple guarantees, then it is foreseeable that you might have to pay, and therefore you will have to make reserves. We will discuss reserves in the next class when we discuss provisions and reserves as well as depreciation. Okay, so these are what contingent liabilities are. Let's move on. Okay, now we come to the preparation of balance sheet. This is important for the purpose of understanding what are the steps involved. Okay, steps involved in preparation of balance sheet. The questions in EPFO do not ask for practical. Do not ask for practical. Okay, only the steps involved are important, so that if you are asked a question on what will be entered in a balance sheet or omitted from a balance sheet, you have to be aware of these facts. Alright, we will just make a sample balance sheet by noting what the steps are. There are only two steps. First is to carry forward all real and personal accounts. The final balance in these accounts in the balance sheet. So this is the sheet which has the final balances of all real and personal accounts. Real accounts are on the asset side, we saw in the last class, and personal accounts can be on the asset side or the liabilities side. The next step is to carry forward the final balance of the profit and loss account for the year. Okay, so these are the only two steps that we will take. Let us begin with the sample. We first put the title, balance sheet of ABC Limited as on 31/03/2023 We make these two columns. You might be very familiar with these columns now. I make them very often. Assets on the right side, liabilities on the left side. Alright. On the asset side, first we put all the current assets. These are cash, closing stock, debtors, and then we put the fixed assets. Let's say land, machinery. Let's put some amounts to these. Say we have cash of rupees 1 lakh, closing stock of 50,000, debtors of 50,000, land of rupees 10 lakh, plant and machinery of rupees 2 lakh. So what is the total? The total is rupees 14 lakh on this side. Okay. Now we come to the liabilities side. Let's assume there is a bank overdraft of rupees 25,000. There are creditors, sundry creditors. Even if you don't write sundry creditors, it's fine. Creditors normally mean short-term creditors. 1,25,000. Then we have bank loan for rupees 4 lakh. This is, and then we have owner's capital for rupees 7 lakh. Okay. Please calculate. These will not be equal. This comes to 12.5 lakh. Then how is this possible? Because ultimately both sides have to be equal. This is only possible if the company earned profit for year rupees 1,50,000. Okay. This will make everything equal. There are entries at times which are called adjusting entries. This we have to do in the trial balance as well as the profit and loss account. But you, for the purpose of EPFO, you will not be required to make the entire accounting statements. You will not be given the entire balance to prepare. Therefore, you don't have to worry about this also. Okay. Just please understand the matching concept which says that assets have to match liabilities. This is the accounting equation and that has to be taken care of. We will discuss one question so that you can have your concepts very clear. Here is a practice question. Prepare a balance sheet based on the following details. Owner's capital rupees 1 crore, net profit for the year rupees 12 lakhs, rent paid during the year rupees 3.3 lakhs, outstanding rent is 0.3 lakhs, bank loan is rupees 20 lakhs, the bank balance for the company is rupees 31 lakhs, land and building is worth rupees 1 crore and closing stock is worth rupees 1.3 lakhs. Okay. These are the basic amounts. I am not going into the accounting treatment. Just prepare a balance sheet based on the following details. Alright, look at whether something has to go into the balance sheet or not, and then include it or exclude it. Take 5 minutes. We will discuss it right after 5 minutes. I hope all of you have been able to attempt this question accurately. Let us discuss the solution. We make the balance sheet as on date. Assets, liabilities, okay. So first entry was owner's capital. I am not putting it in the order that we have to. I am just putting it as it is. It does not make a difference for the purpose of accounting. Owner's capital 1 crore. Net profit 12 lakh. The next entry is rent paid during the year. Please understand, rent paid is an expense for the business. This has already been included in the net profit for the year. Therefore, we will not be including rent paid during the year. Then we have outstanding rent 30,000. Bank loan 20 lakh. On the asset side we come, we have bank balance 31 lakh. Land and building 1 crore. Closing stock 1,30,000. Okay, I gave a very easy question so that it is only to get your concepts correct. The mathematics is not very difficult in this. On both sides you will get 1 crore 32 lakhs 30,000 as the balance. Check it on the other side also, it is 1 crore 32 lakh 30,000. Okay, I hope everyone was able to get this question correct. If someone put rent or if someone did not put outstanding rent, please remember the basic concepts that all expenses have already been included. No other nominal account is put in the balance sheet. Outstanding rent, prepaid rent, accrued revenue, interest, etc. All of these will be a part of personal representative personal accounts. That is why they are included. So this was the reason why we came up with this answer. This was also the reason why I made this question. Okay, I hope concepts are clear. Moving on. We come to one topic called branch accounting. Now that we have discussed balance sheet, we can discuss how if one trading company I will stop using the word company. I will just say trading concern, because company is a specific form of organization. Trading concern is normally when I say it is a sole proprietorship. Okay. So if a trading concern has multiple offices or branches, then accounting requires multiple accounts. Why can't we make all of it in the same account? Because how will one accountant sit at 35 branches or 5 branches or 3 branches and make accounts? They will have to have separate accounts, separate cash registers, separate books, only so that they can ensure that books are clear, that nothing is being hidden from from the tax authorities as well as the auditors. They will need to have multiple registers to keep proofs of bills that they have. Okay. So many businesses have multiple branches. Many kirana stores also, big bazaar, etc. are very big examples which I have given, but even very small organizations sometimes have 2 to 3 branches, be it a dry cleaning store, be it any ration shop, grocery store. All of these will also have multiple branches. There are two systems of accounting. First is the debtor system and second is the stock and debtor system that we use in branch accounting to keep track of transactions and balances between head office and branch offices. Okay. We assume that there is one head office because this is normally the reality. Accounting is normally based on the reality. All assumptions match what happens in reality, because if the accounting principles and standards don't match reality, then people will evade the standards. They will evade or avoid proper accounts. So therefore, the accounting principles have to match reality so that people can practically ensure what they want to. So let us discuss these two forms, the debtor system and the stock and debtor system. The first system is the debtor system. In the debtor system, the branch keeps its own accounts receivable ledger and sends a periodic statement to the head office. Okay. The head office then records the transactions in its own accounts and includes the balance of the branch in its overall accounts receivable balance. Are you able to understand? Basically, the branch exists as a separate entity. There, they maintain their own accounts. Say, branch A has its own cash account, its own ledger, etc. And the head office only has one branch account, and in this branch account we measure the loss or profit of the branch, how much the head office owes the branch or vice versa, and the branch maintains its entire account. So this system is simple. It may be more suitable for branches with fewer accounts, with less transactions, that you simply maintain one account and Afterwards, you tally whatever the branch was doing instead of moving across multiple accounts. This is very simple. In this case, the branch account is a personal account. Okay. Why? Because we are dealing with the branch and the profits of every branch will be simply shown on the balance sheet. If I have 3 branches, let's say, so this is my capital, my profit will be shown as profit from branch A, branch B, branch C, so and so. This is all. So in this case, the branch account is a personal account. They maintain their own ledgers and then they provide all the details in a periodic statement to the head office, and the head office records the transactions in the official ledgers. End of story. Very simple transaction method. This is the debtor system. However, for example, let's say Big Bazaar has 135 branches. I am only giving you a fictional number. This is not a real number. But let's say a business has 135 branches. Some branches are making loss, some branches are making profit, and there is inventory which is the same across multiple branches. If this is the case, then how will the companies account for it? How will the trading concern account for it? They use a more complex system called the stock and debtor system. The stock and debtor system is where the branch keep tracks of both its inventory as well as accounts receivable and sends regular reports to head office about both. So in this case, the inventory is centrally monitored and every branch is responsible for debtors also. Okay. In the debtor system, the branch itself is a debtor of the branch of the head office, and any other debtor of the branch, say Mr. Sumit, buys 100 goods in the debtor system from branch A, then Sumit is a debtor of the head office only. In the stock and debtor system, if Mr. Sumit buys 100 goods from branch A, then Sumit is a debtor of the branch only, not the head office. This is the basic difference, that the branch keeps everything under its own tracking and accounting and ultimately sends reports. In this case, the branch accounts are nominal accounts. Okay. The head office maintains different accounts such as branch expenses account, branch stock account, etc. because sales are centralized, purchases are centralized. So the branch is only an extension of the main office. Extension of main office. The stock and debtor system provides more comprehensive information about the branch's financial position. Okay, because every branch records its own branch expenses, branch stock, etc. Whereas in the branch system, the debtor system, the branch only records how much sales it made. So this was the main difference. This is good for multiple branch companies which need to monitor more than two branches. Okay. So now we shall move on to the previous year questions. When are current liabilities payable? A. Within a year. B. After 1 year but within 5 years. C. Within 5 years. Or D. Subject to a contingency. The answer is A. Within 1 year. Remember, in the normal course, current liabilities are only within 1 year. Others are long term liabilities. Okay. So the answer is A, within a year. Let's discuss other questions. Another previous year question. Branch account under the debtor system is a real account, B, personal account, C, nominal account, D, liability account. We discussed the branch account in a debtor system is a personal account, whereas branch account in a stock and debtor system is a nominal account. Okay. So the answer is B, but this is a tricky question. People sometimes might confuse, so you have to have your concepts very clear. The answer is B, personal account. Let us also look at some practice questions just for the sake of revision for today's class. A lawsuit is filed against the business firm will be a current liability, B, long term liability, C, contingent liability, or D, capital expenditure. If a lawsuit is filed against the business firm, it will be a, the answer is C, contingent liability. We discussed this very example. Suppose a consumer complaint is filed, if you remember. So a contingent liability is one which is not reflected, not mentioned in balance sheet or income statement. Okay. The answer is C, contingent liability. We will discuss one more question. Repairs of plant and machinery will be shown in which account? A, expenses account, B, fixed asset in the balance sheet, C, current liabilities, or D, current assets. The repairs of plant and machinery will be shown in A, expenses, B, fixed asset in balance sheet, C, current liabilities in balance sheet, or D, current assets in balance sheet. The answer is A, expenses, because repairs are revenue expenditure. They keep occurring, they don't add to the asset cost. Therefore, it is fine. You cannot, it is not fine to add them to the asset cost and ultimately to the balance sheet. They will be shown as an expense and deducted from the profit and loss statement ultimately. Okay. This is the answer. Alright. See you in the next class. We will discuss depreciation as well as provisions for provisions and reserves. With this, we will come to the end of the entire treatment of financial statements, and afterwards we will start with accounting for partnerships, not-for-profit organizations and companies. Okay. Thank you. Hello everyone. Welcome to the 6th class for General Accounting Principles for EPFO. In this class, we shall be discussing depreciation, reserves and provisions. Okay, let us begin. We begin with depreciation. What is depreciation? Depreciation is the decline in the value of an asset on account of wear and tear or passage of time. This is on account, not an account. On account of wear and tear or passage of time. Okay. For example, the moment you take a car outside a showroom, you might purchase a car for 10 lakh rupees. But if you take it out of a showroom, you will be able to sell it at most for 9 lakh rupees. Similarly, after 2 years, the car will not go for more than 5 lakh. 5 lakh also, if you are very lucky. So, this is how assets lose value over time. And because this is a practical reality, that assets will lose value over time. Therefore, conventions in accounting provide for these situations. Okay, because otherwise, if we only record the historical cost, remember the cost concept, that we only record the historical cost of an asset. We don't record the present market value. That will lead to very wide disparity. All machines face wear and tear. All assets such as building or furniture, all of them reduce in value as well as in appeal, aesthetic appeal and utility. That is called depreciation. It is the decline in the book value of fixed assets. Depreciation is charged on all fixed assets except for land. Why not land? Because land appreciates. It does not depreciate, it appreciates, which means its value increases value in time. So land is a very special asset because it is limited. There is never going to be more land. You might have more cars in the future. You might have more machines in the future. But land is limited. Therefore, it will never depreciate in value. Depreciation is a non-cash expense. Okay. It does not involve any cash outflow. It is the process of writing off capital expenditure already incurred. So, for example, I spent 1 lakh rupees on a machine that will last for 10 years. Now, I am showing this machine on my balance sheet. I have already paid 1 lakh rupees. So whenever I depreciate for say rupees 10,000 every year, this will be shown as an expense, but this is a non-cash expense. I am not paying further 10,000 rupees to record this expense. This is only writing off an asset in the balance sheet gradually over time. Okay, that is why depreciation is a revenue expenditure. Depreciation does not decrease the value of an asset. Depreciation is only an expense which adds to profit and loss account, and ultimately the value of assets, let's say machinery, goes down, but it is not charged on the balance sheet as directly depreciated. Understood? Let me explain if this was slightly complicated. Suppose I have 100 sarees as goods. They are worth 10,000 rupees. I sell 10 sarees. Now I have sarees in stock worth rupees 9,000. Okay, this is because I can measure if 100 sarees are worth 10,000 rupees, then 10 sarees are worth 1,000 rupees. But what happens if I have one machinery for 1 lakh rupees? I can't sell or I can't lose 10% of the machinery, right? It's not as if some 10% of the nuts and bolts of the machinery or pipes of the machinery are going away. It is only the book value of machinery which is going out. So there are two ways of showing depreciation. Sometimes on the balance sheet we show machinery something less depreciation something, and then we show its book value. Other times we only show the final book value, direct book value. But in both cases, this depreciation is only shown as rough work. Rough work. It is not shown on the balance sheet because it is not a capital expenditure. Okay. Now we come to the concept of amortization. Amortization means gradual death. Okay, the word mort means death and amortization means the process of dying. Amortization refers to writing off the cost of intangible assets which have utility for specified period of time. For example, if I have a patent for 20 years, that is the validity of a patent as per the Indian Patent Act. So if I have a patent which is valid for 20 years, then if I buy it for rupees 20,000, I will have to write it off. After the end of 20 years, its value will be rupees 0. Therefore, this is how I will buy it, write it off. The only difference between depreciation and amortization is that depreciation is for tangible assets. Tangible are physical assets that we can touch or feel. Building, machine, furniture, car, all of these are tangible physical assets. Amortization is for intangible assets. Some examples for amortization are patents, assigned copyrights. Copyright itself does not have to be registered. Only assignment of copyright has to be registered. Trademarks, except for well-known marks. For example, if I trademark a name, let's say Ernie. If I trademark this name, then the trademark lasts for 10 years. But for a big well-known name such as Mercedes-Benz, for these well-known marks which are known to the entire world, even if their trademark expires for 10 years, you cannot trademark these names. Cannot trademark them. They are known to the world already and therefore they are protected separately. Other examples for amortization are franchisees. If I have a franchisee, let's say I have a McDonald's franchisee or a Subway franchisee, I pay royalty for 5 years to own a restaurant in the name of this franchisee. Alright, so that will have limited value. These are all for specified periods of time. What is goodwill? We will discuss goodwill properly when we discuss accounting for partnerships. But in short, goodwill is when we buy something over its market value, for its reputation. The extra cost paid is for goodwill. Goodwill is also not permanent. Over time, whatever goodwill, suppose we buy a company which has a lot of goodwill because we want to expand to another market. Now, let's say I am in Delhi, this is Jaipur. I want to expand into Jaipur, so I buy. If I am in the textile business, I will buy a good textile company of Jaipur which has a lot of goodwill and then make them into a branch of mine. But what happens is that goodwill, it's also not permanent. It will also go with time. So I expect that the goodwill will last for 15 years. If that is true, then I will write off the goodwill that I have extra purchased over the period of 15 years. Okay. How do we calculate depreciation? Depreciation is the gradual writing down of value of any asset. The depreciable cost of an asset is the asset cost minus net residual value. What do I mean with this? Suppose I have a Bajaj Chetak scooter. Okay. I bought it for 40,000. Now I know that even if I sell it 20 years later, it will still sell for 5,000 rupees at least, or 1,000 rupees. I am only giving you a hypothetical case. So if it is sold after 50 years or 20 years or 5 years or 10 years, it will always bring at least 1000 rupees. Then that is its net residual value. Okay. The net residual value is subtracted from the asset cost. Then we have 39,000 rupees as the depreciable cost. Depreciable cost is what will be deducted over the expected lifetime. So the formula for depreciation, we will discuss both methods actually. So I will not give you the formula right now, but I hope this was clear that most articles can have at least some net residual value. Even if I buy machinery, it will have some net residual value as scrap metal, right? I can at least sell it to a raddiwala to ensure that there is some value that is realized even at the last stage of it. The rest will be written off. Alright, it will be written off over a reasonable amount of time. Suppose I buy a machinery and it is expected to last 10 to 12 years. But if it ends up lasting for 20 years, that is my gain. That is my unrealized gain. Okay? That is not something that I am going to pay for. That is something that I have already accounted for, that I should have lost in 10 to 12 years time. This is all. There are two methods for calculating depreciation. First is the straight line method and second is the written down value method. We will discuss both of these methods. Both of them are allowed in India depending upon the final asset in question. So for some assets, it is said that the depreciation shall be charged under the written down value method. For most assets, it is the written down value method. For a few assets, it's the straight line method. Okay, I will tell you both of them. Let us look at these methods. First is the straight line method. The straight line method is also called a fixed installment method. Why is this called these things? Because if we plot the graph of depreciation, we charge the same amount every time. So depreciation in 2020, 2021, 2022, 23, 24, all of this for machinery of 1 lakh, assume this is 10,000. So it was 10,000 in 2020, 10,000 in 2021, 10,000 in 2022, and so on and so forth. So this is cutting out fixed installments from the value of machinery. This method is based on the assumption of equal usage of asset over its entire useful life. According to this method, a fixed and equal amount is charged as depreciation in every accounting period during the lifetime of an asset. The formula, please have a look. The formula for the straight line method is cost of an asset minus estimated net residual value upon estimated useful life of asset. So if I have a 40,000 rupee scooter which has 2,000 rupees worth net residual value, and I know that it will last me 10 years, then I will deduct as 38,000 upon 10 is equal to 3,800 rupees. This is the depreciation which will be charged every year in a straight line. Alright, this will keep going on in a fixed manner. This is only for assets where the assumption is there is equal usage of assets. You will understand this better when we discuss the written down value method. Please note the slide. I am moving on and erasing everything. The written down value method is also known as the reducing balance method. Okay. Under this method, depreciation is charged on the book value of the asset. This method involves application of predetermined proportion or percentage of book value of the asset at the beginning of every accounting period so as to calculate the amount of depreciation. The amount of depreciation reduces year after year. For example, if I buy a machinery of rupees 1 lakh and depreciation is to be charged at 10% every year, then in the first year depreciation will be 10,000. In the second year, because the asset value will be now 90,000, depreciation will be 9,000. Then it will be 8,100, etc., etc., and so on. So if you are to plot a graph of the written down value method, it will look something like this. First it will look like 10,000, then a much lower amount at 9,000, then 8,100, then 7,290, etc., etc. This will never come to zero. Never. Why? Because even if it reaches 10 rupees, the next year only 1 rupee will be charged, so value will be 9 rupees. Then 0.9 will be charged. So you can never reach 0. This allows for longevity of asset. Okay, because book value depreciation is charged, so we are gradually reducing. Sometimes it is also prescribed what percentage charged when. So it can say first 5 years 5%, next 5 years 7%, etc., depending upon the life cycle of different assets. So this is very complex depending upon the nature of the asset. Different authorities prescribe rates of depreciation. But one thing is common is that the amount of depreciation reduces year after year. This is the preferred method for depreciation. Okay. Depreciation is prescribed in Accounting Standard 6 The AS6 provides guidelines for calculation and disclosure of depreciation, including the various methods that can be used. These are the straight line method as well as the written down value method. The AS6 requires company to apply method of depreciation that best reflects the pattern of consumption of assets' future economic benefits. So, if the company is aware that one asset will last 30 years, let's say solar panel. Solar panels have very long life, 25 to 30 years minimum. Then you will charge depreciation accordingly, because their productivity is not going to go down after the first 10 years. So you will charge depreciation at a rate of 3% probably. Okay. So the companies are required to apply the method that best reflects the pattern of consumption of assets' future economic benefits. Okay, this is as per Accounting Standard 6. In India, both straight line method and written down value method of depreciation are used, but the written down value method is the more commonly used method of depreciation. Why is this so? This is because the written down value method of depreciation allows companies to claim higher depreciation in the initial years of assets' useful life, when the asset is likely to be more productive. Lower depreciation is charged when the asset is less productive. For example, if I have one machine that can make 100 sarees every day, if initially I am charging depreciation at 10%, it is fine. I am losing a lot of value. Say I am losing 10,000 rupees in depreciation expense, but simultaneously I am also probably making 1 lakh rupees because of the sarees that it is providing. On the other hand, 3 years later, if the machine slows down because of wear and tear and makes only 50 sarees every day, then I am only allowed to charge 5,000 rupees of depreciation, but I am also making less, 50,000 instead of 1 lakh. So therefore, I am harmed less. Okay, the loss that I face, or the loss that I have to show in my balance sheet, is also less if for example the machine was producing 100 sarees in the beginning and 50 sarees 3 years later, but I was charging 8,000 rupees depreciation in the straight line method. Then what would have happened? In later years, there would be more loss from this machine because it is producing less, but it is showing an expenditure at a constant level. Okay. Moving on. Now, let us look at the legal treatment of depreciation. The Income Tax Act also provides rules for calculation of depreciation for tax purposes. Under the Income Tax Act, companies are required to use the written down value method of depreciation for most assets, while the straight line method is used for specified assets such as buildings. Why? Because you keep using buildings in the same manner. Suppose I have a warehouse which can store 40,000 cartons. If I have such a big warehouse, then 10 years later I will still be able to store 40,000 cartons. Therefore, the value of the asset will be reduced constantly. Okay. Schedule 2 of Companies Act provides for various rates of depreciation for many assets. It provides what kind of electronic machinery etc. have to be written down in how many years. Alright. So, this is the depreciation concept. To apply depreciation, we use a depreciation expense depreciation account, but this comes into play when we are selling an asset. Okay, when an asset is sold, a new account, namely asset disposal account, is created. For example, if I have one machinery for 1 lakh rupees, 5 years later I am selling it. ₹1,00,000 and I am selling it after 5 years. Now how do I know what is the profit or loss on it? We ascertain the profit and loss through an asset disposal account. This also takes into account that sometimes we are not reducing the book value. We are sometimes not reducing book value of assets. Sometimes we are only creating a provision for depreciation. Okay. What is provision for depreciation? Depreciation is an expense. I will explain. So we make a separate account, a separate personal account called provision for depreciation. Okay. Now, this provision for depreciation account is an expense account effectively. This will appear on the balance sheet because it's not a nominal account. It will not be closed down. So, when we have assets and liabilities, let's say machinery for rupees 1 lakh, we can have provision for depreciation rupees 18,000 over the course of 3 years. Every year, if I am charging 6,000 rupees of depreciation, then instead of reducing value of 6,000, I will simply add 6,000 to this provision, because this way the value of the machine remains on the balance sheet, and ultimately it does not matter if I am subtracting 6,000 from the right side or I am adding 6,000 on the left side, the balance sheet will be equal. So companies mandatorily have to have a provision for depreciation. It is mandatory for companies. For trading concerns, you can directly reduce the value of assets also. So for companies which have to maintain a provision for depreciation, when an asset is sold, they have to make a new account, an asset disposal account. A disposal account is a gain or loss account that appears in the income statement and in which there is a recorded difference between disposal proceeds and net value of asset. Let us see how this is done. Suppose we provide for machinery cost 5 lakh rupees. Okay. Provision for depreciation account says that the accumulated depreciation over all of these years is 1,30,000. Okay. And suppose the bank value for which we have sold is 4 lakh rupees. Now, what is the total on this side? On this side it is 5,30,000. Why? Because 5 lakh was the cost, 1,30,000 is depreciation. So the cost should have been 3.7 lakhs. But because we sold it for 4 lakh, so the profit on asset disposal is rupees 30,000. Okay. This 30,000 profit will be carried on to the profit and loss account. So this is how an asset disposal account functions. You will simply create an asset. This is only for companies, please mind. Normally a trading concern can also make but it is not necessary. Alright. So I hope this account is clear. If there is a profit, okay, let us take another example. Say the value was 5 lakh, the depreciation was 1,30,000, but we could sell it for 2 lakh only. Now this is 5 lakh, this is 3,30,000. There is a loss of 1,70,000. This will also be carried on to the P&L account. Okay, this will be carried on as a loss. So ultimately this will be shown on the asset side. Asset side we will show loss, or we will directly for for sole proprietors we directly reduce the loss from capital and we add profit to the capital. For companies as well as for partnerships, it is mandatory to not add profits directly to capital but to distribute them according to legal measures. We will discuss this when we do accounting for partnerships, NPOs and companies in the later classes. Okay. Now we will discuss what are provisions. So the brief description, the definition is that a provision is the amount that is generally put aside from the profit in order to meet a probable future expense or reduction in asset value, although the exact amount is unknown. Okay. There are certain expenses or losses which are related to the current accounting period, but the amount of which is not known with certainty because they are not yet incurred. For example, depreciation. for various assets, the actual depreciation of how much wear and tear happened is not known. We can only estimate. Similarly, for tax liability, this is also not for sole proprietors. Sole proprietors, please remember I had explained that the tax for sole proprietors is paid by the proprietor because it is a personal tax. But for companies, they have to maintain a separate provision for taxation. Okay. So, in the beginning of the year, you will not know what your tax liability is. No idea. But you still have to make a provision so that you have predictability. If the tax liability is slightly more, then that can create some hurdles, but otherwise you had predictability on what the expected tax liability is going to be. This is in line with the prudence principle or the conservatism principle, that expect or anticipate all losses but expect no profits. So therefore, we look at some examples: provisions for depreciation, provision for bad and doubtful debts. What are bad debts? Bad debts are basically not non-performing assets for banks. And if I give a loan to a vendor, so to a debtor, that I am giving you goods on credit, please pay me the actual cost within 30 days or 6 months, and the person fails to pay, then they will be a bad debt. Doubtful debt are people who are unlikely to pay but have not failed yet. Okay, if they have not failed but they are unlikely to pay, they are doubtful debts. Then provision for taxation, we have already discussed that if we anticipate the tax liability, then we can make a provision for taxation. Provision for discount on debtors, if we know that we are going to give discounts over the year, then we have to make for provisions, because that is in line with the prudence principle, that we make discounts for debtors. It happens in the normal course. Then we have provisions for repairs and renewals. If it is anticipated that there will be some breakdown of machinery, if normal practice has told us that once every 3-4 months we need to call the electrician or the AC repairman, etc., then definitely we need to have a provision for repairs and renewals also. So these are the basic principles, the basic examples of a provision. It is the amount that has to be put aside. It is a personal account. Okay, a provision is a personal account. It shows on the balance sheet. Okay, let us now discuss the accounting treatment of provisions. Okay, how they are treated in the profit and loss statement and the balance sheet. So in the balance sheet, the amount of provision may be shown by way of deduction from the concerned asset on the asset side. For example, I can have an entry for depreciation debited to machinery. If this is an entry, then provision for depreciation is a deduction from the concerned fixed asset. Another possible entry, although it is sometimes unnecessary, is depreciation debited to provision for depreciation. Understood? Depreciation is an expense. Expense is debited. This is a personal account. What was the rule for personal accounts? Debit the receiver, credit the giver. So, if we are giving way to provision for depreciation, we will credit it. Okay? And ultimately, this provision for depreciation, we can show it on the liability side of the balance sheet along with current liabilities, or we can deduct it from the concerned asset on the asset side. I told you both of these will have the same impact. If there is an asset worth rupees 10 and liabilities rupees 10, and I reduce 1 rupees of depreciation, it will be 9 rupees, and here there will be 1 rupees of capital reduction. This will be also 9 rupees. On the other hand, if I show it as a provision, then there is an asset of rupees 10, there are liabilities of rupees 10, from which expense is reduced for 1 rupee. So this will become 9. I will write in more space. Suppose in the asset side there is 10 rupees worth of asset, in the liability side there is 10 rupees worth of capital. Now 1 rupees depreciation has already been charged to the profit and loss account because it is an expense on the business. So if it has already been charged to the profit and loss account, this will reduce, so this will become 9, and we also show a provision for depreciation of rupees 1. So this will remain 10. So either it will reduce the value of both or it will stabilize the value of both. It depends. Both of these accounting approaches are valid. Okay. The total on the balance sheet is not of any importance. It is the ratios which matter. Okay. So these are the two ways in which we can account for the provisions. Now we come to reserves. Reserves are parts of profit which are set aside and retained in the business to provide for future needs like growth, expansion, or meeting future contingencies. What can be done with profit? Otherwise, the owner takes profit home, so either the owner takes the profits home or they can save and reinvest the profits. So if they reinvest the profits, they are invested in the form of reserves. Okay. Reserves are saved on the liability side of the business. Let's say there are 12 rupees worth of assets, 10 rupees worth of capital. We earned 2 rupees of profit. So either we could add 2 rupees to the capital, this would make it 12, or we could make a general reserve of 2 rupees, which would also make both of the sides 12. Okay, we can use, then these reserves are the property of the company, not of the owner. So we can have a general reserve which is for not any specific purpose, or we can have specific reserves such as workman compensation fund, investment fluctuation fund, capital reserve, dividend equalization reserve, reserve for redemption of debentures, etc. Companies have to maintain this. Okay, these are important because the companies do not have one single owner, and if they give everything to the shareholders, then they may not have enough to pay the workers if a contingency arises, if workers demand extra wages, or if there is a lockdown, or if workers have to be laid off. We will discuss this concept when we discuss labor law properly. But these have to be maintained. Investment fluctuation fund is when the companies have investments in shares, securities, etc., and they are representing them in the balance sheet. Then you need to have an investment fluctuation fund, so that if your value of securities goes down drastically, you can protect yourself against significant losses. For example, the share markets keep crashing once in a few years. You have to protect yourself, and for this the companies need to make a reserve. Capital reserve is a reserve made from sale of capital assets, fixed assets. These are used to buy more assets, buy more capital assets. This helps the companies undertake capital expenditure. Dividend equalization reserve is once again for the payment of dividend to multiple categories of shareholders. We will discuss this when we do companies. And reserve for redemption of debentures, when companies issue debt instruments such as debentures, they have to make a reserve for the redemption of debentures. We will do this also in the companies portion. But basically, this is what a reserve is all about. Okay. Then we come to a concept called secret reserve. A secret reserve is one which does not appear in the balance sheet. It is not fair to have a secret reserve. It is against accounting principles. It may help to reduce the disclosed profit and also the tax liability. Okay. Sometimes companies do this. They don't want to pay so much tax if they have earned too much. Then they will not be willing to pay tax, not paying tax. So they will have to hide the money somewhere. So they hide the money using various legal provisions such as charging higher depreciation than what is required, undervaluation of inventories or stock, making excessive provision for doubtful debts, for showing contingent liabilities as actual liabilities even if they haven't occurred, and then they siphon off money into secret reserves. This is illegal, and tax authorities closely monitor how reserves are going to be utilized. Okay. So this was basically a secret reserve. There are two kinds of reserves. Let us discuss. First is capital reserve and second is revenue reserves. These are multiple types of reserves. A capital reserve is one which is created to finance long-term projects for a business. Okay. Setting up of a new factory or expansion into new territory, etc. All of this requires a lot of capital. So companies start saving capital and putting money in the capital reserve. The revenue reserve is created to meet unforeseen events in a business organization. For example, loss by fire or damage because of theft. All of these have to be met by the revenue reserve. Okay. Capital reserve is specifically required in accounting principles. When there is a sale of a fixed asset, a company cannot simply take that money and run. Cannot take it and run. They have to put that money in a capital reserve which will be used for capital expansion purposes. Same with loans. You cannot, if you have taken a loan for a purpose, you cannot spend that money from the loan in another way. You have to spend it in the way that you have disclosed. So all of these will go to capital reserves. Revenue reserves are only to be used for reinvestment for the company. You can hire more people in urgency, or you can spend it in different manners such as special contract agencies, etc. Capital reserve cannot be used as dividend. This is earmarked for a special purpose. Earmarked. Revenue reserves such as general reserve. General reserve is one example. They can be used for dividend payout. They do not have any charge upon them. Okay. Capital reserve is created by sale of fixed asset, whereas revenue reserve is created from retained earnings. So if it is created from profit, from normal profit, then you can use it for other purposes. If it is created from capital profits such as windfall gains on sale of machinery, profit on sale of land, etc., then you have to maintain a capital reserve. Okay. I hope this was clear. Let's discuss a previous year question. Depreciation of fixed assets is an example of, we discussed, it is an expense. It's a revenue expense. It is deducted in the profit and loss account and then later added to a provision for depreciation if need arises. Okay. It's a revenue expenditure or expense. So with this class, we come to an end of the general accounting principles for a sole proprietorship. From the next class, we will begin accounting for partnerships, then not-for-profit organizations and companies. Okay. There will be a few classes on these topics only to ensure that we cover the entire syllabus holistically. Okay, thank you. Hello everyone, welcome to the 7th class for General Accounting Principles for EPFO. In this class, we will discuss accounting for not-for-profit organizations or NPOs. Okay, let us begin. So, not-for-profit organizations or NPO is basically an organization whose sole aim is to provide service either free of cost or at nominal cost, not to earn profit. Okay. Under Section 8 of the Companies Act, these companies are registered as not-for-profit entities. Therefore, these are also called sometimes Section 8 companies. Section 8 companies you might have heard when you listen to any tax debate, if at all you listen to tax debates. So these Section 8 companies are basically not-for-profit entities. There are many examples such as educational trusts. Tata Trust is a major set of social trusts, NPOs, which are registered under the Income Tax Act. These not-for-profit organizations receive tax benefits of different kinds, donations to them are also exempt sometimes depending upon the category. This will be out of our syllabus. This is not a tax course. For the purpose of EPFO, we just need to understand what are not-for-profit entities, okay, not-for-profit organizations. Over the course of this lecture, I will use the word NPO very often. Whenever I say NPO, it only means not-for-profit organization. Other NPOs can be clubs such as sports clubs. Manchester United is an NPO. Then there are other clubs such as breakfast clubs, so on and so forth. The Brahma Kumaris or religious organizations. Please remember, accounting for NPOs is similar even if not registered under Companies Act. You can be registered under Societies Act, Trust Act, etc. There are many state laws also. Separate states such as Andhra Pradesh, Maharashtra, etc. have different laws for trusts as well. But the accounting format for them is more or less similar. The same actually. So let us begin looking at the sources of the income for not-for-profit organizations, NPOs. The main sources of income of such organizations are, first and foremost, subscription of members. This is the most important source. For many clubs, Gymkhana, etc. These are clubs and they rely on the membership subscription. Okay. The next most important are donations. So especially for religious organizations, donations are the primary form of income. Okay. The third part are legacies. Legacies is when someone leaves property or cash in their will. What is a will? When someone dies, passes away, they can leave a will to say how their property will be distributed. So they can sometimes, many people leave their wealth, either all or some part of their wealth, to charitable organizations. You might have heard Warren Buffett or Bill Gates. All of them have pledged their wealth to charity. So it is basically that upon their death, their wealth or a good portion of it, many of them have pledged 99% of their wealth shall go to charity. So one can do this through a will. The next is a granted aid. A grant in aid is basically financial support from government. Normally these are tied to projects. For example, if government wants to partner with any NGO for midday meal programs that the government runs, then they will provide for a grant in aid to the NGO. Okay. The last is income from investments. This is very similar to a sole proprietorship that we have already discussed. Sometimes the charitable trusts etc. have surplus funds which they invest. So the income from investment such as interest, dividend, all of this is also income for the NPO. I hope this is clear. Moving on. So because NPOs are different from business organizations in a core manner that they are not going to earn profit. We saw in the earlier slide that their main purpose is to provide charity or membership benefit. Thus, they are not providing, not selling goods or services. Understood? As a consequence, there will not be any profit. It is in the name that they are not for profit. So, we have two different forms of account. The first is the receipts and payments account. The receipts and payments account is basically a year-long cash book that is prepared at the end of the accounting year. It only provides what came in, what went out in a summary form, the same way as a cash book does for every cash transaction. Receipts and payments account does the end of year for all receipts and payments. We will discuss this further also in good detail. Then we come to the income and expenditure account. The income and expenditure account is basically a replacement for profit and loss account, because the NPO is not having any profit or loss. It is not conducting operations for the purpose of profit and loss. So it can only have income and expenditure, and whatever is the surplus might be transferred as surplus balance, or it might be running a deficit balance. That is all. If they are not for profit, they can't make a loss either. Okay. The third is the balance sheet. Balance sheet is based on the same principles that the accounting equation of assets equal to liabilities plus capital. This accounting equation will be maintained even in the balance sheet. There are some differences in the items which are put on the balance sheet, but it is still based on assets and liabilities only. Okay. So first we come to the receipts and payments account. Receipts and payment account, as I told you earlier also, is a summary of cash transactions based on the cash book. Okay. The main difference here is that a cash book is prepared on daily basis, whereas receipts and payment account is prepared at the end of the accounting year. This is also a flow statement. It records all the transactions that happened during the year. Okay. The receipts and payments account serves the purpose of trial balance and becomes basis for preparing financial statements. So this R&P account is what ultimately is used to prepare both the income and expenditure account as well as the balance sheet. Remember, for NPOs, the financial statements are income and expenditure account and balance sheet. Receipt and payment account is not financial statement. So in the receipts and payment account, all cash receipts and payments are recorded. All cash receipts and payments are recorded in this account, whether they belong to the current year or next year or previous year. Okay, this is unlike what we used to do in the balancing for companies, for business organizations, where only current year was measured. In this R&P account, we only provide for what was received and what was paid. Okay, this is to ensure that, because NPOs are not complex organizations, normally they are not complex organizations, so they should have ease of accounting. So to boost ease of accounting, we have provided them certain leeway or relaxation in the kind of account they have to maintain. So they don't have to maintain full ledgers at times, but bigger NPOs normally maintain a ledger also. Okay. all receipts and payments are recorded in this account, whether these are of revenue nature or capital nature. All receipts are recorded on its debit side, whereas all payments are shown on the credit side, in the same manner as we have for the normal rule in real accounts, that debit what comes in, credit what goes out. In the same way, receipts are on the debit side and payments are on the credit side. But please remember this very crucial difference. All revenue as well as capital receipts are mentioned together. Okay, this is the basic theory for receipts and payment account. This is what a sample receipts and payment account looks like. I have taken one sample from Zenith Golf Club. Mostly all NPOs that you will find are either sports clubs, gymkhana, or some religious organization, some charitable trust organization, some educational society, welfare society, etc. Okay, so we see on the receipt side, first we have balance brought down. Balance brought down is previous year's balance. Then we have subscriptions. Please see, we notice that subscriptions are the main source of income for most clubs. For the year ended 31 December 2017. So this is for 2017. The subscriptions are for 2016, 2017 as well as 2018. The receipts and payment account is recording all types of subscriptions. Okay. Then they have concepts of entrance fee as well as interest on investment. On the other hand, in the payment side, they have sports equipment which they paid for, support equipment that they paid for. This is 20,000, and support equipment, when they normally mention the word equipment, it is a capital expenditure. However, it is recorded in the same manner as revenue expenditure. Then we also see tournament expenses, electricity, printing costs, salaries and wages. Okay. Exhibition expenses and balance carried down. Balance carried down is when amount is basically the balance account for cash and bank. So this is how a receipts and payment account looks like. Please have one look and then we will move on. Okay, I hope this is clear. We will move on to the income and expenditure account now. Okay, before this we have a practice question. Actually, we will do this practice question after we are done with the income and expenditure account. We will discuss it. There is one more concept of honorarium. So on the receipt side, we saw payment of receipts of subscription are the main form. There are donations, legacies also. We will also discuss life membership fees briefly. But subscription is the main part. On the expenses side, there is something called honorarium, which is mostly given by NPOs only. This is an amount paid to persons who are not employees of the organization but take part in management of the organization. People such as trustees, elected board members, all of these are not employees. They are acting charitably. So to honor them for their charitable contribution, we give an honorarium. This is remuneration for contribution. So this is recorded on the receipts and this is recorded on the payment side of receipts and payments account. Okay, there is no limit. There is no limit as such on what can be paid as honorarium. For example, some education society might call a retired judge to give a lecture or to take a short course. Some law society, law education college might call a retired judge to take a law course, and they might pay 2 lakh rupees to the judge. That is also fine. That is not wrong. Unless there is money laundering, there is no limit as in law for how much can be paid as honorarium. Okay. We will come to the income and expenditure account now. The income and expenditure account is the summary of incomes and expenditures of the organization of a particular year and is prepared at the end of the year. This is also a flow statement. We discussed what is a flow statement in the class on financial statements. This account is similar to profit and loss account of business organizations. However, this is maintained for non-trading concerns. Okay. Trading concerns can have profits, losses. When we say concern, we mean enterprise, any organization. So trading concerns can have profits, non-trading concerns cannot have profits. So whenever there is a non-trading concern, they will have a income and expenditure account. It is a nominal account. Please also remember the receipts and payments account is also for non-trading concerns only. Okay, both are nominal accounts and both will be closed at the end of every year. R&P account as well as I&E account, receipts and payment, income and expenditure, they are only for non-trading concerns. In the income and expenditure account, only revenue expenditure and revenue income of the year for which income and expenditure account is being prepared are taken. Okay. So unlike the receipts and payments account where capital receipts are also allowed, here in the income and expenditure account only revenue expenditure and revenue income is taken. Therefore, we have to look at two things. First, that the transaction is of revenue nature, not capital nature, and second, only of that year, not previous year or next year. Okay, why? What will happen to receipts of previous year or payments of previous year which are made this year? Remember, they are personal accounts, representative personal accounts for outstanding or prepaid monies, and they will go to the balance sheet. Not the income and expenditure account. Okay. Please have a look at a sample income and expenditure account. After this, we will start with the practice question. So this is also for the same entity, an income expenditure account for the year ended 31st December 2017. Now you recall some prices are the same. The exhibition expenses, salaries and wages, printing, electricity, tournament expenses, all of these are there, but the support equipment that was purchased is not there. Why? Because that was capital in nature. Similarly, this has a concept of depreciation. Depreciation on support equipment and furniture that was not mentioned in the receipts and payment account. Why? Because depreciation, we saw in the last class, is a non-cash expense. Thus, it will not be in the normal category of cash expense, which was what the receipts and payments account was measuring. Okay. So only the revenue expenses and revenue income of that year is to be added. Now we come to the income side. In the income side, let us look at subscriptions. This is 37,000 subscriptions have been added. The subscriptions received in 2016, this is the year 2017, those received in 2016 were advance subscription. Okay. Advance subscription is what was received last year. This was not in this year's R&P account because it was received last year. But this pertains to this year, that is why we make a column in the income and expenditure account. Now we say subscriptions in arrear, we add because this is due this year. Even though we have not received yet, we might receive it next year, but even then this is supposed to be our income for this year. And we have interest on investment. This was also mentioned in the normal course of this year's incomes in the receipts and payments account. So we see the balances match because we add the excess of income over expenditure as rupees 17,500. This is more frequent in clubs than for companies, that many people don't care to pay subscriptions. They take their own time because these are informal or recreational in nature. Informal, recreational in nature. Sometimes it is only by peer group. So people fail to pay subscription on time. So all of these arrears have to be accounted for. Okay. Okay. Now let us come to the practice question that we were supposed to do earlier. With the income and expenditure account concepts being clear, I think this is a better time to approach this question now. The question is, how are the following items of subscription shown in the income and expenditure account for the year ended 31st March 2018 and balance sheet as at 31st March 2017 as well as 2018. Okay. So please understand that in this question, 3 statements are required. First is the income and expenditure account for 31st March 2018. Second, balance sheet for 31st March 2017 and then balance sheet for 2018. There are 3 accounts which are required in this question. Let's look at the sums which are mentioned. First, subscriptions received during the year ended 31st March 2018. Okay, 3,58,500. So these are all the subscriptions received, be it previously due or advance subscriptions. Okay. Subscriptions outstanding on 31st March 2017, rupees 30,000. Third, subscriptions received in advance on 31st March 2017, rupees 22,500. Fourth, subscriptions received in advance on 31st March 2018, rupees 13,500. Fifth, subscriptions outstanding on 31st March 2018, including 12,500 for the year ending 31st March 2017. Okay. So, subscriptions outstanding for the year ended 31st March 2017 was rupees 30,000. On 31st March 2018, this was 37,500, of which 12,500 was for 31st March 2017. This is a complicated question. Please take your time. Let us take 5 minutes. We will take 5 minutes to attempt this question. If you want more time, please pause the PPT and attempt it even further. Okay. Remember, you have to make 3 accounts. All of these 3 have to be, and balance sheet, don't worry if the balance sheet does not tally. I am only giving the amounts, not the assets and liabilities. This is not about matching the balance sheet. Just mention the amounts in the balance sheet for what is outstanding and what is advance correctly. That is all that you have to worry about. Don't worry if the balance sheet doesn't tally, it is not going to. Okay, please start. And also remember that making of accounts is not directly important for EPFO paper. It is the concepts that I am trying to make you comfortable with that will ultimately help in the solving of EPFO papers. Many times they have asked numerical questions which require application of concepts. Therefore, having a difficult question like this will allow you to have better application skills of these concepts. Now take 5 minutes. We will commence after 5 minutes. Okay. So time is over. I hope you were able to attempt this question at least. I will now give the solution. Okay. Please have one last look at this entire board. We will move to the solution. So the first account that we had to make was the income and expenditure account. income and expenditure account for year ended 31st March 2018. Okay. Let's leave the debit side. There are no payments this year. It's only the income side or the credit side which matters. Okay. So we have subscriptions received, which is 3,58,500. I will put the final amount here. We normally don't put the rough amounts in the actual balance. Okay, we have this rough column only. So we have subscription received during the year. Then we add outstanding subscriptions at the end of the year, which is 37,500. Then we add advance that was received in the beginning, for rupees 22,500. Please remember that the advance that we received in the beginning on 31st March 2017 pertains to the present year. That is why it was an advance for last year. And because the income and expenditure account has to take in all incomes meant for the present year, we will take in this advance as added, even though we did not receive it in this year. Okay. Now we come to what we have to subtract. So we will subtract what we what does not belong to us for this year. What was outstanding for last year is something that we can't include. So we have minus 30,000. We also subtract advance for next year that we have received, because that is not for this year. Advance for next year is 13,500. Please understand, what was outstanding for 31st March 2017 does not matter in this accounting treatment. It will matter when we discuss the balance sheets for the 2 years. Okay. So we'll calculate 3,58,500 plus 37,500 plus 22,500. This becomes 60,000 minus 43,500. So we get a total of 3,75,000. Okay. There is nothing required on the debit side. This is all in the credit side only. Now let us prepare the balance sheets for the 2 years. There is a space constraint. I will use the debit side and a different color pen. Okay. So first let us discuss balance sheet for 31st March. Balance sheet for 31st March 2017. Okay. Assets liabilities. Remember, matching is not necessary, you just need to know what amount goes where. So outstanding subscriptions on this date were assets. Outstanding subscription rupees 30,000, and on the liability side we have advance subscription. Why is advance a liability? Because members can claim it in the next year. 22,500. This 22,500 later on was appropriated in the year it was meant to be appropriated. Okay. Now we come to balance sheet for 31st March 2018. Liabilities, assets, outstanding subscriptions. We have 37,500. And subscriptions in advance, we have 13,500. I hope this was clear. Please note some concepts that I will just give a brief explanation once again, that the 12,500 that was for the last year is irrelevant because it is going to stay outstanding only. Later on we will only deduct it from the next financial year. Okay, the rest I think is clear. Let us move on. We come to the balance sheet for not-for-profit organizations. Every NPO prepares balance sheet at the end of the year. It also has the same asset side and liability side as we saw. However, there are three different treatments that we will look at. First is the treatment for donations, second is the treatment for legacies, and third is the treatment for life membership fees. Okay, these are some things that normally business organizations do not have. It is only that charitable organizations will receive donations, legacies, or clubs might receive membership fees. Okay, so let us discuss the different types. First, we come to donations. It is a sort of gift in cash or property received from some person in organization. It can either be cash or property. It appears on the receipt side of the receipts and payment account. Okay, there are two kinds of donations. First is the specific donation. Specific donation is received to utilize to achieve specified purpose. For example, let us say there is a environment fund for a regional organization that can only be used for afforestation or tree plantation drives. Such a donation is to be capitalized and shown on liability side of the balance sheet. Why? Because this is not income but a grant. Not income, it is a grant for the business for a purpose. Okay. The second category is a general donation. A general donation is to be utilized to promote the general purpose of the organization. For example, a temple trust might receive donations. It can use this for bhandara, food camps, medical camps, puja, etc. There is no restriction on the general donations. These are treated as revenue receipts as it is a regular source of income and hence it is taking to the income side. Okay. It is taken to the income side of income and expenditure account of the current year. There is still a restriction that you cannot use it for members or trustees. That has to be paid as honorarium and recorded separately in the receipts and payments account. You cannot misuse the donation for non-purposes of the organization. Okay. Let us move on. The second category is legacies. Legacies, as I described earlier, is the amount received by organizations as per the will of a deceased person. Upon the passing away, death of any person, if their will provides for some property or cash to be left to a non-profit organization, not-for-profit organization, then that is called a legacy. Okay. It may or may not specify the use of amount. Depending upon how it is done, it is similar to a donation. Okay. Specific legacies, the use of which is specified, is shown in the balance sheet as a liability. The general legacy, if the use is not specified, it is considered revenue nature and credited to the income side of the income and expenditure account. This is basically a different name for donations because the donation is coming from a deceased person. It is called a legacy. Okay. The third category is a life membership fees. A life membership fees is a not recurring income received once for the whole life from a member. So sometimes people can make major donations. For example, if 3000 rupees is the annual fees, some person might just make a donation of 50,000 rupees as a life membership. This will allow them to be a part for life even if they stay for more than 17 years, which is their 13 into 17, what should have been this 50,000. This is a one-time subscription fees basically. So all life membership fees are capital receipts. They are added to the capital fund on liability side of the balance sheet. Okay. Life membership fees is not income. it is a capital receipt. Alright, now let us discuss some questions. This was all for the course. First question, legacies are generally A. capitalized and taken to balance sheet, B. treated as income, C. treated as expenditure, or D. capitalized and taken to suspense account. Please remember, this is a tricky question. It says generally. Okay. Generally, we discussed legacies are treated as income. If they do not specify purpose, they are income. When there is a specified purpose, then capitalized and taken to balance sheet. That is for specific legacies, not for general legacies. Legacies cannot be treated as expenditure. Capitalized and taken to suspense account is also an nonsensical option. When do we make the suspense account? Can you remember? We make it for the trial balance. If the balance doesn't match, we discussed it. So the correct answer in this case is B, treated as income. Please be very careful. Sometimes you might get confused by multiple answer keys, but generally legacies are treated as income. If there is a specific purpose, they can be taken to balance sheet and treated as a capital receipt. Okay. Moving to the next question. Income and expenditure account is a real account, B, personal account, C, nominal account, and D, capital account. We see that income expenditure account is closed at end of every year. Therefore, it is a nominal account. Okay. Real account, personal account and capital account are not closed. Income and expenditure account is a nominal account. Answer is C, nominal account. Let us discuss one more previous year question. Which one of the following concerns prepares receipts and payments account? A, trading concerns, B, non-trading concerns, C, manufacturing concerns, or D, companies registered under Companies Act. I am sorry, this is a incomplete question. No, this is a previous year question. So, the correct answer is B, non-trading concerns. Alright, we discussed only not-for-profit organizations, clubs, trusts, etc. will be making a receipts and payment account. Others will be making a profit and loss account. Profit and loss account will be made by them. Okay. Moving to some practice questions, let us just discuss. First, annual members subscription is a capital receipt, B, revenue income, C, capital expenditure, or D, revenue expense noted on the payment side of receipts and payments account. The answer is B, revenue income. Member subscription is one of the main sources of revenue income for any NPO. So it's a revenue income or a revenue receipt. Okay. Last question. In the income and expenditure account, all revenue receipts are entered on the A. left hand side, B. right hand side, C. liability side, or D. asset side. We just discussed this, so I hope everyone is able to get this answer correct without wasting any time. You should ideally look for theory questions to be solved within 10 seconds. That is because sometimes you will find numericals. There are some English questions which will take time. There are some maths questions in EPFO. All of these will take a lot of time. So, all theory questions please try to solve within 10 seconds. The more comfortable you are with theory, you will be able to answer them sufficiently. The answer I will now give you. The answer is on the right hand side. If you remember, we just made the income expenditure account, and on the credit side we were discussing all the subscriptions, whereas we left the debit side alone in the question that I just did. Alright, so this was today's class. In the next class we will discuss accounting for partnerships. Okay, thank you. Hello everyone, welcome to General Accounting Principles for EPFO. Today we will discuss the 8th class, which is accounting for partnerships. Okay, let us begin. So, a partnership, according to the Indian Partnership Act, the Indian Partnership Act says that partnership is a relation between persons who have agreed to share profits of a business carried on by all or any of them acting for all. Okay. So, there are 5 keywords in this definition. Firstly, that this is the relation between persons who have agreed. Therefore, it is a relation created by an agreement. This is why it is different from other structures such as Hindu undivided family. You might have heard of the term Hindu undivided family, or HUF, or companies. An HUF is by birth, whereas a company is by law. On the other hand, a partnership is by agreement. Okay, so this is one of the core differences between an HUF, a company, and a partnership. The next point is those who have agreed to share profits of a business. Therefore, sharing of losses is not necessary. Sharing of losses is not necessary, although that is usually what happens. You share profits as well as losses, but it is possible that some partners, we will discuss those cases, don't share losses, only the profits. Okay. The next point is sharing the profits of a business. This is also very important. This is not a charity, not a trust or a religious organization. This is a business. And the last part is there should be participation by all or any of them acting for all. Therefore, there is joint liability in partnership, that all partners are liable for acts of any of them. There is also several liability, that
even if B does an act, A will be liable for it. It is not necessary that if the partnership has A, B and C and B does an act, I have to sue either ABC together or B and A together. I can only sue A also. So this is called several liability. All are liable is called joint liability. So there is, in a partnership, there is joint and several liability. Okay, let's move on. There are four major types of partnership. First is partnership at will. This is my agreement. Any agreement by partners to share profits in a business is called partnership at will. This need not be written. For example, if I tie up with a friend of mine to supply goods, that will be a partnership, as long as the other conditions that this is a business with profit sharing. What if the friend is not sharing profit? If he is supplying goods for me but not sharing profit, then he is only my agent, not partner. Okay, we will discuss agency as well as joint ventures in the next class when we discuss accounting ratios also. The second point is partnership for fixed term. Let us say some partnerships come only for a limited time, such as 2 years, that we will have a joint venture for 2 years. We will discuss joint venture also in the next class in proper detail. Next is limited or particular partnership, such as two traders jointly sell sunflower oil. So on this they form a partnership, but on other parts such as wheat, sugar, they sell on their own. So on that part they don't have a partnership. This is a limited or a particular partnership. And the last is a general partnership, where all business by two or more persons is a partnership. Normally there is no agreement here, just a partnership, and all business which happens by the partnership is included in the profits of a partnership. Okay, moving on. Let's briefly discuss what types of partners can exist. First is the active partner. This partner takes part in the business, management, etc. Then comes the sleeping partner or a dormant partner. They don't participate in management. They only provide capital. Third is nominal partner. Nominal partner is only by name, for brand value probably, for security, sometimes or for trust. Sometimes having a very trusted entity enhances the value of your own business or provides contacts, networks. So those partners who only provide such supplies are called nominal partners. Then come partner by estoppel or holding out. If, for example, I don't have any stake in the business. No stake in the business, but I pretend to be a partner. For example, if A, B and C together go for a business meeting, while only A and B are actual partners, C only sits in the business meeting but pretends to be a partner, then to the outsiders, C can also be held liable. In the same way, a regular partner is held liable. Alright, so this is called partner by estoppel or holding out. Estoppel means you are stopped from claiming excuse. Okay, so this is what partner by estoppel or by holding out means. Now we come to partner in profits. Remember, partnership is an agreement to share profits of a business, not losses. Therefore, you can have a partner who only shares profits. Let's say someone who contributes capital and is a sleeping partner. They might have agreement to only share profits. Those can be partner in profits. Last is minor partner. According to the Indian Contract Act, minor cannot enter valid contracts. However, a minor can be a partner only for profits in a business, will not share any of the losses, but profits. So for example, if there are 5 partners A, B, C, D, E and E is a minor, then losses shall be shared by these 4 and profits shall be shared by these 5. Why does this make business sense? That is dependent upon the independent considerations of the business. Alright, let us move on. Let's begin with the accounting portion of partnerships. So any partnership needs a partnership deed to be registered at the registrar of partnerships. The written form of agreement is the basis of a document of partnership. This is documentary evidence of the terms of partnership. Okay, it contains terms and conditions regarding conduct of business, rights, duties, obligations of partners. It is also for the admission of procedure of admission, retirement or death of a partner. What will happen is provided in a partnership deed. It is not mandatory to register. An unregistered partnership will also function. However, there are certain limitations which we will discuss, which ensure registration is better. Alright, let us discuss. In the absence of a partnership deed, the Indian Partnership Act provides that distribution of profit shall be equal. No matter how much effort or capital you bring, your profits will be shared equally. Interest on capital is not allowed. In a partnership, if partners are providing capital, then they can be entitled to interest. Let's say at 6%. However, if there is no partnership deed, then there is no interest on capital allowed. Okay. Next is interest on drawings. If there is no interest on drawings. If a partner withdraws capital, they cannot be stopped. So if one partner is constantly withdrawing capital, their part of the capital, then there is no hurdle to stop them from withdrawing it. Otherwise, if you charge interest, then a partner has to pay the firm, pay the partnership firm to withdraw. This is a disincentive to withdraw capital, which keeps capital in the business. If there is no partnership deed, then you cannot charge interest on drawings. Okay? Merely having an agreement is not enough, because this cannot be enforced in courts if there is no partnership deed. All right. Then come interest on partner's loan. A partner is allowed 6% per annum on the amount of loan given by partner. Even if the interest rates are higher, you cannot charge higher interest rate. No market interest rate. Market rate interest is also not allowed if there is no partnership agreement which is registered. All right. Now we come to salary and commission to partner. Many times there is only one partner who is working. The other partner might be sleeping or dormant. If there is no partnership deed, then partner is not entitled to any salary or commission or any other remuneration for managing the business. Then it is assumed that all partners are contributing equally. Next, if a partner derives any profit for him or herself from any transaction of the firm, he shall be account for the profit and pay it to the firm. This is one of the normal rules of no secret profit. For example, if you are selling oil, sunflower oil, and you bag, if A, B and C are selling sunflower oil, and A also gets a contract for 100 barrels of sunflower oil, he shall have to give the profits to the firm. He cannot take it for himself. Until unless he is allowed by a partnership agreement, there is no secret profit allowed. Secret profit is anyway not allowed. He will have to disclose the profit at all costs to the firm. Last, if a partner carries on any business of the same nature and competing with that, he shall account and pay to the firm all profit made by him in that business. This is the non-competition clause for any partnership. Okay, let us move on. The first part is accounting for business partner's capital. The capital account in a partnership is maintained in two methods. Okay, all transactions relating to partners of the firm are recorded in their capital accounts. There are two methods. First is the fixed capital method. Second is the fluctuating capital method. The fixed capital method has two accounts. In this, every partner contributes for some fixed capital. Let us say every partner brings 10 lakh rupees to the firm. That is their fixed capital. And the next is their current account. In this, they might have a transfer of profit, some drawings, if they withdraw, interest, salary, all of this will go to the current account. Okay, the capital will stay fixed. This means if interest has to be paid on capital, let's say 5% interest, then 50,000 rupees will come every year to the interest on capital account, which will go to the current account. That will not go to the capital account itself. On the other hand, if there are losses, they will also be deducted from the current account initially. In fixed capital account, generally initial capital contributions are credited to partner's capital account and all subsequent transactions are dealt through current accounts till major events happen which require readjusting of capital. We will discuss when this happens. The other method is the fluctuating capital account. The fluctuating capital account is when there is no current account, all transactions are passed through capital account. This is the same way as a sole proprietorship that we have discussed, that there is only one capital account. Okay. So in a partnership firm, there is one capital account per one account per partner. All right. Let us move on. Next is the profit and loss appropriation account. This is merely an extension of the profit and loss account of the firm. The profit has to be distributed amongst partners in their respective profit sharing ratio. Let us say A, B, C shall be sharing a profit in the ratio of 2:3:5. So therefore, if there is 1 lakh rupees of profit, A gets 20,000, B gets 30,000, C gets 50,000. So this profit sharing ratio has to be decided at the beginning of the partnership itself. Beginning of partnership. And the profits have to be adjusted before being distributed. So let us say this is the P&L account which says balance is 1 lakh rupees. Now interest on capital was paid. Let's say there is ABC in ratio of 2:3:5. Now interest on capital might be equal because everyone is contributing equal capital of rupees 10 lakh. So everyone gets equal interest, let's say 10,000 each. There are 3 on interest on capital. Then let's say A had given a loan. Not loan, let's say A is entitled to salary of rupees 15,000 and C has some commission of rupees 5,000. All of these will also go to the P&L appropriation account. Then what remains is 50,000 rupees. They will be divided amongst A, B and C in 10,000, 15,000 and 25,000 respectively. All adjustments are made in this account: partner's salary, commission, interest on capital, interest on drawings, etc. And finally, what is due to the partners will be distributed amongst the partner in their profit sharing ratio. Okay, this is the P&L appropriation account. Moving on, we come to the issue of admission of a partner. So if a partnership might already have A, B, C as partners, now they want another partner D. So a person can be admitted into partnership only with the consent of all the existing partners unless otherwise agreed upon. It depends on the partnership deed. Let's say only the managing partner can decide. A is the managing partner. So then the consent of B and C will not be taken. Otherwise it will be taken. On the admission of a new partner, following adjustments become necessary. First is adjustment in the profit sharing ratio. Earlier it might be that ABC had a profit sharing ratio of 2:3:5, but suddenly if D is added, it could be that the new ratio is 2:3:5:10 because he is contributing so much. Adjustment of goodwill, we will discuss goodwill properly, but it is when a partner is bringing business boost because of a partner's entry is generally treated with goodwill. Next is adjustment of revaluation of assets and reassessment of liabilities, because the value of assets might have increased, decreased, and provisions for depreciation might have existed which have to now be deducted. All of this will happen. Distribution of accumulated profits and reserves. If the previous partners had accumulated reserves of rupees 10 lakhs, we had discussed what are these reserves in the last class. Then this will already be distributed between the partners in 2 lakh, 3 lakh, 5 lakh, because the new partner has no role in the existing profits that the firm had earned. And the last is adjustment of partners' capitals. That is only because the new partner will also be bringing new capital. Most likely, it is not necessary for a partner to bring capital. Okay. So these are the 5 steps that we mandatorily have to see at the time of admission of a partner. There is something called a sacrificing ratio. So in the example that we discussed, A, B, C, D, where earlier there was a profit sharing ratio of 2:3:5, now becomes 2:3:5:10. The sacrificing ratio is the existing ratio minus new ratio. Only the old partners have to sacrifice some of their profits. So for A, this will be 2/10 minus 2/20 is equal to 2/20 or 1/10. For B, this will be 3/10 minus 3/20 is equal to 6 minus 3/20 or 3/20, and for C, this will be 5/10 minus 5/20 is equal to 5/20 or 1/4. So these are the sacrificing ratios. Okay. This only happens for the old partners at time of admission. Now we come to retirement of a partner. Okay. Retirement is the very opposite of admission. It is basically a partner is going out. A partner retires either with the consent of all partners or as per the terms of agreement or at his or her own will. You cannot stop someone from going out. However, there can be penalties in the partnership deed. Such as interest on drawings or severance that one might have to pay to the firm. Alright. The terms and conditions of retirement are normally provided in the partnership deed. If not, they are agreed upon by partners at the time of retirement. Okay. Now we come to the gaining ratio. The gaining ratio is the exact opposite of sacrificing ratio, because when an old partner goes out, the new existing partners gain share in profits. Therefore, the gaining ratio is new ratio minus old ratio. Please remember, sacrificing ratio is old ratio minus new ratio, and gaining ratio is new ratio minus old ratio. So if the earlier share was 2:3:5 for ABC and C goes out, then the new ratio might be 2:3. So everyone gains 2/10 or 3/10. Please also remember, it is not necessary that this is what the new ratio might look like. Let's say earlier ABC had ratio of 2:3:5. Now A and B will have 1:1. Now what will be the gaining ratio? Please calculate. I am giving you take 10 seconds. If you want more time, you can pause the video. This was a small question. So please see, or the new ratio is 5/10. 5/10 is the new share of every partner. For A, it is 3/10. For B, it is 2/10. So gaining ratio is 3:2 for A:2B. You can also write it as A:2B 3/10, 2/10. That is also permissible. Okay. It is not necessary, please remember once again, that the new ratio has to be same. It can be anything. Alright. If a partner dies, the share is transferred to legal representatives or executioners of the deceased partner. There is no gaining or sacrificing ratio at the time of death of a partner. First, their account has to be settled. Only then will the new partnership be constituted. Okay, let's move on. Now we come to the topic of goodwill. This is one of the most important topics in the entire chapter on partnership. Goodwill is the value of the reputation of a firm in respect to profits expected in the future over and above normal profits. So let us say you are earning 1 lakh rupees per month as 10% return on your capital. Everyone else is also earning 10%. Everyone is earning 10%. Then you are normal or average only. But let us say you have a sweet shop and suddenly you realize that while you are earning 10%, everyone else is earning 5% only. Then there must be something special about your sweet shop. That is why you are earning so much. This is the goodwill of your business. It could be because of the time or the quality. These materials add to the goodwill of a firm. Recognized brand name, advertising, all of these affect the goodwill of any company or a business. Goodwill is an intangible asset. Alright, it is not physical. We had discussed tangible and intangible assets. So goodwill is an intangible asset. There are three methods of calculation. Technically, because capitalization method has two more methods, there are four methods. First is the average profit method, the next is the super profit method, and the third is the capitalization method, where you can have capitalization on the basis of average profit or on the basis of super profit. Alright, let us discuss each of these methods. We will discuss this in some detail. Alright. First is the average profit method. In this, the value of goodwill is basically average profit into number of years purchased. So when you are buying a business, please remember I had already discussed questions on this, that only when you are buying a business will you be seeing goodwill represented on the books of accounts. Otherwise, you don't put it on the books of account what your goodwill is. Okay. So in the first method, the average profit method, let's say your average profit is 1 lakh rupees for the past 7 years. Alright. And number of years purchased is the number of years that you count. Number of years counted for goodwill. So let us say the number of years purchased is also 7. Then the goodwill will be 7 lakh rupees. Okay. However, if some business wants to buy the goodwill only for 5 years, number of years purchased, they might say that even though average profits were 1 lakh for the last 7 years, we will only be counting 5 years worth of goodwill. Then the goodwill will be rupees 5 lakh. How is the number of years purchased calculated? There is no specified formula. It depends upon case to case basis. No formula. Alright. These are for registered valuation experts to decide what is the correct way to ascertain value. So this was the average profit method, where you only look at average profit into number of years purchased. The next method is the calculation of super profit method. Okay. The method basically says goodwill is equal to super profit into number of years purchase. Now what is super profit? Super profit is average profit minus normal profit. So, and normal profit is capital employed into normal rate of return upon 100. Let us say you have 10 lakh rupees of capital employed. Okay. The normal rate of return is 5% per annum. Therefore, what is the normal profit? Normal profit will be 50,000 rupees. But your profit for the last 7 years is 1 lakh rupees. So therefore, your super profit is 50,000 rupees. And your goodwill will be super profit into number of years purchase is equal to, let's say, 3,50,000. If a firm buys another firm for 3,50,000 above balance sheet assets, then this 3,50,000 is the goodwill. Okay. Please look at the formula. I will be erasing it soon. Super profit is basically any profit above normal profit. Okay. Moving on, we now come to the third setup. This is calculation of goodwill on the capitalization method. The capitalization method has two categories. First is capitalization of average profit, and the second is capitalization of super profit. So capitalization basically means you look at the capital employed and then come at the capitalized value of profit. This can be done either on average profit or super profit. We will see both of them. So capital employed normally is total assets minus outsider liabilities. This is basically the accounting equation of assets is equal to liabilities plus capital. Therefore, capital is equal to assets minus liabilities. Capitalized value of profit is average profit into 100 upon normal rate of profit. Okay. For example, if I am earning 1 lakh rupees, the normal rate of profit is 5%. Therefore, my capitalized value is 20 lakh rupees. Okay. This basically means in how much time will I earn my capital again. If any of you have seen Shark Tank, they sometimes have a discussion on the grounds of in how many years will I get my money back. So for that you need to have a capitalized value of profits. So if the capitalized value is 20 lakhs, goodwill is capitalized value minus capital employed, minus 10 lakhs, you have 10 lakhs. So if in 10 years you will get your money back, and in another 10 years you will gain the entire amount of capital all over again. Okay. How did we get 10 years plus 10 years? It was basically dependent upon the normal rate of profit. If the normal rate of profit is 5%, the time taken for capitalization is 20 years. If the normal rate of return would have been, let's say, 20%, then the time taken for capitalization would have been 5 years. So this depends upon how many years purchase in this case is not required, because you have a normal rate of profit which is 100 upon normal rate. So you get the number of years needed. Okay. The other method is the capitalization of super profit. In this case, goodwill is equal to super profit into 100 upon normal rate of profit. So coming with the same example from the earlier one, there was 1 lakh rupees of profit, average profit, 50,000 was the super profit. So in this case, we have 50,000 into 100 upon 5 is equal to 50,000 into 20 is equal to 10 lakh. Okay. Both capitalization of average profit and super profit will give the same result. Why is that so? Because there is a mathematical equation. Let us say C is the amount of capital and X is the normal rate of profit, X upon 100. Then the average profits will be C into X by 100, which is Cx by 100. Okay. This is the normal rate of return, and the average rate of return or the average profit could be, let's say, Y. So we will have Cy upon 100 as the average profits. And later on, when we look at the value, this will either be Cy by 100 is the average profit, and the capitalized value of profit will be Cy by 100 into 100 by X, because X was the normal rate of profit. This becomes Cy by X, and if we have to reduce the capital employed, this becomes Cy by X minus C. Okay, which will ultimately come down to C into Y by X minus 1. This is the equation where Y is the average rate of profit and X is the normal rate of profit. Applying the same method to the super profit method, what is super profits? Super profits will be average profit, which is Cy by 100 minus normal profits, which is Cx by 100. Therefore, you get C by 100 into Y minus X. And now if you capitalize this into goodwill, you will get this number C by 100 into Y minus X into 100 upon X. Alright. So you get once again C into Y by X minus 1, which is the exact same. Even if you don't understand this equation, it is fine. We can move on. Please just understand that the basic point is that in both methods, ultimately, you will have the same answer. Alright. Now let us move on to a practice question. Suppose you have to calculate goodwill based on average profit, super profit, and capitalization of average profit and super profit methods. Alright. These are the terms which are given. The capital employed is rupees 1 crore. The normal rate of return of profits is 15% per annum. Profits of year 1 is rupees 25 lakhs. Loss of year 2 is rupees 5 lakhs. Profit of year 3 is rupees 40 lakhs. You have to calculate the profit based on 3 years of purchase. Okay. Take 5 minutes, not more than 5 minutes, and then we will commence. I hope you are going on the right track. We have 1 minute left. All right. I hope everyone has completed. Let us discuss the solution. Okay. First, let us come through the average profit method. Now, what is the average profit of the firm? For 3 years, we will calculate. First, we had 25 lakhs. Then we have loss of 5 lakhs. And then we have 40 lakhs. So, therefore, we have 60 lakhs as the total profit for 3 years, and average will be for 3 years rupees 20 lakhs. So, on the basis of average profit method, we have rupees 20 lakhs into 3 years purchase, which we get goodwill rupees 60 lakhs ultimately. Yes. Now we move on to the next method, the super profit method. The average profits we saw were rupees 20 lakhs. The normal rate of return was 15% per annum, which is 15 lakhs. Please calculate on the basis of 1 crore into 15%. You will get 15 lakhs is equal to rupees 5 lakhs. On the basis of 3 years purchase, the goodwill is equal to rupees 5 lakh into 3 is equal to 15 lakhs. Okay. Now we come to the capitalization method. The capital employed is rupees 1 crore. The average profits were rupees 20 lakhs. We multiplied by 100 upon normal rate of return, which is 15. So 100 by 15 gets us 6.67 approximately. Okay. So the capitalized value of profit is 1.33 CR. You will get 33,33,333. After deducting capital of rupees 1 CR, we will get goodwill as 33,33,333 rupees. This is also 6.666666. This is not 6.67. I just took it for this purpose. Same if we apply the super profit method. The super profit was rupees 5 lakh. We multiplied by 100 upon 15, which is 6.6666. So we will get 33 lakh 33,333 rupees as goodwill. Okay. I gave a confusing question only to see how many of you are able to solve it properly. I hope most of you were able to get it correct. The UPSC and EPFO normally does not ask numerical questions, but they have asked numerical questions in the past, and calculation of goodwill is one of the easiest ways in one where one can get tricked. So to avoid these tricks, I was giving you these questions. I hope the concept is very clear now. From all three methods, average profit, super profit, as well as capitalization profit method, you should be able to calculate goodwill. We come to the last part, which is dissolution of partnership. The dissolution of partnership is a reconstitution of the partnership, which may take place by change in existing profit sharing ratio among partners, admission of a new partner, retirement of a partner, death of a partner, or insolvency of a partner. If basically the business continues but in a new form, let us say they were A, B, C in 2:3:5. Now suddenly they are sharing profits in 1:1:1. That is a dissolution of the partnership and a reconstitution. Okay, so dissolution of partnership is only a reconstitution of the partnership agreement. So all of these changes might happen. The other is a dissolution of partnership firm. All right, remember, partnership is only an agreement, whereas firm, the partnership firm, is the entire business itself. Okay, so dissolution of partnership firm might be by agreement, that partners decide to end the business. It might be dissolution by law, that the business is now illegal. For example, let us say the government puts a ban on selling of onions. Then that might be illegal, maybe because of Essential Commodities Act or any other act, but now the business cannot be carried on. So this will lead to dissolution of the firm altogether. Okay, if all partners become insolvent except one, even then all of them become insolvent, then this will also lead to dissolution of the firm. Okay, the third is dissolution by court, winding up a firm. If any partner approaches court, if the other partners are not consenting for dissolution, then the court can order dissolution. Dissolution by fixed time, we saw there could be some firms which are only formed for 2 years, 3 years. So therefore, they will be dissolved automatically at the conclusion of the term period. The last is dissolution by notice. Any partner, let's say ABC are partners, A can give a notice to other partners of his intent to dissolve the firm, and it will be dissolved within due time. Okay. There are some accounting treatments which have to happen whenever a firm is dissolved. The first is treatment of losses. All partners have shared capital. The losses and including deficiencies of capital shall be paid firstly out of profits, next out of capital of partners, and lastly, if necessary, by partners individually. So, if the liabilities of the firm are rupees 10 lakhs, profits are rupees 1 lakh, and capital is rupees 6 lakh by the three partners. This is liabilities, this is the assets and profits, these are the debts. Then the other partners will contribute 3 lakh in the profit sharing ratio. Okay. The next part is application of assets. If the assets of the firm, including any sum contributed by partners to make up deficiencies of capital, shall be applied in the following manner: in paying debts to the firm of third parties. Second, in paying each partner proportionately what is due to him her from the firm for advances distinguished from capital, such as partners' loan. So first is third party loans, then is partner loans, then is partners' capital, and last is profits. So if after paying the loan as well as the partner's loan, there is 3 lakh rupees cash left in the business, and each partner has contributed 80,000 rupees of capital, and the profit sharing ratio is 2:3:5. First you will pay off the capital for rupees 2,40,000. Okay. Then the remaining 60,000 will be divided in the ratio of 2:3:5. Alright. These 12,000, 18,000, 30,000 will be, only this will be divided. The rest of the capital will be paid first. The last part is the realization account. The realization account is prepared to record transactions relating to sale and realization of assets and settlement of debt creditors. The balance in account is termed as profit or loss on realization, which is transferred to partners' capital accounts in profit sharing ratio. So at the end of the partnership business, we don't come up with P&L appropriation account, we come up with a realization account. Okay. So these are the three accounts: the realization account, the partners capital account, as well as the P&L appropriation account. These were the three accounts that are new in a partnership business ultimately. The rest is pretty much similar. We also discussed how goodwill is to be appropriated and measured and valued. Alright. These are very important topics. UPSC has not asked any questions in the EPFO papers on the calculation of goodwill so far, but because it is one of the major types of accounting, please expect that in the coming terms, in the coming questions, coming years, you will have questions on these lines. Alright. Major topic है, अच्छे से पढ़ना पड़ेगा इसको भी. I hope this class was understandable and ultimately all concepts are clear. We will now be discussing accounting ratios as well as company accounts in the coming classes. Okay. Let us discuss a previous year question. In the absence of any provision in the partnership agreement, profits and losses are shared by the partners. A. In the ratio of capital of partners. B. Equally. C. In the ratio of loans given by them to the partnership firm. Or D. In the ratio of the initial capital introduced by the partners. Profits and losses in the absence of any provision in the partnership agreement are shared, we discussed, equally. Okay, so the answer is B. Alright, thank you. Hello everyone, welcome to General Accounting Principles for EPFO. This is class 9, Accounting for Companies. Towards the end of this class, we shall also discuss non-traditional ventures such as joint venture as well as agency. Okay, let us begin. So, brief information. A company is formed and registered under the Companies Act or registered under any other act as per the Companies Act 1956. The 1956 Act was replaced by the 2013 Companies Act, but the definition remains the same. Okay, so therefore, a company is an entity registered under the Companies Act or an existing company under any other act. Alright, there are certain features of a company which are mandatory for it to be a company. First is that a company is an artificial legal person. Okay, unlike a shopkeeper who is a living person, a company is an artificial legal person. This means a company can sue on its own and can also be sued. It has almost the same rights and powers of a natural person in terms of economic rights. It does not have the same fundamental rights. Does not have the same fundamental rights but has the same economic rights. Okay. The second point is perpetual existence. A company has an independent and separate existence distinct from its shareholders. Shareholders are the owners of a company. Just the same way we discussed a business entity concept in the first class, the company is separate even in law. A business entity is separate only in accounting, but a company is separate only also in law from its owners. It will continue till it is wound up by order of the court. Okay, so these are some features. Let us discuss other features of a company. A company is an incorporated body. It must be registered under the Companies Act by the Registrar of Companies. By virtue of this, it is vested with corporate personality and it has an identity of its own. Therefore, it can sign deals under its own seal. Alright, so a director of a company or a manager signs for the company and also adds the seal of the company to give it official look, because a company is a separate legal identity. The management is representative. The number of shareholders can be very large at times and scattered. For example, Tata has more than lakhs, more than 10 lakh shareholders across the multiple Tata groups. So they cannot manage the affairs of the company collectively. Therefore, they elect some persons amongst themselves to manage and administer the company. These elected representatives of shareholders are individually called directors of the company and collectively called board of directors. You must have heard this term. So, the board of directors represents the shareholders. They only represent, they are not the only shareholders. Besides that, there are the key managerial personnel such as CEO, CFO, Chief Executive Officer, Chief Financial Officer, etc. They may or may not be board of directors. It is not necessary that a CEO is a shareholder. For example, in Twitter, 100% of the ownership now belongs to Elon Musk. However, for a brief while, Parag Agrawal was still the CEO of Twitter, while Elon Musk was the sole shareholder. He ultimately removed Parag Agrawal, but there can be representative management. Okay, moving on. So there are some minimum steps for the making of a company. There is a need for a minimum number of directors. For a private company, it is 2. So the minimum number of directors to form any company is 2. For a public company, it is 7. In a private company, a maximum is 200. In a public company, there is no maximum limit. Okay. So 2 people at least must sign up to be the directors of a company. They must obtain the DIN number, the director identification number, issued by the Ministry of Corporate Affairs. Then they must undertake some preliminary expenses such as verification of documents and payment of legal fees to company, etc. A preliminary expense is a deferred revenue expenditure. Okay, it is shown on the balance sheet of a company on the asset side and ultimately removed gradually. On the liability side, I'm so sorry, the deferred revenue expenditure is shown on the liability side. Then there is a memorandum of association. Okay, the memorandum of association we will discuss in the next slide is basically the constituting document, the basic document of a company. Once these are formed, the application is made to a registrar of companies, after which there is a certificate of incorporation, after which the board of directors make the articles of association. We will discuss what this is, and further shares are issued to shareholders as decided by the initial board of directors. These are the basic steps in the incorporation of a company. We will be discussing mostly the accounting standards for a company. Okay. So the memorandum of association is a charter document of the company. It has to be filed at the time of incorporation. It provides the foundational principles and objectives of a company. For example, HUL, Hindustan Unilever Limited, might have, or any other FMCG might have provision for different memorandum of association, such as we shall provide different consumer eatables. If this is what the memorandum of association says, then any act outside this scope is void. It does not have any value and it is not authorized, cannot be authorized by the company. The company will not be liable for any act that is outside the memorandum of association. It cannot be amended retrospectively. Basically, if an act is outside the MOA, then you cannot ratify even by consent of shareholders. Okay, cannot do this. On the other hand, we will now discuss articles of association. The articles of association are the rules and regulations for a company's governance. They provide how the annual general meeting and other meetings will be conducted, such as board of directors, how many posts can the chairperson take, what posts will exist, such as CEO, CTO, Chief Technological Officer, Chief Financial Officer, etc. The acts outside the AOA, the Articles of Association, can be ratified by special resolution at the annual general meeting. So therefore, the shareholders can authorize the company to do any act outside of the Articles of Association, but not for an memorandum of association. You can only amend memorandum of association by application to registrar of companies. You must apply to the registrar of companies to amend the memorandum of association. Okay. Another feature of the company is shareholders are the owners. Every company issues divisible shares. For example, 10,000 shares of rupees 10 each. The capital of the company is divided into shares. A share is an indivisible unit of a company. You cannot say I sold 3.5 shares. That is not allowed. A share is one share and it is one whole. The shares are transferable. The shares of a company are easily transferable. They can be bought and sold in the stock market. Okay. This is for public limited companies, public listed companies. For private companies, the shareholders can sell directly to anyone. Okay. The last point is limited liability of a company, of the shareholders. The liability of shareholders of a company is limited to the extent of face value of shares held by them. No shareholder can be called upon to pay more than the face value of shares held by them. At most, the shareholders may be asked to pay the unpaid value of shares. So, if shareholders have 10 lakh rupees worth of shares and the company falls into debt for rupees 1 crore, the shareholders cannot be asked to pay more than rupees 10 lakh. Okay. Ultimately, the company will go insolvent, but the shareholders will not be liable beyond their own share. Okay. This is the concept of limited liability. This is not with a business entity. If a shopkeeper owns rupees 1 crore, then the shopkeeper will have to pay rupees 1 crore, including from their personal assets. This is allowed because they are also allowed drawings from the business. A company is not allowed drawings from the business. It cannot withdraw capital. We will see how equity capital is a permanent source and cannot be withdrawn during the life of the company. So this is how going concern such as a personal sole proprietorship is different from a company due to limited liability in a company. This is the only reason why companies are such an attractive model for large corporations. Okay, let us move on. There are various types of companies, such as a private company where minimum 2 directors are needed and maximum 200 directors can exist. Then comes a public company for which minimum 7 and no maximum limit for directors exists. Then we have a government company where 50% plus shareholding is by government. a foreign company where 50% plus is by foreign entity or headquarter is outside India. Then we have a holding or a subsidiary company. A holding company is a company that owns another company, and a subsidiary company is one that is owned by another company. Okay, so for example, Tata Sons owns Tanishq. So Tata Sons is the holding company, Tanishq is the subsidiary company. Okay. Then we have listed and unlisted company. A listed company is one which is traded, the shares of which are traded on stock exchange such as Bombay Stock Exchange, National Stock Exchange, etc. Unlisted companies are those companies which are not traded. Remember, it is possible that a company is a public company but still unlisted. Once again, we come to the example of Tata Sons, which was a public company but it was never listed on a stock exchange. It continued to own and operate as a private company. Alright, and then we have one person company. This was introduced in the Companies Act 2013 to promote entrepreneurship by sole entrepreneurs. A private company has minimum 2 directors need. A one person company needs only one director. Okay, there are limitations on what this company can do, but this is also a new innovative model. Okay, there are two different kinds of share capital which can exist for any company. First is equity shares and the second is preference shares. Alright, the equity share gives one part in the right of ownership of the company. Each equity share provides one vote in the management. Suppose a company has authorized capital of rupees 1 crore from 10 lakh shares worth rupees 10 each. Then if someone owns 5 lakh shares, they will have 50% of the vote. Alright. Equity shares are entitled to dividend out of profits. So if the company makes 10 lakh rupees profits ultimately after all reserves, after reserves are made, then they can pay rupees 1 per share as dividend to all its owners. The equity shareholders are the last in series of liquidation. Equity share is a permanent source of capital. It cannot be redeemed, and if the company goes bankrupt, the equity shareholders will be paid last. Normally, nothing is paid to equity shareholders whenever a company goes bankrupt, because ultimately there is a reason why the company would have gone bankrupt in the first place, that it does not have enough assets to meet liabilities. So the equity shareholders are paid nothing. The second kind of shareholders are the preference shareholders. The preference shareholders have three basic advantages. First is preference at the time of redemption as well as dividends. Preference shares are redeemable normally. There are some exceptions we will discuss in the next slide. There is a preference dividend which is at a fixed rate. Let's say 7% preference shares is how it's called. So a 7% preference share, if the total profit is rupees 1 crore, and there are 1 lakh rupees worth of preference shares, then 7,000 will be paid to them as preference dividend first. Okay, only after that whatever is remaining from the 93,000, the equity shareholders will be paid. All right. Preference shareholders are allowed voting only in special circumstances, not in normal circumstances, and they are second last in the series of liquidation. So they will be paid just before the equity shareholders are paid. All right. There are different types of preference shares, such as cumulative preference share, non-cumulative preference share. A cumulative preference share is one where interest dividend accumulates. For example, if 3% preference shares existed and the company posted loss for 2 years, if there is a loss, there will be no preference dividend, right? Because dividend is out of profits. So if there is loss, then 3 years worth of dividend will be paid in the third year if there is profit. Okay, these are what cumulative preference shares are. Non-cumulative preference shares are basically those where if there is a loss, there is no dividend. End of story. You are not entitled to arrears in the next year. Okay. Then we have a participating preference share and a non-participating preference share. Participating preference shares are those which are allowed voting in special circumstances. Non-participating preference shares not allowed voting. Okay, in any circumstance normally. Then we have redeemable and non-redeemable preference shares. Redeemable preference shares are those which will be redeemed towards the end of their tenure. So if they are for 20 years, after 20 years they will be redeemed. Non-redeemable preference shares will never be redeemed. The last categories are convertible and non-convertible preference shares. Convertible preference shares are those which can be turned into equity after some time or some condition. For example, if in 3 years there is no profit or no dividend paid on preference shares, then the preference shares might be turned into equity shares. This is the concept of convertible preference shares. Non-convertible preference shares don't have any such option. Okay. Generally, preference shares are non-cumulative, non-participating, non-convertible, and redeemable in nature. Alright, so the default is non-cumulative, non-participating, redeemable, and non-convertible nature. Alright. Now we come to capital of a company. The company need not issue its entire capital at once, okay, and it needs to get permission for permission for capital from the registrar of companies. Therefore, it can say it has maximum permission of capital of rupees 10 crores with 1 crore shares of rupees 10 each. It can say this. However, at one point it might only issue 50 lakh shares of rupees 10 each worth rupees 5 crore. So this 5 crore rupees will be the issued capital, whereas this 10 crore maximum limit will be the nominal or authorized capital. The authorized capital refers to the maximum amount of share capital which a company is authorized to issue as per its memorandum of association. Alright, this is mentioned in the MOA itself. The issued capital is that part of the authorized capital which the company offers to the public that may include vendors for subscription or purchase. A company may issue its entire authorized capital or may issue in parts from time to time as per needs of the company. It is not necessary that you only issue to the public. You can also issue to lenders such as banks. You can also issue to vendors, etc. Now, issued capital itself has different parts. So we have subscribed capital, which is that part of issued capital which is taken up or subscribed by those who are offered for subscription. So if I issue 5 crore rupees of capital, but people buy only 4 crore worth of shares, then 4 crore rupees is the subscribed capital. There are three kinds. First is full subscription, which is equal to the subscribed issued capital, which is offered for subscription is the keyword, okay. Then there is over subscription, which is receiving more than what was offered. Sometimes you might see in IPOs, initial public offerings, there are 2x over subscription, 3x, 35x. Sometimes there is no limit to how much people might be willing to buy a stock, and at times there is less than or under subscription of the shares issued. Please remember, there are SEBI guidelines. The Securities and Exchange Board of India, the SEBI, has provided that less than 90% subscription will lead to failure of the IPO. The portion of nominal value of issued share capital which is actually paid forms part of the subscribed capital. Okay. Now we have called up capital. Called up capital is that part of the issued or subscribed capital which is called up by company to pay on the allotted shares. It is to be paid by the shareholders at the time when it is called for. An uncalled capital, it is that portion of the issued or subscribed capital that is not called up by the companies. For example, a company has issued 5 crore rupees of shares. However, the shareholders are supposed to pay in installments 3 installments, first of rupees 3 CR, then of rupees 1 CR, and then of rupees 1 CR every 3 months. Sometimes companies do it, they used to do it, nowadays this practice has waned out because people needed time to mobilize that much money. So called up capital would be that amount of capital which was called at the time. If the issued capital or subscribed capital was rupees 3 CR, but only was rupees 5 CR, but only rupees 3 CR was asked or called upon to be paid by shareholders, then the called up capital is rupees 3 CR. The uncalled capital is the remaining, which is not called. Called up capital is therefore paid up capital plus call in arrears minus call in advance. So let's say there are 1 crore people who have subscribed. Alright. Now amongst these 1 crore people, 50 lakh people of rupees 10 each for this. Okay. Of these 30 lakh people, 30 lakh people have paid the entire sum up till the second call of 4 rupees, 6 rupees per share. Okay. So they would have paid 1.8 CR. There are 10 lakh people who have only paid the first installment but not paid the second installment. And there are 10 lakh people who have paid the entire 10 rupees on the sum. Okay. Even though this last 1 CR was not called for, only 4 CR was called for, but even then they have paid the entire amount. So this is how different shareholders might work. Those people who have paid in advance will be called calls in advance, and those people who have paid not even the amount that was called for, they are put under call in arrears or unpaid capital. So called up capital is paid up capital plus calls in arrears. Basically, if 3 CR plus 1 CR has been called, then the called up capital is 4 CR, and whatever has been received in advance will be subtracted from whatever has been paid. Okay. Now we come to the concept of reserve capital. The company may keep some part of its share capital uncalled and kept in reserve to be called only in case of winding up. For this, a special resolution has to be passed by the company. This portion of uncalled capital is called reserve capital. This will not be issued till absolutely needed for insolvency. Okay. This practice has also weaned out lately. Nowadays, companies normally issue shares at a premium, and we will discuss issue of shares, but the ideas of reserve capital, call in arrears, call in advance, these are theoretical concepts. They are not practiced so much. Now we come to issue of shares. So whenever shares are offered to the public, they can be offered in three ways. First is at par, where only the share application money and share allotment money is collected. Application money and allotment money are also today paid together. Otherwise, there used to be separate amounts. First for application stage, and once the application was accepted, in multiple calls, the allotment money was paid. However, nowadays this has reduced relevance. Suppose a company has rupees 1 CR, 1 crore of share capital that has been subscribed. So it may directly offer 10 lakh shares at rupees 10 each. However, it can also offer 10 lakh rupees at 10 lakh shares at rupees 100 each, right? If it offers for this, where the authorized capital will not change. Authorized capital is only this, rupees 1 crore. So the value of each share will be rupees 10, and there will be a securities premium of rupees 90 per share. Okay, this will not go to the capital account. This will go to a separate account called the securities premium reserve. The securities premium reserve will be used specifically for payment of repayment of shares or debentures. The securities premium reserve can also be used for meeting contingencies and capital acquisition. Okay, we discussed what reserves are in the previous classes. The third category is issue of shares at a discount. So you can offer rupees 1 crore worth of shares at rupees 90 lakh also, where value of each share is rupees 10 with a discount of rupees 1. The SEBI prohibits issue of shares at a discount except in the cases of sweat equity shares, which is made to employees. So the employee stock option plan ESOP that you might have heard is basically issue of shares at a discount to employees specifically. Alright, these are the three ways in which shares can be issued. Shares ultimately form part of the share capital of a company. In the same way that shares are issued, shares can also be withdrawn if they are unpaid. Earlier it used to happen that people would not pay their call money on different calls, and if shareholder fails to pay the due amount of allotment or any call on shares, the board of directors may decide to cancel his or her membership of the company. With the cancellation, the defaulting shareholder also loses the amount paid on such shares. So if you have paid rupees 8 upon the 10 rupees that you were supposed to pay and your share is forfeited, then you will lose this amount. Okay, the result of forfeiture of shares is cancellation of membership of the shareholder. The name is removed from the register of shareholders and reduction of the issued share capital of the company. So if 1 crore was the, let's say 10 CR was authorized capital, 1 CR was the issued capital.
of which 10 lakh had to be forfeited. Now the issued capital will only be shown as 90 lakh rupees because 10 lakh shares have now been taken back by the company. Okay. Interest can be charged on late payment of share capital to the defaulting shareholder. However, after forfeiture, this is not remedy. You cannot say that please charge interest but give me the share. Once it is forfeited, it is forfeited. Alright. The company also has the right to reissue forfeited shares. Reissue of shares means sale of shares which were issued earlier but had been forfeited for non-payment of called up amount. Okay. The balance amount of shares forfeited is a capital gain of the company and is transferred to the capital reserve. We discussed capital reserve in the types of reserves that can be created. Capital reserve can be used for capital purchases, capital expenditure. So once the shares have been forfeited, you cancel the amount. Let's say it was rupees 1 crore, now it is only 90 lakhs. So 10 lakh worth of shares you have taken back. But if you received rupees 8 lakh on it already and you reissue the 10 lakh again and you receive those 10 lakh, these 8 lakh are a capital gain. Alright. So this is how forfeiture of shares as well as reissue of forfeited shares works. So while shares are a part of capital, the other liability normally remains the same except for this one marketable debt instrument called debenture. The debenture is a debt instrument which can be traded in the market. So you might have heard bonds, corporate bonds have been existing now, and India is trying to develop a corporate bond market properly. So companies issue debt instruments with fixed interest rate or a floating interest rate. These are not capital, these are not like shares, they will have mandatory payment. These are called debentures. They can also be issued as zero coupon bonds. Zero coupon bonds are basically bonds which don't provide interest but are given at deep discount. So let us say I have a 100 rupees bond which I sell at rupees 70. Okay, and I say that 5 years later I will pay you rupees 100. Then the balance of rupees 30 is the interest effectively. Please think about it, that to get rupees 100 later on, if you are paying rupees 70, then you are getting approximately 40% plus in 5 years. So on average, compounded interest would be about 6 to 7% in this case. Interest is payable before any dividend. Dividend is paid out of profits, whereas interest is an expense for the business. So therefore, it is payable before any dividend is paid. Debentures can be issued for collateral security. If a company takes a loan for a project, they can issue debentures to the lender so that if the lender wants to liquidate the debt later, they can sell the debentures in open market. They can be issued for cash
directly to buy cash from the public or for any other consideration such as for payment of land purchased or machinery, etc. If any long term debt is issued, then consideration can be in the form of debentures also. While issuing debentures also, one can charge premium. So this will also be credited to the securities premium reserve, such as cash debited to debentures to securities premium reserve. Let us say 11 crores were received, 11 lakhs, of which 10 lakhs were the debentures and 1 lakh was the securities premium reserve. So all of this is the basic accounting treatment of debentures. Okay. There are a few types of debentures, redeemable and non-redeemable. Most common is the redeemable type. Non-redeemable type is generally not preferred by investors because they come for limited terms. Alright, then comes secured and unsecured debentures. The Yes Bank case, if you remember, had AT1 bonds, additional tier 1 bonds, which were unsecured debt instruments. So secured debentures normally have charge on an asset, whereas unsecured debentures don't have any charge. If the debenture is not paid, if the interest on debenture as well as the debenture is unpaid, then the asset can be sold to recover the amount. The last is convertible or non-convertible debentures. Convertible debentures can become equity shares in the future, whereas non-convertible debentures NCDs will not become equity shares. Both of these are valid forms. Okay. Besides this, the rate of interest can also be a variation. So there is a floating interest rate and a fixed interest rate. Now floating interest rate might depend on the market interest rate. Let's say if the savings account is 3% in year 1, then this is what the debenture offers. If the savings rate is 10% in year 2, then this is what the interest, this is what the debenture offers. So this hedges the risk. Or the fixed interest rate, which is, let's say, 7% interest annually. The company can't change it. Even if market interest rates are lower, it will still have to pay 7% on the debentures that they have issued. Companies will obviously prefer floating interest rate because this allows them to match the market rate of interest. Alright. Now we come to non-traditional structures. We have completed the portion on companies. Sometimes there are joint ventures. Okay, this is a temporary partnership. A temporary partnership who have agreed to jointly carry out a venture. The business relationship between co-venturers comes to an end as soon as the venture is completed. This can be government to private or private to private for multiple purposes. Sometimes you have to jointly build a road. So the supplier of cement will work with a contractor for construction, etc. Multiple joint ventures can exist in different forms. So this is a temporary partnership. Joint ventures are quite common in construction business, consignment, sale, purchase of property, underwriting of shares and debentures, etc. we discussed underwriting is effectively the process where during an IPO, a company offers to buy shares in case of under subscription. If the IPO is undersubscribed, then it will fail. So, underwriters promise the non-failure. They do it at a premium. So, underwriting of shares is a very big business, especially in investment banking. So, this is done normally in joint ventures also. No specific firm name is used for joint venture business. It is normally said as a joint venture between X and Y. Okay. The terms and conditions of a joint venture are normally dependent upon the agreement between the parties. The co-venturers share profit and loss in agreed ratio. It is mandatory to have an agreement, although it is not necessary to have written agreement, but a company must have written agreement. So if a joint venture is with a company and another party, then a written agreement is must, because company can sign through its seal only. In the absence of any agreement, profit and loss are to be shared equally regardless of what capital is contributed. Co-venturers are free to continue with their own business unless otherwise agreed. There is no restraint like in partnership. We had discussed that in partnership you have to mandatorily disclose your profits as well as share the profits with the rest of the partners in a partnership firm. However, this is not the case in a joint venture. In a joint venture, you can retain your profits. The account books for a joint venture can be kept in 4 ways. There is no one way to maintain the account books. In the books of one co-venturer only, that they will handle primary responsibility. In the books of all co-venturers, it is possible that they will each handle part of the responsibility. Then you can have a memorandum joint venture account. In this method, each co-venturer will record only those transactions relating to joint venture which are directly concerned with her or him. Such account will not disclose profit or loss. This additional document is called joint venture account. So in this case, for example, you give goods to the joint venture, you will simply have joint venture debited to sales, credited as an entry, where you are selling your goods to the joint venture or any asset, etc. Let's say if you are donating your furniture, then this will be the entry. Separate sets of books can also be prepared. This is the fourth method. A joint bank account, a joint venture account, personal account of each co-venturer are prepared in this form. So purchases, sales, etc. they might be noted in the books of one co-venturer or in a joint venture account or in a memorandum JV account in the books of each person. There is no one answer to this, but please apply the logic that it will be only one of these 4, generally not outside these 4. Okay. Now we come to agency. So when one person acts on behalf of another, then there is a contract of agency as per the Indian Contract Act. There is a principal-agent relationship which is established in an agency. Principal is a person whose task is being done by another, and agent is a person who does the task on behalf of another. An agent can also be a minor. It is not necessary that an agent has to be above the age of 18 years also. An agent not necessarily takes salary or remuneration, not necessary. Okay. In the case of trading, there is something called consignment, where one party sends goods to another to sell. In this case, the principal is called the consignor, or the party which sends the goods, and the agent is called the consignee, or the party to whom goods are sent. Okay. The consignee receives a commission calculated on the basis of gross sale. A gross sale is calculated on total sales, not merely credit sales, until and unless agreed upon by the consignor and consignee. So, if the agent sells 10 lakh rupees worth of goods, 5 lakh on credit, 5 lakh for cash, with 10% commission, we will get full 1 lakh rupees as commission. Alright. The total sales has to be counted, not credit sales or cash sales only. Generally, consignee is not responsible for any bad debt that may arise. Alright, so if in these 5 lakhs of credit, only 3 lakh are received later on, the consignee will not be responsible for it. If the consignee is to be made responsible, he has to be paid del creditor commission. Okay, del creditor agent is an agent which has a stake in business. It is different from partnership because there is no joint or several liability. There is only a commission involved. Okay, so please understand the del creditor commission. The accounting for consignment happens in the following manners. First, we count the consignment cost. Suppose you have goods worth rupees 7 lakhs as the cost price. It takes 50,000 rupees to send the goods to the agent, and then they are sold for rupees 10 lakhs. So the consignment cost, and let's say 1 lakh was the commission for the agent. So the consignment cost means not only the cost of goods but also all expenses incurred till goods reach premises of consignee. Alright, commission to consignee is not a consignment cost. It is only the cost of your goods as well as the delivery cost. The valuation of inventories, the principle is that, this is principle PLE, that inventory should be valued at cost or net realizable value, whichever is lower. So if the agent has sold 5 lakhs worth of good, 5 lakh is remaining, then if it cost you rupees 7 lakhs, then the value is rupees 3.5 lakhs only. Sometimes there is a loss on sale. So for unavoidable normal losses, it would be spread across the entire consignment while valuing inventories. No entry is recorded for normal loss, and it is considered an expense for valuation of the inventory. Okay, normal loss by sale from agent is only an expense and not a regular loss. An abnormal loss such as fire in the godown will be unnecessary or accidental loss. This is credited to consignment account. Okay, this is a separate account for which there will be a credit and debited to the P&L account, the profit and loss account. Because this is a loss, so a loss, an increase in loss will be debited. Please remember the rules of debit and credit, and it will be credited to the consignment account. It will not be credited to the purchases or inventories account. Okay, the consignee returns. Sometimes the consignee will return the goods. These goods are valued at a price at which it was consigned. Expenses incurred to take those goods back are not taken into consideration. So let's say you had 7 lakh rupees cost for the goods and 7.5 lakhs after transportation. 50% of this was returned and that cost another 30,000. So you had 3.75 lakhs plus 30,000. Although your expense is 4.05 lakhs, but you will only count 3.75 lakh as the cost. You will not count only 7 lakh, 3.5 lakh, because you also spent money on the travel, and that is a part of the consignment cost. Okay, so these are the 5 rules for accounting for consignments. Now we come to previous year questions. An abnormal loss on consignment is credited to. The answer is consignment account. Please remember, this says credited to. If it says debited to, then the answer would have been profit and loss account. Okay. The answer is C, consignment account. Next question. When goods are purchased for joint venture, the amount is debited to A, purchase account, B, joint venture account, C, venturer's capital account, or D, profit and loss account. We have discussed this concept, but this can still be confusing because there are multiple ways of accounting for the joint venture. Please apply your own brains and common logic. It cannot be purchase account because that is for credit purchases of goods for individuals only. The venturer's capital account makes no sense. Why would this be added to the venturer's capital? Profit and loss account makes no sense because goods are being purchased. This is not a loss or a profit for a business. They are only increasing the stock. So the only possible answer is joint venture account. This is also one of the methods. Please remember the 4th method, that a joint venture account can be created. Okay. Preliminary expenses are examples of A, capital expenditure, B, capital gain, C, deferred revenue expenditure, or D, revenue expenditure or expense. We discussed this in the beginning of the class, that preliminary expenses are deferred revenue expenditure. Okay. We have also discussed this concept in earlier lessons. Let us have one practice numerical just for the sake of conceptual clarity. Calculate the dividend payable. The equity share capital called up is rupees 5 lakh. Okay. Calls in arrear, calls which have been not paid yet, arrear is not paid, is rupees 40,000. calls in advance is rupees 25,000 and the proposed dividend is 15%. Now remember, 15% is the dividend which has to be paid. You have to decide how much dividend will be paid. Okay. Take 1 minute. This is not a very difficult question. Okay, time is up. Let us try to solve this question now. Okay. The equity share capital is rupees 5 lakh, of which uncalled capital is rupees 25,000. This is not in the called up part itself because these are calls in advance, and called up capital only includes paid up capital plus calls in arrear minus calls in advance. So therefore calls in advance is not included in the called up capital, although it would have been included in the paid up capital if we had counted this. Called up capital is rupees 50,000, of which 40,000 has not been 5 lakh, of which rupees 40,000 has not been paid. So only 4,60,000 of the called up capital has been paid. On this you apply 15% interest rate, you get rupees 69,000. I hope everyone was able to get this. Okay, the answer is 69,000 rupees. I did not give options just to test your calculation. In the EPFO exam, if you get a numerical, it is also backed with options, so don't worry. Okay, I hope this class was clear. These were some important and new concepts. So please go through this lesson multiple times if needed. There will also be a handout which covers most of the important aspects. Okay, thank you. Hello everyone. Welcome to the last class for General Accounting Principles for EPFO. In this 10th class, we will discuss accounting ratios. Let us begin. So what are accounting ratios? Accounting ratios are any ratios based on different elements of financial statements. So financial statements such as trading account, profit and loss account, as well as balance sheet. We had discussed all of these in the classes on financial statements. They have multiple elements such as closing stock, gross profit, net profit, assets, current assets, current liabilities, capital, etc. So any ratio which is based on different elements of these financial statements are called accounting ratios. Okay. These ratios are used to determine the financial performance of a business. Analysts, economists, etc. use the financial ratios to determine how well a business is doing. Stock market traders, all of them make use of these financial ratios, accounting ratios. They also help in comparison with industry standards. For example, let's say if the current ratio, I will explain all of these ratios. We will discuss current ratio when we come to it. For one sari business is 35%. For two other businesses, it is 37%. For one more, it is 50%. Then we will know that who is an odd performer, who is a very good performer, whereas who is just slightly above average. Alright. So industry comparison is easier when we compare ratios with each other. This is also useful for investment decisions as well as for banks to judge solvency. So if an investor wants to buy your shares, they will look at your gross profit ratio, your operating profit ratio. Similarly, a bank will also look at these ratios to see whether or not you are profitable or whether you will become a non-performing asset, an NPA, in the future. Okay. So this is the basic importance of accounting ratios. There are four major types of accounting ratios which judge very different things. We will not be diving deep into many other kinds of accounting ratios because they are too technical and not related to the topic of accountancy directly. Okay. So we will only be discussing the relevant ones for the purpose of the EPFO exam. First, we have the liquidity ratio. The liquidity ratios discuss how well the current or short-term liabilities of a business can be met. Okay. So this looks at how well a business is doing in its activity. The second part is the turnover or activity ratios, which measure the efficiency of a business, on how well you are managing your resources and can you do the same task in less resources. The third are the profitability ratios. As the name suggests, they discuss how profitable is your business. You may be efficient, but are you really making any profit? And the last is the leverage ratio. The leverage ratio basically looks at how much is your capital exposed to risk. Okay. So these are the basic four types of accounting ratios that we have. Alright. We will discuss each of these in proper depth over the course of this lecture. First, we come to the liquidity ratios. The liquidity ratios are used to measure, as I said, the firm's capacity to meet short-term liabilities. If a business is not sustainable in the short term, it will not be sustainable in the long term anyway. That is general wisdom, but don't apply this to modern time startups because sometimes you have to run on venture capital to grow first. Okay, so the first liquidity ratio is the current ratio. We will discuss all of these. The next is the quick ratio and the absolute cash ratio. These are the only three that we will be discussing. There are many other metrics that are sometimes used for liquidity, but these are the most important ones. And it is unlikely that the EPFO exam will ask questions outside of this entire calculation anytime soon. Alright, so let us begin with the liquidity ratios. We come to the first one, current ratio. Current ratio is a very simple ratio. It is calculated as current assets divided by current liabilities. So suppose the balance sheet has asset side and liability side. Here you might have cash rupees 10,000, stock rupees 40,000, and land rupees 1,50,000, whereas you have creditors of 25,000, 10-year loan for rupees 1 lakh, and your own owner's capital of 75,000. So this will be 2 lakh on each side. But the current ratio will be, what are the current assets? Cash plus stock. So 50,000 upon current liabilities, which is the creditors, for 25,000. So you have a current ratio of 2:1 or 200%. Normally this is measured as a ratio because current assets are normally supposed to be higher than the current liabilities. This can also be expressed as percentage. There is no harm in it. Okay. Now there are some issues with the current ratio. Please understand that current assets also include stock. We discussed in the last example, there was stock, and simply meeting the stock's value is not correct. Unfair. Why? Because that is what the business is there to sell. You can't simply claim that you have already realized the value only because you purchased the stock. Therefore, there is something called the acid test ratio, liquid ratio, or the quick ratio. Okay. The quick ratio discusses what is outside the stock as well as personal expenses, the personal account expenses, the representative personal expenses that we had discussed. So the quick ratio is basically liquid or quick assets divided by current liabilities. Okay, and liquid assets are current assets minus stock as well as prepaid expenses. So amongst current assets, if we look at this, if there is too much stock, then it is not liquid. Not liquid. Why? Because you cannot sell it instantly. You are there to sell the stock in the first place. If you were very good at selling the stock, you would have sold it anyway. The fact that you have the stock is proof that it is not so liquid that it cannot be sold very easily. Who wants to keep inventory to the end of the year? Every businessman will prefer that all of their stock goes so that they can start making new stock. That does not happen. That is why we have these ratios. The other asset, current asset that is not liquid is prepaid expenses. Let us say rent is prepaid rent. You can't do anything about it, right? You can't sell prepaid rent. It can only benefit you in terms of your landlord. To all other parties, this is not a viable asset. So that is why we have an asset test or a liquid ratio to see how well the liquidity of the company will be managed in times of adversity. Okay, so just in the previous example that we had discussed, if we look at the quick ratio, the same. Okay, let us say there was cash 10,000, stock 40,000, and creditors 25,000. Let's say let's discuss the quick ratio now. That will be 10,000 upon 25,000, or merely 40% or 0.4. So you can see that even though the current ratio was 2:1 or 200%, the quick ratio is only 40% or 0.4:1, which is a huge gap. Normally, if you have studied mathematics, you will notice that you don't express ratios and decimals. Often ratios are expressed as 2:5 instead of 4:10 or 0.4:1. That is the correct way of representing a ratio. But in accountancy, because we need to compare different companies, we always have the current liabilities portion as 1. Alright, so that is why we will keep it as 0.4:1. An even more deeper liquidity test is the absolute cash ratio. Okay, the absolute cash ratio is the amount of liquid cash or cash equivalents with the business. Absolute cash ratio is cash plus bank balance plus marketable securities upon current liabilities. So, for example, if the firm had debtors, sundry debtors, they would also be included in the quick ratio because debtors are liquid. You can ask money from them, or you can sell your debt through discounting. So it is still a form of quick ratio, but cash is the most liquid of all. So therefore, when we have to calculate the absolute cash ratio, we only look at cash, bank balance, and marketable securities. What are marketable securities? We have discussed in previous classes. These are mutual funds or shares in stock markets that we can sell instantly. Within 3 days, we can realize the value of it. Those are called marketable securities. If you have a lock-in, let us say a fixed deposit of rupees 3 lakh, that is not going to be broken down, so it's not a marketable security. But 3 lakhs in mutual funds, which you can sell instantly, will be marketable security. Okay, I hope this is clear, that only cash equivalents upon current liabilities will give the absolute cash ratio. Now that this is clear, let us discuss a practice question. Okay, calculate the current ratio and quick ratio and absolute cash ratio for the following. There is cash at bank rupees 34,500, debtors of rupees 6,000, furniture for 45,000, prepaid rent for 4,500, stock inventory for 9,000 rupees, and land for 1,01,000 rupees. And on the other side, on the liability side, we have bank overdraft of 10,000, sundry creditors of 35,000, bank loan of 55,000, and owner's capital of 1 lakh. Okay, please exercise your wisdom on what is a current liability in this case and what is not a current liability normally, based on our interactions in the previous classes. Okay, take 2 minutes to solve this on your own. Okay, time is up. I hope all of you were able to complete all three ratios in the given time. Please understand that EPFO has a huge time constraint, that there are many MCQ questions. There are 120 MCQ questions and only 120 minutes. So you will not get more than 1 minute per question, and you will need a lot of time to calculate mathematics as well as for English portions. So therefore, the less amount of time that you spend on accountancy portions is better. Alright, let us come to the solution. The common thing in all three, the current ratio, the quick ratio, as well as the absolute cash ratio, is current liabilities. Current liabilities were bank overdraft plus sundry creditors is equal to 45,000. Okay, current liabilities in this case, current assets in this case were cash plus debtors plus prepaid rent plus stock. Okay, so we get 54,000 upon 45,000. So we get 1.2 is to 1. This was not very difficult to calculate. If you find it difficult to calculate, normally even the questions, the numericals that EPFO has given, they provide very easy numericals which are fine. So you have 54,000, you subtract 45,000 from it, you get 9,000 upon 45,000, which you will very simply get as 1/5 or 20%. You add 20% to 1 and you get 1.2 is to 1. Okay. Quick ratio, in this case, you will remove stock as well as prepaid rent. So you will only get 40,500 upon 45,000 is equal to 0.9 is to 1. I hope this was clear. This is basic maths. And the absolute cash ratio, you only have 34,500 upon 45,000. Sorry, this got deleted. We were at the absolute cash ratio, which is 34,500 upon 45,000, which is 76.67%. This was specifically to trick everyone. I hope people understand that at times the calculation is not going to be easy, but you don't have to calculate the entire sum. In an MCQ question, you can only look at which is the closest option. Suppose one option said 70%, the other said 90%, one said 50%, and the last said 76.67. You can clearly see that because 4,500 is 10% of 45,000 and this is not divisible directly by 4,500, you can have a close look that none of these three can be answers. So you will have to have 76.67%. Okay. Numericals normally are not very difficult, but you need to have your concepts correct. At times they can have difficult questions where if you apply the wrong concept, then you will get it wrong. Okay, let's move on. Now we come to the turnover ratios. The turnover ratios measure the efficiency of operations of a business. Okay, they look at how well a business manages its limited efforts. So how well it manages its stock, how well it manages debtors, how well it manages creditors, as well as its working capital. All of these are measured in the turnover ratios. Okay. The first is the stock turnover ratio. The stock turnover ratio measures the efficiency with which stock is managed. Okay. The stock turnover ratio is the cost of goods upon average stock or inventory, where average stock is opening stock plus closing stock divided by 2. This is the same concept, cost of goods sold, that we have discussed, which used to be purchases minus purchases return plus opening stock minus closing stock. This used to be the formula for cost of goods sold. We have discussed this entire concept in previous classes. So this is the stock turnover ratio. Where you first calculate, you will be given opening stock. Let's say opening stock was worth rupees 10 lakhs. Closing stock was worth rupees 3 lakhs. Purchases during the year were rupees 6,50,000. Purchase returns were 25,000. Wages on production. Please remember, wages on production as well as any direct costs which are used for processing of goods itself, they are included in the cost of goods sold. Alright, let's say these are the 5 criteria that you have. Wages on production is purchases returns is 25,000. What will be the stock turnover ratio? Calculate in 1 minute. Okay, time is over. Let us calculate. Cost of goods sold in this case will be opening stock minus closing stock plus purchases minus purchase returns and wages on production. So this comes out to be rupees 13 lakhs, and the average stock is rupees 6.5 lakh. Okay, so therefore we have a stock turnover ratio of 2:1. This means that on average the business is able to complete its inventory every 6 months, twice every year. Okay, this is what the stock turnover ratio is about. I hope this is clear. Let us move on. Now we come to the debtors turnover ratio. It is calculated to indicate the efficiency of a company to collect its debts. Okay, how well you are able to realize your debts within a year. Okay, so the debtors turnover ratio is net credit sales upon average account receivables. Average account receivables in the same way will be opening debtors minus closing debtors upon 2. So whatever net credit sales you make in a year, you can simply calculate the debtors turnover ratio. You will realize how many debtors are paying you back. This is not extremely important from the point of view of numerical questions. Just knowing this formula should be enough. Okay. Similarly, we come to the creditors turnover ratio. The creditors turnover ratio indicates the efficiency with which suppliers are paid. So it is net credit purchases upon average trade creditors. It only shows how responsible is a business and how often it pays its creditors. Please just learn these concepts. They are not very important because credit purchases, trade creditors, trade debtors, sundry debtors, these are not concepts that the EPFO has asked in great depth in the past, and therefore just knowing these concepts are enough. Okay. Now we come to the working capital turnover ratio. The working capital turnover ratio indicates the speed at which working capital is utilized for business operations. Working capital is basically assets used to meet day-to-day operations need. For example, a construction business will have to pay daily wages as well as transport cost, material cost. All of these it will need on a very short term basis. Those will be working capital. Alright. So working capital turnover ratio is basically total sales upon working capital. This shows how much your working capital is able to generate for your business, and where working capital is simply current assets minus current liabilities. So for example, if over the course of 1 year you have 10 lakh rupees of sales, within 1 lakh rupees of working capital only, then that means a ratio of 10:1. This is too high a working ratio. Ordinarily 1.5:2, 1.5 to 2 of a working capital turnover ratio is considered good. Less than 1 is considered as problematic because it means that your sales don't cover the assets that you maintain for your day-to-day operations. Therefore, you are not going to be very profitable in the future ultimately. Okay, so this was the working capital turnover ratio. Let us come to one question on this. Calculate the working capital turnover ratio if the total sales for the year were 27,000 rupees. This is the same balance sheet as the previous question that I had given you. Please try to calculate. I will give you 2 minutes. This is a question that you have already seen. So please take 2 minutes and try to calculate the working capital turnover ratio. Okay, time is over. Let us discuss the solution. So, the formula for the working capital turnover ratio is total sales upon working capital, where working capital is current assets minus current liabilities. In this case, current assets were cash plus debtors plus prepaid rent plus stock. Okay, this is 54,000. Current liabilities are bank overdraft plus sundry creditors is equal to 45,000. Therefore, the working capital is 54,000 minus 45,000 is equal to rupees 9,000. The total sales were rupees 27,000. So 27,000 upon rupees 9,000 is equal to 3:1. The working capital turnover ratio for the present question is rupees 3:1. I hope this is clear. Let us move on to the profitability ratios. These are the most important ratios that we will discuss now. Now we come to the profitability ratios. They show how much profit a company or a business is making. Okay, we will discuss all of these concepts we have covered briefly or touched upon in previous classes. Gross profit ratio, net profit ratio, operating ratio, as well as operating profit ratio. And lastly, the return on investment ratio is unnecessary as a word here. It is simply return on investment. It is also called return on capital employed. Okay. So we will be looking at these four ratios. Let us begin. First, we come to the gross profit ratio. You might recall in earlier classes, we have discussed the gross profit ratio when we were discussing financial statements. So the gross profit ratio has a basic formula: gross profit upon net sales into 100. Alright. Net sales in this case is total sales minus sales returns plus excise duty. Normally you will not be questioned on this metric. Sales return is enough, but just in case, for the purpose of principles, please know that excise duty is also deducted from the net sales, because that is something that you collect on behalf of government. So if someone pays you rupees 700 as inclusive of taxes for any good that they buy, and of this rupees 10 is tax, then your own income is only 690. Rupees 10 you will have to pay to the government. So that is why we deduct excise duty from net sales, from total sales, to arrive at net sales. Okay. And gross profit is net sales minus cost of goods sold. Please remember, cost of goods is purchases less purchases returns. Opening stock minus closing stock was the basic, and wages on production as well as electricity charges for production, machinery, all of these are also very important, because these are direct expenses. Whatever is a direct expense for the business in its revenue generating capacity will be included in the cost of goods sold. They will not be included in the net profit, but in the gross profit itself. So let us take an example. Sales was rupees 1 lakh. Sales returns were rupees 15,000. Cost of goods sold is rupees 17,000. Please calculate the gross profit ratio. Take 1 minute. This is a very easy question. Okay. So we see that net sales are rupees 85,000 and gross profit is net sales minus cost of goods sold. So it is 68,000, which is equal to 80%. Very high amount of gross profit. So I think this is very clear. Okay. This was an easy question because I directly gave the cost of goods sold. I did not give any confusing elements. Okay. Let's move on to the operating profit. So operating profit is basically gross profit minus administration expenses plus selling expenses. Okay. Therefore, operating profit ratio indicates operational efficiency, while gross profit ratio provides how well is your production efficiency. The operating profit ratio provides for your overall operational efficiency. Merely producing is not the job of a business. They have to maintain an office, they have to advertise, they have to buy different insurance policies, pay non-workmen such as employees. So multiple tasks of a business. All of these are directly related to business, but they are not directly related to production. So these are in the operating ratio. Okay. Operating profit upon net sales is the formula for operating profit ratio. These include rent and insurance, variable expenses such as shipping, freight, payroll and utilities, as well as amortization and depreciation. Amortization is for intangible assets we discussed. So this is how operating profit is arrived at. Operating ratio is equal to 1 minus operating profit ratio. Okay. Operating ratio is the cost of operations upon net sales into 100, whereas operating profit is gross profit minus administration, which is operating profit. So operating profit plus operating cost will equal to net sales. So therefore, if operating profit is 40% operating profit ratio, then your operating ratio will be 60%. As simple as that. Please understand, both of these ratios are complementary ratios. Okay. Now let us come to net profit ratio. Net profit is also something we have discussed earlier. Net profit is gross profit minus all indirect expenses plus other incomes. Okay. So other indirect expenses and other incomes include interest paid on loan, interest received from investments, legal charges paid, etc. All of these general revenue expenditure as well as other revenue expenses that we make, they will be included in the net profit. Okay. So if a balance sheet provides for interest for investments, then you might have to also calculate interest received, and that will be a part of net profit. There are some companies which at times might be posing a gross loss but ultimately a net profit because they have too much other incomes. So while this should not normally happen, but having a lot of other incomes sometimes saves the company from insolvency, especially in bad times. Okay. So let us take practice questions on it. Please try this question. Sales are rupees 10 lakhs. Purchases return is rupees 50,000. Cost of goods sold is rupees 50,000. Salaries paid during the year were rupees 1 lakh. Rent paid was 1 lakh. Interest on loan was rupees 20,000 and interest on investments was rupees 30,000. Okay. Please calculate the gross profit ratio, the operating profit ratio and the net profit ratio. Alright. calculate gross profit, operating profit and net profit ratio. Take 2 minutes. Okay, time is over. Let us simply come to the answer. In this case, gross profit is net sales minus COGS. Net sales is the same as sales in this case because there is no sales return. So it is 10 lakhs and cost of goods sold is rupees 50,000. Purchases returns will not matter because purchases returns are already included in the cost of goods sold. Okay. So we have 9,50,000 upon 10 lakhs. So the gross profit ratio is 95%. Even if the answer seems outlandish, please don't worry. These are only meant to give you a command over the principles. There have been numerical questions. We will discuss them today. Okay. Now we come to the operating profit ratio. Operating profit also includes salaries as well as rent. So we deduct 2 lakhs and we come to 7,50,000 from the gross profit. Therefore, operating profit ratio is 75%. Now, for the last part, we have interest on loan as 20,000. This will be deducted, and interest on investments is something that we have received. So this will be added. So therefore, we add 10,000 to the net profit, to the operating profit, and we get 76% as the net profit ratio. Okay. Please remember, interest on investments is always something that we receive. Interest on loan is something that we pay until it mentions interest on loan to someone. And loan to someone is normally not the case because business entity is not in the lending business until unless it's a bank or a mutual microfinance entity or a non-banking financial company. Okay. I hope most of you were able to get this answer correct. I hope all of you were actually able to get this answer correct. There were some tricks that were responsible, but please be observant. Okay. These ratios are very important. The gross profit is what is ultimately we looked at for insurance purpose, because especially in the case of fire insurance, they will look at productivity. Okay. In case of employee insurance, they will look at operating profit ratio. So please look at the different metrics. We will discuss this in the class on insurance when we discuss social security. But please understand the general concept that gross profit is the most important for insurance purposes. And if you have to take an insurance of the business, they will look at the gross profit. They will insure your gross profit. Otherwise, it will be specifically mentioned because this is what your business is generating. Okay. Let us now discuss the return on investment. Return on investment is net profit before interest, tax, dividend upon capital employed. So there are two terms. First is EBITDA. This is what companies generally provide, which is earnings before interest, tax, depreciation and amortization. So earning without calculating all of these payments is called EBITDA, and sometimes ROI measures EBITDA, sometimes it also includes dividend because dividend is paid on the EBITDA, okay, upon capital employed. This will give you in percentage terms return on investment. There are three methods of calculating what your capital employed is equal to. Remember, we looked at ROI and I also called it return on capital employed, ROCE. Okay. So capital employed can be calculated in three ways. First, we look at the share capital. This is mostly for companies. We look at the equity share capital plus preference share capital plus reserve and surplus plus long-term liabilities minus fictitious assets minus non-trading investments. Okay. So we look at all the assets, all the liabilities minus current liabilities, except current liabilities, and then we deduct the on the asset side fictitious assets such as deferred revenue expenditure, preliminary expenses. All of these are fictitious assets. And non-trading investments. Okay. Non-trading investments are land, building, etc., which cannot be traded directly. These are the non-trading investments. So capital employed is basically the entirety of long-term liabilities and their claim on trading assets. That is one way. Another way is to calculate capital employed as fixed assets minus their depreciation plus current assets minus current liabilities. Okay. And the last is fixed assets minus depreciation plus working capital, which is the same as current assets minus current liabilities. So these are the three ways in which we calculate capital employed, and ROI is EBITDA upon capital employed. Okay. Let us discuss one practice question. Calculate the operating profit ratio where net sales are rupees 10 lakhs. Cost of goods sold is rupees 2 lakhs. Wages on production are rupees 50,000. Sales return is rupees 1 lakh. Salaries paid is rupees 1,50,000. Rent for office is rupees 1,20,000 and interest on loan is rupees 80,000. Okay. Please take 2 minutes and solve this. Last 30 seconds. Okay, let us discuss the solution. We already have net sales, therefore, and cost of goods sold. So wages on production as well as sales return are not necessary. Gross profit is equal to 8 lakhs. Operating profit is equal to 8 lakhs minus salaries paid minus rent paid is equal to 5,30,000. 5,30,000 upon 10 lakhs, we get 53% as the operating ratio. Okay, the answer is 53%. Please just understand the last concept of leverage ratio. We will not be discussing numericals on this. These are very technical concepts. Just knowing the basics is enough. Leverage ratio or capital structure ratios are calculated to test the long-term financial position of a firm. The capital gearing ratio is the most common one, which uses equity share capital plus reserve surplus upon preference share capitals and long-term bearing fixed interest. Alright, so therefore any long-term liabilities, remember preference share capital we discussed in the last class has fixed liabilities till the term it is redeemed. So equity share capitals as well as reserve and surplus upon preference share capital and long-term bearing fixed interest, long-term loans bearing fixed interest, these provide the capital gearing ratio. There are other ratios such as capital adequacy ratio, which banks have to maintain under the Basel III norms for after the 2008 crash. The capital adequacy ratio has also been introduced. These are not important from the numerical point of view. Just knowing these ratios exist is enough. Okay. Let us discuss some PYQs. First, which one of the following denotes gross profit? We have discussed this. The answer is B, sales less cost of goods sold. Okay. Very simple, very plain question. However, please expect that over the course of many years, EPFO questions will get more complicated and tough, and getting the basics very clear is important. Second, from the information below, calculate the sum insurable. Date of fire is on 1st March 2016. Turnover is from 1st March 2015 to 29th Feb 2016. Okay, this is the year preceding the date of fire. Turnover was 88 lakh rupees and agreed gross profit ratio was 20%, and special circumstances clause provided for increase of turnover by 10%. What do you do in this case? In this case, you add 10% increase to the turnover. So 88 lakhs is the turnover. You add 8,80,000 to the turnover. You get 96 lakh 80,000. Okay. On that, you apply gross profit ratio. Turnover is basically net sales. Okay. Turnover is net sales. So you apply the gross profit ratio of 20%. You will get 19 lakh 36,000. Okay. Last PYQ. Consider the following information. Rate of gross profit is 25% on cost of goods sold and sales is rupees 20 lakhs. Which one of the following is the amount of gross profit? Okay. Please look at the question carefully. Gross profit is 25% on cost of goods sold. So, cost of goods sold plus 25% of cost of goods sold is equal to sales. Therefore, you will see 125% of cost of goods sold is equal to sales. 100% of cost of goods sold will equal to rupees 16 lakhs. If 125% is equal to rupees 20 lakhs, 100% is equal to 16 lakhs and the gross profit will be rupees 4 lakhs. Okay, this is what I was talking about, that please be very careful of the words. If you only had 25% and you thought 25% talks about 25% of sales, then you would have taken A. However, the correct answer is D. Okay. With this, we come to the end of the accountancy portion of the EPFO syllabus. Thank you.